In the last 10 years, I've gone from college dropout to making over $1 million 7 different ways. And while I've done this, I put my very best lessons online, explaining my thought process and methodology for literally everything I've ever done. This video contains my best, most effective videos on making millions investing in stocks and cryptos, as well as how to make money trading, even if you're starting at $50 or less. You don't need to be making thousands of dollars per week to start. You just need to start. Now, there is a fast way, making money trading. There's a slow and reliable way, making money in the stock market. And then there's the new way, making money with crypto. I'm gonna show you all three in this mega video. So let's start with the fast way, trading. How to do technical analysis. Understanding technical analysis can mean the difference between buying here and buying here. And that's why I've decided to create the best darn beginner's guide to technical analysis on the internet. Starting with some very important terminology. Price action, the movement of an asset or security's price over time plotted on a chart. All-time high, ATH, the highest an asset has ever been in price. Support, a point in the market where the price is less likely to drop below due to previous demand or price action. Resistance, a point in the market where the price is less likely to break above due to previous demand or price action. Trend line, a line indicating the general price direction of a chart. Breakout, when the price of an asset breaks through a predetermined trend line. Formation, when a financial chart moves in such a way to create a recognizable pattern. Patterns to signal trading opportunities, either to enter or exit positions. Pump or bullish, the price of an asset is going up. Dump or bearish, the price of an asset is going down. Long position, a regular buy in the market, a trade that is predicting the asset will go up in value. Short position, the opposite of a long position, entering a trade position betting the asset will go down in value. Don't worry, if you're feeling lost already, we will break everything down even more. A market order, an order to buy an asset or security immediately at the current market rate. Limit order, an order to buy an asset or security at a specified price or better. If you set a limit order to buy an asset at $5, your trade will not be initiated unless the price hits $5 or less. These terms will help you with the learning process for the remainder of this video. Now let's go ahead and get you set up. The first thing you need to do is select your trading platform. It's important to take your time on this because there's a lot of scam exchanges and exchanges that simply charge way too much in fees. For trading cryptos, I'm personally a fan of KuCoin. If you're looking to trade stocks, I'm a big fan of Webull as they have a really easy to use interface and some free stocks for signing up. I'll have all the options linked in the description of this video. After you've created your account, you'll need to understand what you're getting yourself into before entering any trades and risking your life savings. Please don't risk your life savings.
I don't understand. Why would you buy a policy? It's just the cost of a cup of coffee an hour.
I've seen people make millions trading, but I've also seen people lose everything. So trade responsibly because no one can predict the future. Technical analysis is just an additional tool in your tool belt that you can use to become a more well-rounded investor. It is by no means a fortune teller, and none of this video should be interpreted as financial advice. So what are we doing when we talk about our own technical analysis? Picture this. You're planning a vacation to Italy with your family, but you need to get a hotel. Before you go, you could manually call some hotels in Milan and ask about their services, their schedule, and how close they are to a wine and cheese shop. It takes you about 2 weeks to complete this exercise, and at that point, you have about 10 hotels on a spreadsheet with all this data that you've collected. You have great information, but most won't go through all of this effort. Instead, you probably would look at an aggregator website that allows you to compare customer feedback, average booking prices, and of course, the distance to your local cheese shop for the most popular hotels. This allows you to get a pretty good idea of what you're getting yourself into without ever having to crack open the operations manual of 10 different hotels. Technical analysis works a bit like the second situation. Well, it's important that we have a good understanding of a crypto or stock's fundamentals before considering it. You have to ensure it's not a scam anyways. Past a certain point, we need to learn about how investors are trading that asset. What's the price action and what can it tell us? Can this help us invest? This will help us determine if the trends we see happening right now will continue or if they're more likely to change in the future. Technical analysis measures price movements, uses indicators, and offers suggestions as to potential opportunities to buy or sell cryptos and stocks. This usually is more useful for short-term traders, but it can be valuable to long-term holders as well who want to ensure that they find the best possible entry prices for the assets that they're looking to invest in. Now, to keep things simple, this is a beginner's guide. Now, I've selected a few of the most accessible ways that you can start doing your own technical analysis and learn to create a more proactive strategy for crypto and stock trading. And before we dive deep, I also need to let you know about my Patreon linked in the description. There you'll find a massive private investor community, daily crypto trade signals, free coaching, and alerts whenever I buy or sell assets, all for as little as $10 a month. And there's a reason that we have nearly 10,000 satisfied members. The first indicator that I want to talk about is the candlestick graph. It's one of the most popular ways of looking at how prices change. This tells us a lot more about the supply and demand for an asset than a simple line graph ever could. Candles can be set to show price changes per minute, per hour, or per day, and this is beneficial depending on how frequently you trade. So let's look at the colors first. A red candle tells us for that day the asset closed at a loss, and you guessed it, a green candle tells us that the price went up. What's more important to look at here is the opening and closing prices. If the candle is red, then the closing price is the bottom end of the candle, with the opening price at the top. The opposite is true for green candles. The bottom is the opening price and the top is the closing price. But that's not all. Many new traders will forget to look at the wicks, and this is important. Don't forget the wick. That sounds dirty for some reason.
That's what she said.
The wicks tell us what the highest and lowest prices were for the day or whatever time interval your candles are set to. Very often, the wick extends past what a candle's opening and closing prices are. So as a rule of thumb, we say the larger the wicks, the more volatile the market. But we can dig deeper still because short and long wicks have different meanings between red and green candles. First, the red candles. A long wick at the bottom of a red candle can tell us that within the day or whatever time period you're looking at, prices fell to what many investors consider to be the cheapest price. And so they bought back in at that price, driving the price back up. Some investors see this as an indication that the price will begin to move up in the next day or the next trading period. But remember that a long wick means high volatility, and that trend could easily reverse. Now, if you see a short wick at the bottom of a red candle, proceed with caution. This tends to mean that traders will continue to sell the asset. But again, this is not always certain. Now, for green candles, a green candle means that during the set time period, the asset's price went up. A long wick at the top of a green candle tells us that at some point within the day, the price significantly exceeded the closing price, meaning that traders might have considered that to be the top and then decided to take profits at that top price. That is, sell their crypto or stock. Long wicks show us that the market is volatile and could indicate that the price may fall from there. A short wick at the top of a green candle, on the other hand, is common when the price is at all-time highs. Now, some say this is a good time to sell if you're looking for an exit in that position. If you are looking for an opportunity to buy and you only had the candlestick chart to look at, a good time to do so, according to technical analysis, would be on a red candlestick with a long wick at the bottom and a short one at the top. Now let's pump the brakes here for a second, because you'll notice on this chart for ADA price movements, there are some red candles that fit the description of a buying opportunity, only for the price to fall well past that just a few days later. And spoiler alert, the tools that we're going to discuss today can't account for which way investor sentiment is going to go in the response to headlines and other global events. There isn't a candlestick that can predict a global pandemic or election results, unfortunately. And if you find a fortune-telling candlestick, keep it to yourself, but DM it to me, but keep it to yourself. Now, investing, especially in crypto, can be very volatile. And one way of making an informed decision despite that volatility is by using trend lines. This is the practice of finding the overarching movement in price. The trend. Many exchanges will have charts that automatically show you trend lines generated by AI, but if you want to DIY a trend line, you basically just draw a trend line yourself by choosing a period of time that you want to measure, starting at the bottom of the candlestick for that day, week, or hour, and then drawing a line connecting it to the bottom of other candlesticks. Once you have enough points, you can project your trend line in the future to help you determine if the price will move upwards or downwards if that trend continues. Trend lines can help us take a step back and look at how much an asset's price rises or falls over a defined period. If we look at that same price chart for Cardano ADA, except zoomed out, where each candle represents 1 week, we can see the trend now tells a completely different story. If we were looking at the performance of Cardano just in the last few days, our trend line would be clearly pointing downwards. However, looking at the last few months, the bottoms of most of the severe candles have been showing a general uptrend. This indicates that ADA could be a good long long hold crypto. However, with this, you may have to sit through some heart-wrenching price swings on your way up. And again, none of this is science. Because of this, it's good to compare multiple trend lines. Looking at long-term trend lines covering about 6 months to a year, and then compare that with short-term trend lines. This will help you find better entry and exit points in the assets that you're interested in. So far, I've talked about ways that you can interpret common price charts for your own technical analysis. So next, let's talk about support and resistance lines and how to derive and interpret them for your very own strategy. Well, support and resistance lines are horizontal lines that you can draw onto your price chart. Support shows the lowest price at which investors are willing to buy that asset. This signals when buyers show the most demand for an asset. When you see an asset continually bouncing off a specific price, this is support. Let's say you're trying to forecast prices for the next month. You might look at the lowest price point from the previous month and label this your support level. This way, if and when your stock or crypto dips to below that price point the following month, you can anticipate that an upwards trend may be coming. Resistance, on the other hand, shows the highest price at which investors will usually stop buying and instead begin selling that asset. This can signal that there are more buyers than sellers in the market at that specific price, meaning that the asset will have a harder time passing through this price point. In your analysis, you might see that support and resistance lines don't really change from period to period. This happens when the majority of buyers and sellers tend to group around the prevailing support and resistance lines. And this could lead to what we call trading sideways, where the price doesn't change a whole lot over a period of time. Now, what you want to look out for are price movements that break away from support and resistance lines. Take, for example, our ADA chart from last month. Notice how from September 15th to October 18th, there was a steady decline in the resistance line, meaning that investors were finding lower and lower prices too expensive to buy. We saw the resistance line drop from $2.6 down to $2.3 and then continue to dip around $2.1. So at least for this short period that we're measuring, the price at which there was an oversupply of ADA kept getting lower and lower. This might lead an analyst to believe that there would be a steep correction coming in this asset. Next, we need to talk about formations. Formations are patterns in the price movement of an asset on its chart. Formations are amazing because this is what allow us to identify the most likely direction an asset is headed to, as well as the most likely price it will stop at after breaking through that formation. In the same image, you will see a yellow circle and a green circle. The yellow circle is the moment this asset broke out of the formation. Most traders, you gotta listen here, most traders will make the mistake of entering a long or buy position at the moment of breakout. This is a huge but very common mistake new traders make. They assume that since it broke out of the formation, this verifies the formation that they drew, that verifies that it's accurate, and verifies that the asset will go directly to their price target. But it's an extremely important practice to be patient here and wait for the confirmation bounce. An example of this is the green circle. The price bounces off of our previous resistance line, confirming that this resistance no longer has the same effect. The confirmation bounce should be the best moment to enter in your trade. If it bounces to the upside, you would enter a long position. If it breaks through to the downside, you would enter a short position. Breaking through a pattern, just like the trend lines we just discussed, is called a continuation pattern. So let's briefly cover a few popular patterns that you may see referenced. The pattern that we just looked at could be referred to as a wedge pattern. If trend lines had connected in that pattern, it would be called a pennant pattern. Flag patterns are two parallel trend lines that can head upwards, downwards, or sideways. A cup and handle pattern is when the price increase has paused. The bowl shape is then followed by what looks like a pennant chart pattern, and this may indicate a further breakout in price. A head and shoulders trend following an increase in price may indicate the price will decrease. A reverse head and shoulders trend following a decrease in price may indicate that the price will increase. Now, it's important to note that humans love finding patterns in literally anything, and there are a million chart patterns that can mean different things. But this doesn't mean you should expect the result to always come true. Again, this just helps paint a more clear picture, but does not absolutely tell us the future. Now that you know when to enter a trade, let's talk about when you should exit a trade, because this may be even more important than when you enter a trade. And this answer may vary because it depends on whether or not you are trading futures with leverage or trading spot without leverage. Leverage leverage is simply borrowing money to use in a trade to help increase your potential return. Let's say you've entered a trade with $100. When trading with leverage, you may borrow funds against that $100. With 10x leverage, your $100 acts as if it's $1,000. So mathematically, when the asset you're trading goes up 1%, you will actually be 10% in profit. However, it's not all good and rosy, because if the trade goes down 1%, you will be at a 10% loss. If you lose too much, you will be liquidated completely, meaning you lose all the funds that you entered into the trade, and you don't want to be in that position. So this, of course, is very high risk and not for beginners. Now, trading spot is just regular trading with your own money and no borrowing. Here you still have the risk of losing money, but liquidation is not a concern like it is with leverage. When trading with leverage, typically you want to close your trade the moment you hit your target or just before. This will prevent you from being hit with recurring leverage fees. When you're trading with spot, you don't have to worry so much about rushing out of the trade. So if a trade has surpassed your target, you can simply hold longer and set up a trailing stop loss. Now, a trailing stop loss is a stop loss tool you can use that will follow the price of an asset by a dollar amount of your choice and then close your trade at the maximum amount of profits possible, completely on autopilot. Typically, you wouldn't set up a trailing stop loss until your price target is already hit and you just want to try and make a little bit more profit. Now, speaking of hit, if you appreciate my efforts in putting together this free course, just please consider hitting the subscribe button. It's totally free and you can always change your mind later. Now, spotting trends isn't enough on its own. You also need to evaluate the strength of a trend, because not all trends are created equally. So one indicator that we can look at is trading volume. This is the total dollar amount traded of an asset. Now, it's pretty simple to do this, so it should be a regular part of your technical analysis. The higher the trading volume, the stronger the trend. And this makes sense if you think about it, because a trend with 10 million in volume behind it means much more than a trend with 1 million in volume behind it. So it's always good to take a look at the 24-hour trading volume on days where the price moved downwards, and then compare this to the trading volume on days where the price moves upwards. If you see higher volumes on positive days, this can tell us that there's a long-term potential for the asset to continue trending upwards. This also helps us evaluate how the market will react to a sharp drop in price. If the trading volume during one dip is larger than another more severe dip later on, we might determine that the drop in price does not signify a stronger downwards trend. Something else to take into consideration is market cap, which you get by multiplying the current price of your crypto or stock with the total supply of the crypto or stock. Big cap coins and stocks tend to be more stable because large volume trades have less of an impact on their prices. It's hard to move a big ship. Now let's move on to a more technical indicator of price movement, and one that I use quite regularly. This is the Relative Strength Index, or RSI indicator for short. The RSI of a certain crypto or stock usually is pretty easy to access. It's usually displayed just underneath price charts for the purpose of directly comparing price trends with the RSI. It's displayed as a number between 0 and 100, and this number changes continuously based on trading activity, typically relative to the average gains and losses over a 14-day period. This kind of graph is called an oscillator because the readings always show a number between 0 and 100. So let's break down how this works. In basic situations without drastic market moving events, RSI indicates whether a crypto or any kind of security is overbought or oversold. A reading above 70 would tell us that it's overbought and can signal that a price correction may happen. A prolonged RSI above 70 can be interpreted as some kind of bubble, and that the coming correction could create dramatic losses to the people who are invested in that asset. Now, readings under 30 indicate that the security is oversold. In other words, the asset may be undervalued, meaning it could be a good opportunity. You've probably seen videos where certain cryptos or stocks are proclaimed to be undervalued. The RSI indicator was likely one of the tools used to come to that conclusion, and now you can use that. At the water cooler, at work, you can be like, hey, I think that this stock is undervalued. You just check the RSI. It can be that easy. So there's actually a whole book written about the Relative Strength Index. If you want to fully understand it, I will have this book linked in the description of this video. Now we need to talk about the moving average. You can calculate this by taking the price readings of your crypto or stock from the last X number of days. The standard is 20, but you can reduce it to about 5 if your trading strategy requires it. So this works by adding up the prices each day of your stock or asset or crypto, and then dividing that sum by the total number of days in the period. It's just the average price. What this gives you is a price figure that's less impacted by wild market swings, allowing you to focus on price performance as it changes over longer periods of time. If you want to use a shorter window for your average, like 5 days, just know that your moving average could be far more affected by temporary price swings than longer averages are affected. So just make sure your investing strategy takes this into account. I like using moving averages to forecast price changes in a similar way to how the RSI indicator triggers buy and sell alerts. When the price of an asset falls below your moving average, some investors take this to mean a downward trend is imminent. And you can interpret crypto or stock prices above your moving average to mean an upwards trend is more likely to happen. Now, understanding when to take profits can sometimes be tricky, but there's a solid rule you can remember, and I think everyone should follow this. It's never wrong to take profits. Even if it's 1%, even if it's 0.5%, don't let greed take over and tell you, it could just keep on going up. Trust your plan, not your emotions. Please, you will make more money in the long run. So far, we have gone over trend lines. Now let's cover how we can use these formations to find a price target so then we know when to safely exit a trade. In this example, I will show you a double bottom formation or a W formation. We'll call it a booty formation. I don't know. In this formation, you wait until we break the resistance called the neckline. We then wait for the confirmation bounce. This is revealed to us after the breakout. The price action uses the neckline as support. We measure the target by measuring the bottom of the W formation to the neckline, then dragging the measurement to the top of the neckline. We can also use indicators to tell us if we're unlikely to hit the exact target. Indicators I like to use are EMAs, which stands for exponential moving average. My settings are at 21, 90, 200, and 600. This indicator will tell you when the price is likely to hit short-term support or resistance levels. And there you have it, some of the useful tools that you can use to get started in your own technical analysis of your favorite stocks and cryptos.
Meet Kyle. He turned $26 into $2.7 million, and he did it using 4 easy rules.
The last bull cycle, I was able to flip 15 grand into $300,000. Then I went from 300,000 to 2.7 million. The last trade changed my life. It allowed me to get a house, allowed me to get this crazy cool studio. Yeah, it changed my life. My story can be anybody's story because, dude, I'm not really that special. It's just, if I can figure it out, literally anyone can figure it out. I just hated my job enough to start this. That's all that really took.
But what's amazing is he's helped others do the same.
There's one member that's basically start with $250 and in 8 months, turn that $250 into $1 million.
He posted his entire multi-million-dollar trade step by step on FINOVA so members could copy his results in real time. Here's why I interviewed Kyle. I wanted him to take me through his insane story from the beginning, where he left this job that he hated, he had to get out of debt, he then got scammed, leaving him with $27 to his name, and then he took that tiny little $27 pocket change and turned it into generational wealth.
I was working at a call center when I quit my job. Debt interest in combination to my bills was actually outpacing what I made per month. So I needed to find a solution that was scalable, and I found that through trading. And I was able to grow my account from $26 to over 2.7 million.
You know what? I'm going to take you through my entire interview with Kyle where he explains the 4 simple trading rules that made him $2.7 million and how he protects that money, the 2 free tools that he uses every single day, the warning signs that he follows to buy and sell, how he would start again with as little as $100, and I asked him what 4 coins he's watching right now outside of Bitcoin, so stick around for those. Now, this isn't financial advice. It's just the strategy used by an everyday guy who has a crazy success story. It's up to you whether you want to take on the risk and try this yourself. It's just a story that I felt the world needed to hear. The key principles. As you'll see in a second, Kyle's strategy is extremely simple, but to pull it off, you need to lock down some key principles that will keep you safe. And the first one is so crucial. It's allowed him to time his trades almost perfectly, like suspiciously well.
The problem with a lot of traders and investors is they're impatient. They want to get rich quick. If you are trying to force an opportunity that isn't there, you usually end up being the liquidity that makes other people money. Be as patient as you can and wait for the rules to tell you when to get out.
But of course, patience by itself, that's not enough. Kyle also needed some fixed guidelines for how to approach risk. That way he can prevent himself from making huge mistakes.
There's some things that everyone needs to be aware of. They also need to know how to manage their risk. Don't use too much leverage. Use a safe amount of funds. balance. Always risk to lose 1% to gain 2. Always have your stop loss set up. It's the only thing protecting your wealth, and it can allow you to grow. When it comes to limit orders, getting it set up so it automatically exits the trade for you at a profit. What I'll do instead, I'll either set an alarm if it's during the day. When it's time to go to sleep, I'll set a limit order, and then that way I'm making income while I'm asleep. I think of the stop loss as a budget. Everyone has to drive to get to work and pay for gas. And when I lose a trade, I'm just paying for gas. So I just paid for gas. And the next trade, because of my risk to reward ratio, is always going to be worth more than the loss that just occurred. So it allowed me to scale.
And if you like Kyle's style so far, you're absolutely in luck because you can actually follow his every move in real time. That's because Kyle is a full-time trader over on the FINOVA Patreon. This is a service where I give access to all of my personal investments in my entire portfolio. I offer 50 plus hours of training material, and as you can see, I seek out the best traders in the world, like Kyle, to make this the most profitable trading service in the world. Here are some of his recent trades. That'll be linked below. So as Kyle traded, he learned how to better allocate his time, and what he discovered surprised him as it ran opposite to what most new traders were actually doing.
A new person just getting into the market, learning how to trade, they're probably looking at the chart and probably over trading, doing 10, 20 trades when they really only need to do 1 or 2 to make the same amount of money. I can look at a chart in 15 minutes and I'll know what I'm doing for the rest of the day. When I first started, I was doing it 10 hours a day. When you just got a rule book and you just got to follow the rule book and you just got to wait for those rules to be met, you can literally set alarms on your chart to tell you when to start looking at the screen. So you only need to dedicate like 45 minutes a day.
But principles aren't enough. He also had rules based on solid data. Here are the 4 simple rules that made him $2.7 million. His rules start with a tool called chainexposed.com. It's a free tool that collects on-chain and technical analysis metrics to help people predict the market. But Kyle only focuses on a few super specific graphs.
This is like one of my favorite charts. It's supply and profit and loss. So you can see when I move my cruiser here, you can see that it's showing you based on the current price where this black line is, what the supply is in percentage of profit, like how much of the supply is in profit and how much of it is in a loss. 67% of people were in a profit and 32% were in a loss. Obviously, as the price goes down, the more people are in a loss and less people are in a profit. You can help use this as a tool to tell you like when's the best time to buy and when's the best time to get out. And as we get closer and closer to all-time highs, it's inevitable that like 100% of the supply is going to be in a profit. What I look for in this, it tells me like basically how exhausted are we in the market, and it helps me call the tops a lot better, and it helps me call the bottoms. I usually want to see before I decide to buy for a macro trade, I want to see like at least around 50% of holders at a loss. That helps me identify like, okay, we're in a state of capitulation. There's a lot of fear in the market, and everyone's heard like, buy into fear, sell into greed. It's basically this. This shows you exactly what's going on in the background for that.
So that's rule number 1. Prepare to buy when supply and profit or loss has 50% at loss. He uses that graph to give him cold hard data. I shouldn't make that hand movement. To give him cold hard data on how much fear is in the market. When that sinks below 50%, that's a good sign, but it's not the only sign.
And then when we go to the relative unrealized profit chart, this one here, there is what's called the opportunity zone down here, this green box. And when we're in this is another rule. I want to see price inside this green box. This is when we're in a state of capitulation, not just holders, but also miners are at a loss. There's a lot of people that are at a loss right here. When I see we're in the green box, it's time to buy. It's pretty simple. Just wait for this little line to get in here. That's one of the rules that needs to be met for a buy. And it's just as simple for when it's time to sell. When we see price action above 2.35, when we're in this overheated zone, this is one of the rules to prepare to sell. It's very explanatory. There's colors. Anyone can look at this chart and figure out what it means, right? But basically what's happening in the background, this is like unrealized profits going on here. And when we're below 0, there aren't any unrealized profits. So there's like a lot of unrealized losses. This cycle is gonna be a little bit different. I'm anticipating like a 50% correction rather than like an 80 or 90 because of the ETFs. They legally have to hold it to sell it to their clients, and that will create a new base floor for Bitcoin. Prepare to sell it overheated, prepare to buy at the opportunity zone. And that's another easy rule to follow.
And that's rule number 2. Prepare to buy when the relative unrealized profit is below 0 in the green opportunity zone. The logic is that when the price is in the green box, it means that a ton of people are at a loss and it's time to buy. But all of his rules aren't met quite yet. We also need to look at the Nupal chart.
Then we have the Nupal chart. Same kind of analytics. When we're below the 0 line, you'll see that there's a bunch of little lines here. The black one represents the price. The red one here represents long-term holders and what they are doing. And then this orange one is basically everybody in the mix, not just it's long-term and short-term mixed into that. When you see both long-term and short-term down here at a loss, it's time to prepare to buy. When you see people at a state of capitulation, people are at a loss, it's the best time to prepare to buy historically for Bitcoin. These charts have called the bottom almost perfectly every single time. Even like the little COVID crash that we had is telling you it's time to buy. So that's pretty much it for the on-chain stuff, man. It's very simple.
That's rule number 3. Prepare to buy when long-term holders and average holders are in a state of capitulation, meaning down below the 0 line on that chart. Again, he's looking for real-world signs on-chain that show the market is full of fear. That's when he's targeting a buy. The first 3 rules here on Chain Exposed are extremely important.
You want to see this line, basically price the Newell chart showing that the long-term holders and the average holders at a state of capitulation, they were a loss, we're down below the 0 line. We prepare to buy when we start seeing about 50% of the supply at a loss, and we prepare to buy when we see this in the opportunity zone below 0.
So this gives you a good idea of market activity and sentiment, but we still got rule number 4, which requires a completely different chart on TradingView, another free tool.
And then it's about the chart. What's the price doing? So we go into the chart, it's about the structure. So if we zoom out on Bitcoin, we have what's called a legacy trend line right here. And this is a trend line that's been holding up Bitcoin since 2017. When we reach this level, you can either use this line or you can use the 300 weekly EMA. I find this line just to be a lot more accurate. It's called legacy support. When you draw a trend line and you're going on the daily chart and you're trying to get as many connection points as you can for support, it'll give you a good idea of where the bottom's going to be. And it tells you, and you can see that's trending upward, right? So like the floor value of Bitcoin is going up based on this trend line. As time goes by, it's going to get higher and higher and higher, and it's going to help define where Bitcoin's likely going to go when we have the next bear market correction. You look at this as your target to rebuy. And when it comes to selling, it's a little bit different. Like calling the tops a little bit more difficult, but it's the same on-chain rules, but in reverse. And then you just want to wait for a loss of uptrending support. This is a trade when you jump into it, you go in with the mindset that it could last over a year.
Rule number 4, prepare to buy when the price hits the legacy support trend line. The logic here is that once you've determined the market is in a state of capitulation, you can then look at the Bitcoin price to see where the bottom will be. When it hits its legacy support, that's where you buy, and that's where you potentially make this insane return. This way, you're looking to start a trade at a good evidence-backed level of market fear and a reasonably low price. In essence, he's kind of using data to invest exactly like that famous quote you've probably heard before: be greedy when others are fearful and fearful when others are greedy. As I said in the start, Kyle took FINOVA members through this trade as it happened in real time. This is one of the most profitable trade signals of all time, and it was available right on FINOVA, meaning you would have had access to this trade and so many more if you were a member at the time. If you don't want to miss out on the next trade from Kyle, myself, or any other FINOVA trader, make sure to join. But just a warning, join fast because we sell out of spots every single week. Now, Kyle's strategy works for any kind of trading, but typically he uses it for an inverse perpetual trade that has a unique fee structure. This is where you leverage Bitcoin to predict futures. I'll let him explain.
So an inverse perpetual trade is a lot like trading with regular futures where you're predicting the direction. You can go short, you can go long. So like short predicting it to go down, long predicting for it to go up. Rather than using USDT or USDC like most people do, you use Bitcoin. So you're putting your Bitcoin into the trade. It's called coin margin, or it's called inverse perpetual, depending on the exchange. Most people know it now today as coin margin. But when you enter that trade, you choose your leverage just like you do with any other setup. And you basically, that will determine your volume. So my 10 Bitcoin acted like 20 Bitcoin in this trade. Most of the major big exchange has coin margin or inverse perpetual.
Just a word of warning, you need to be careful with trades like these because the fees can scale rapidly. That's actually what got him out of this trade in the first place. So you need to have money set aside to cover those fees, otherwise your trade will be closed early. But let's say you hit a big win. What's next? Well, as you can guess, Kyle has key rules for selling as well.
And you'll notice that the short-term holders on chain will start to go up and the long-term holders start to go down. And we just had that occurrence go through now. So we've got the warning sign that we're halfway through the bull market. Now we just got to wait until we are seeing about 80% of short-term holders in a profit again. And that's a warning sign. And then this gets to the overheated zone. That's the next warning sign. Then we lose support on the chart. On the chart here.
So in essence, you sell when it's the reverse of all the buy rules that we've already talked about. But returning to buying, Kyle's rules aren't quite enough. He relies on a couple signs that have to be in place before he even checks his 4 rules to begin the trade. So how to know when to buy. To do this, he looks at a piece of data called the golden accumulation chart.
I call it the golden accumulation chart. This is called the 200 weekly EMA. It's basically think of it like every single time there's a weekly candle that's printed, it creates an average and it generates this line. So this is like a combination of 200 weeks of candles that tell you where the current average is. And it creates a really big weighted level of support. And when it breaks, it's actually known to be one of the best times to buy. So if you use the break of the 200 weekly EMA, this green line here, in combination with the on-chain data, you can get yourself a really good entry price. Of course, you can use formations to help guide you too, like double bottoms are huge warning signs to prepare to buy. Like this is the bottom. You're not going to have another opportunity to buy. So you can see them here. They're like big W's.
By looking at the 200 weekly EMA and double bottoms, Kyle was able to see whether he should start looking into a trade. When he sees the right information, he then checks his 4 key rules.
So you use this chart. Whenever you see this box pop up, you prepare to buy, and then you just go through the rules that we went through on chain. And once all those rules are met, it tends to give you the best entry. A lot of people jump the gun and they'll get really hypey when they see price action get down below here, but it's not enough. Just wait till all the rules are met and it'll save you tons of money and time.
Be patient, look for the yellow box. This means it might be time to buy, but then check your 4 rules first. If they're all met, buy. If they haven't, wait. It's that simple. Don't try and create an opportunity. Wait for one to arrive. That was the backbone of how Kyle made his $2.6 million from 27 bucks. But remember, without patience and without emotional management, it's just not going to happen.
They're impatient. They want to get rich quick. If you are trying to force an opportunity that isn't there, you usually end up being the liquidity that makes other people money. Be as patient as you can and wait for the rules to tell you when to get out. Honestly, that's the biggest thing. Emotions will destroy you.
He also told me something surprising, that most people could become a millionaire in far fewer trades than they think. How many trades for the average person?
The average person can become a millionaire in 300 trades. It also, of course, depends on what you start with. But if you're starting with like $1,000, the average person can become a millionaire in like 300 trades. That's including losses in that too.
So 300 trades total, like realistically not that many. But if you're using his rulebook and his strategy, how long does that take per day?
If you got your rulebook in your pocket and you just wait for it to meet those rules, you're looking at like 45 minutes to an hour per day.
An hour a day. I asked him something that I think would apply to a lot of viewers, something achievable. How would he start again with as little as 100 bucks?
If I were to go back in time and start completely all over again, like I know I wasn't very fortunate at the time, so $100 would probably be a lot to me. The reason why I would recommend most people to start with a small amount is because as your account grows, you're actually training your emotions little by little to handle a larger and larger account balance. Emotions is a huge factor when it comes to trading. A lot of people will jump into a trade that they do not belong in. If I were to give you a set of rules and you cannot enter a trade unless those rules are met, it's not going to matter if your emotions get in the way and try to jump you into a trade that you're not supposed to be in. I would still start small so I can still train my emotions, give myself a set of rules, and not chase after the new shiny indicator. That was a big problem with me when I first started trading, is I would try to add more rules, look at other indicators, add more rules, stuff like that, and not analyzing how it's going to impact my win rate. So backtest every single thing that you hear when it comes to trading, and especially in the crypto space. You want to make sure that those rules, if you were to apply them, if you were to backtest it, you would give yourself a percentage value of how often you're going to win a trade. So if you give yourself like a sample size of 100 or 200 trades and you find out what your win rate is going to be using those rules, then you would have yourself some data that would literally tell you exactly where you're going to be from now after 300 or 400 trades. And you can actually predict where you're going to be at mathematically in terms of profitability. Risk management is incredibly important. You know, if you're trading with $100, you should be risking around $1 to gain $2. You know, you should always be risking to gain more than what you're willing to lose, and let yourself scale through compounding that way. As your account grows, you know, maybe it gets to $200, you'll be risking to lose $2 to gain $4. And when you're at $300, you'll be risking $3 to gain $6, and so on and so forth. And you'll find yourself one day trading with 15 grand and be able to quit your job or stuff like that. And another tip I would give myself as well is if I were to try to think about quitting my job again, I would highly recommend having at least a 6-month emergency fund. When your trades are the only thing that's paying for your bills. It could add a lot more stress into trading, and you want to be as calm as you possibly can as a trader. So having a good lush fund to fall back on is more than recommended.
And we aren't done yet. I know you love hearing about coins outside of Bitcoin, so I asked him what else he was looking at and what interests him about the market right now. The 4 coins Kyle is watching.
When it comes to other coins other than Bitcoin, I like to look at all these cryptocurrencies, all these different assets as their own vehicle. What I mean by that is I want to see which one's going to hit their destination the fastest and which one has the most amount of safety features. Rather than an airbag, basically what I mean is which vehicle has the most amount of holders, the most amount of liquidity, the best development plan, the best marketing, stuff like that. And I want to jump in on the vehicle that will basically get to the destination as quickly as possible. So I can take those funds out and put them into a different vehicle that hasn't even started going yet and compound and grow that way. So when it comes to larger market cap, I'm focusing mostly on like Solana, Chainlink, and Ethereum. When it comes to lower market cap assets, you got to take a huge step backwards and think about what is the narrative that everyone's talking about right now? What is everyone talking about right now? It doesn't have to be in the crypto space, just in general. And right now it seems to be artificial intelligence. Like AI is the big hype that's going on right now around the world. When you are looking at the AI sector in the crypto space, you can see that they're outperforming even Bitcoin right now. So short term, you basically want to get in and out as quickly as you possibly can, and you just want to think about which assets are the loudest right now and which one's got the, just like I said before with the higher market cap stuff, like which one has the best roadmap and the best marketing plan and the best which technology you think is going to be a disruptor in the space. Yeah, for this cycle, I would say artificial intelligence for the lower market cap stuff, and you invest in a significantly a lot less funds than you do with the larger market cap stuff, like scratch ticket amount of funds, basically.
Make your first $1,000 with options, even if you're a complete beginner and don't know what options are. Options have a reputation of being difficult, but the truth is they're mostly taught the wrong way. Once you understand how they work, you can have one-day trades like these, or longer trades that can literally double your money, which is what I'm going to teach you in this step-by-step course. But first, you got to start with step 1. What is an option? An option is a bet between you and another investor. You're betting on the future price of an investment. If it goes your way, you make money. If it doesn't, you lose money. The bet is made official through a contract that outlines the cost to set up the bet, your goal price, and the expiration date. But here's the magic. With an option, you're buying the right, not the obligation to make that bet. If you don't want to go through with it, you don't have to. Kind of like a reservation at a restaurant. Just because you booked it doesn't mean you have to show up. You always have the choice. Here's a real-world example. This stock is trading at $35, but you think it's going to hit $45 next week. In order to make that prediction, it's going to cost you $10. Now let's say you bought that bet. If you're wrong, you're out $10. If you're right, you actually profit $1,000, minus the $10 to make the bet. That's because you bought the right to buy 100 shares at $35 and sell them at $45, making you $1,000 in profit. But that sounds too good to be true, right? The choice to make an investment only if you're gonna make money? You'll understand exactly how to make money in a minute, but we need to pump the brakes real quick. This can get overwhelming, so let's start slow. Dip in a toe first, take it easy. We'll start with the basics using analogies and animations, slowly wading into the water, driving home how options work in the real world. Then we'll get into the exciting stuff. But before that, we gotta cover step 2, understanding puts and calls. Buying a call is a bet that prices will go up. Buying a put is a bet that prices will go down. Now, it can be hard to remember which is which, so here's a dumb trick I invented. When buying an option, I actually look at the words put and call. I think of the U in put and the A in call as arrows. The U in put forms an arrow pointing down, so buying a put means you're betting the price of an asset will go down. While the A in call forms an arrow pointing up, so buying a call means you're betting the price of an asset will go up. That trick works for buying options. Follow the natural direction of the arrows and you won't be led astray. But
We can also sell options. Here's how you can remember what those mean. Selling is going against the grain. So when selling a put or a call, we simply turn the words upside down before again following the arrows. So we have a call option. Buying a call option is a bet that prices will go up because of the arrow. Selling, we flip the word upside down and follow the arrow. So selling a call is a bet that prices will go down. The same goes for put options. Remember that buying a put is a bet that prices will go down. But if we're selling a put, we flip the word upside down and follow the arrow to see that selling a put option is a bet that prices will go up. I highly recommend screenshotting or drawing this graphic to use for reference in the future. It's dumb, I know, but I swear it works. So now that you know the terminology, let's go back to how much options can actually earn you. Those massive profits from earlier are actually from an institutional investor coach of ours, Eugene. Of course, not everything is a win, but it's insane what he's capable of. And by the way, our investment group will be linked in the description. There you'll get access to Eugene and other coaches just like him. In fact, I'm so confident in our service that we're offering 7 days free. After that, you can stick around for as little as
$79.
Just make sure you join ASAP because we actually limit spots every single month to ensure that everyone gets the help that they need. Okay, so how's the water feel? Good, not too cold, not too warm, a real Goldilocks porridge situation? Great. Well, let's go a little bit deeper, and we'll use a far-fetched analogy to really drive the explanation home. Let's pretend you smoke flower. For some of you, I know that's going to be a bit of a stretch. So let's say that your local flower dealer is really into the derivatives market. Oddly specific, I know. But you didn't think it was a woman. She allows you to pay a little today for the right to buy your grain at a specific price next month. Today, flour is $10, but inflation is getting out of control, and who knows what it's going to cost next month. So she allows you the option to buy your goods next month at $12.50, guaranteed. If you think the price is going to increase to more than $12.50 in that time, this is a good deal. You need to lock in that price. But if you expect the price to stay the same or drop, then you shouldn't take the deal. The dealer's selling a kind of call option in this case, like a stock option, but instead done in the alleyway behind the CVS. Let's say you take the deal. You'll have to pay a small fee upfront called the premium.
Premium! Dude!
In this case, we'll say the premium is 50 cents to enter the deal. Now what happens next? There's two scenarios. First, let's say hyperinflation does kick in and prices rise dramatically. The dealer needs to sell for way more than $12.50 to her normal customers. Well, you just made an awesome deal. The poor small business owner will lose money on the OG purple skunk hazy kush that you are going to buy, but that's not your problem. Now, what happens if the price stays the same or decreases? This is scenario 2. So let's say the price stays right at $10. This is where the beauty of options really kick in, because you don't have to buy your bud at $12.50 like the option outlined. You can just cancel the contract by letting it expire. Now, you might be thinking, that sounds too good to be true. And of course, yeah, there is a catch. Remember that premium that you paid for the right to the option? You lose that money whether you take the greenery contract in a month or not. So if the price stays the same at $10 in a month, you actually do lose money, your 50-cent premium. The price of the premium can change dramatically based on a few factors that we'll discuss in a minute. But it's important to remember that when buying a call option, a bet that prices will go up, the most you can ever lose is the premium, no matter what happens in the market. A company behind the stock could go down in flames, or Bitcoin could be worth less than a single nug full of seeds and stems, and you'd be safe because you can choose to just not exercise that option. Look at this diagram of buying a call option. You can see no matter what, you start with a loss. That's because of the premium fee you must pay in order to get the option in the first place. You begin to make up that loss when the asset reaches the agreed upon price of $12.50 from that example earlier. You will be in the negative until that 50 cents premium fee is then covered. Beyond $13 is where you start racking up profits. If the price were to go to $15, you would have made an awesome deal. Now in real life, your returns would actually be much higher because options contracts typically deal with at least 100 shares at a time. In fact, options can make a ton of money off of a small investment if done properly. We'll discuss how exactly you can do that just a little bit later, because first, Let's do one more non-bud related example. We're wading into the pool a little bit further. The water's up to your upper thigh. It's a little chilly. Okay, let's imagine you're buying a call option today for 1 Bitcoin with a current price of $30,000 and a strike price of $35,000. By the way, the strike price is a set price at which a derivative contract can be bought or sold the moment that you can strike. This is important because remember, an option gives you the option to buy or sell an asset at a specific future price. That asset needs to hit the strike price before you can exercise or use that option. This is what's called being in the money. It means the strike price has been met and you can exercise the option if you wish to. For call options, strikes higher than the market price are said to be out of the money. So let's reset this. We're out of the money in our example right now because the market rate is $30,000 for 1 Bitcoin, but the strike is $35,000. So again, if Bitcoin moved up above $35,000, we would be in the money, ready to strike. Okay, back to this full example of buying a call option. Bitcoin's market rate is at $30,000. Strike, $35,000. You've got a month to exercise the option and it costs $500 to arrange. If Bitcoin drops to $25,000, then, well, you're out $500 because the deal isn't worth it for you. In fact, if Bitcoin drops to $20,000 or $10,000 or $3.47, you're still only down $500, the price of the premium. But what if it rises? If it goes to $36,000, you'll get a $1,000 profit minus the $500 premium. If it goes to $45,000, the profit is $10,000 minus the $500 premium. If it hits $100,000, then this will be you.
I'm gonna buy the entire earth and be king.
Now, in order to take home your profit, you either need to sell the contract to someone else, now that it's in the black, or you can actually buy the Bitcoin. Let's say Bitcoin went to $36,000 on your $35,000 option. Upon exercising your option, you would be buying an entire Bitcoin at the discounted price of $35,000. This means you could buy the Bitcoin immediately and then sell it, pocketing your $1,000 minus the $500 premium fee. Buying call options like this, betting the price will go up, is the most common approach for retail investors because they're the most simple and they can be low risk if done correctly. So now that we understand the mechanics of how this all works, let's get into some real world examples. We're going deeper into the pool, from your upper thigh to your, I'll just say it, your groin. Your groin is in the pool. Options have been available in stocks for years, and now they're becoming more and more popular for cryptos. While they generally work the same, there's a big difference in volatility. Since cryptos are known to swing wildly in price, that means that the premium fees are higher, but they can also be quite attractive for short-term strategies. Looking at the Bitcoin price chart, any of these steep climbs would have made fortunes with call options. Just like with comedy and juggling, the secret is in the timing. Okay, so you like the look of options and you want to use them on the stock market. Well, research is the key. Since we're looking at buying a call option, you want a stock that has the chance of going above the strike price in the agreed timescale. Let's assume you've done that research and chosen a stock. I'll be using the Webull stock brokerage to set up this option. I find them easy to use, and if you open an account, you get a bunch of free stocks, so that'll be linked down in the description if you want to check them out. Now, after signing up, search up the stock ticker that you want. Choose the options button at the bottom of the screen. Now you get a bunch of numbers, but don't panic. I know it's a little bit freaky. Click that little arrow up on the gray date bar. This brings up all the available contract expiration dates. Now you can flick between expiration dates to see the full list of your alternatives and choices. We're going to click 21 days out. You might have to scroll down a bit to see the current price of the stock. You can see that that's in the red row. The strike price is written in white text right in the middle. Remember that this is the price where essentially something will happen if it hits that price before the expiration of the contract. And it's really important to note that calls are on the left and puts are on the right. We're doing a call, or a bet that the price will go up. So on the call side, you'll see bid and ask. This is essentially the going market rate for a call option on this specific stock. But remember, with stocks, you need to multiply that by 100 because we're always buying in groups of 100 units. So if we click on one and then go to market order, we can see that in order to buy a call option of 100 shares of Palantir, we would have to pay $45. Then if we click the single option button up top, we can see the break-even price of $8.97 per share and maximum loss of now $47 because the price just updated backdated from 45. Let's put this on our chart from earlier. If this stock goes below $8.50, we lose our $47 premium. If let's say it goes to $10, we make $103 in profit on a $47 investment. That is $10 times 100 shares, minus $8.97, the break-even price, times 100. This means with a $470 investment, you would make over $1,000 in profit trading options. That easy. Once the contract is at a price you'd like to take profits on, you can either exercise it or sell the contract itself in the open market for a nice chunk of change. Then all you need to do from there is take an obligatory screenshot and post it to Wall Street Bets. For dealing in crypto options, it can get a little strange. We're up to our neck in the water now, so tread carefully. Bybit is the best site I've seen for crypto options. Plus, they have an offer for a $50 bonus when you use that link in the description and deposit $1,000. So you'll need to make an account and then fund your derivatives account with USDC, the stablecoin, and then go to the derivatives drop-down menu, and from there, click USDC options and Bitcoin options. Here we have an options page with contract expiration in the middle, calls on the left, puts on the right. Let's say we think Bitcoin is going to shoot up in a few days. We could buy a call, a bet that prices will go up, by scrolling down to find our desired expiration date. We can see the current price is $16,600, but we think it'll go over $17,500 by the 18th when this contract expires. So we click that contract on the call side, and then the right-hand side pops up with even more details. Now we're gonna go to market and type in 1 Bitcoin here for the sake of simplicity. Now that it's calculated, we can see to make the bet that Bitcoin will hit $17,500, we'll have to pay a $229 premium. And what I love about Bybit is they actually show you a profitability chart if we scroll down. So here we see our maximum loss is the premium fee. This is rounded to the nearest $5. Our break-even point is $17,720, and then above that, it's straight profit. Now, if all looks well, you'll simply click place order. As you can see, it's pretty simple and straightforward for non-Americans, kind of like healthcare. And don't worry, I'll show you a workaround on crypto options for US users a little bit later, because first we need to go back to that Bitcoin example from earlier. We have another exciting way to make money with options. The difference here is now you're on the other side of the deal, selling a call option. When selling a call option, you're betting the price will go down, a real negative Nancy. If that happens when the contract closes, you get to pocket that nice premium fee. But the loss can be massive if the price instead keeps on increasing. The current price is $30K. You sell a call option for a $500 premium and a strike price of $35,000. You are in the profit zone all the way until Bitcoin hits $35,500. After that price is where losses start, and they are theoretically unlimited, because as the price of an asset goes up, you lose more and more. If Bitcoin were to go to $100,000 where the contract is then executed, this means you just lost $64,500 having to purchase that off the market in order to give it to the buyer. Now this happens because you only got paid the $35,000 strike price plus the $500 premium, but you had to purchase a $100,000 Bitcoin. Now this isn't very common. It's called a naked call, since you sold a call option where you didn't actually own the asset and therefore you exposed yourself. It's super risky, and like other forms of naked calling, I wouldn't recommend it. Much more common is selling a covered call. This is where you already own the asset, so you're covered. So in the Bitcoin example, if you already own the Bitcoin, you would be selling your $100,000 Bitcoin for $35,500, which is annoying to say the least, but you wouldn't actually be out of pocket anything since you already own the asset. Again, this is an extreme example. Most of the time, this is a very reliable way to earn passive income on stocks and cryptos that you already hold. Typically, an investor would sell a covered call at a price that they think is unlikely to be hit. That way, they can just keep on collecting the premium fee over and over again, essentially leveraging their asset for passive income. And it can be a really awesome way to earn money on assets that are just sitting there. Let's go back to Webull and do an IRL example of selling a covered call. And this is important. If you're looking to sell a call here, you need to first own 100 shares of that asset. So you need to buy some if you don't have 100 shares yet. Remember, this is generally used to earn passive income on assets you already own, that is covered calls. I have 100 shares of MetLife, so I'm going to use that for this example. On the stock page, click Options, click the gray date bar in the middle, that's where it says 4D. That will collapse the view, showing you all of the possible contract dates. You'll choose the time frame that makes the most sense for you. I'm going to go with 32 days out, so I tap 32D.
we now see all the calls and puts for that expiration date. But we're selling a call, so we're going to just focus on the left side right now. Remember, when selling a call, we're betting that the price of our asset will go down. That's how we make the most money. Here we can see the current price in the middle is around 66 bucks per share. If we sell a covered call at the $70 per share price and our asset doesn't hit $70 before it expires 32 days from now, we get to keep our shares and collect that juicy, juicy premium fee. Let's click on the $70 contract. Then we'll click sell. At the bottom, we can see the credit is $95. This is the premium fee passive income we'd collect if we sell this covered call and in 32 days at expiration, the share price hasn't reached $70. Here's what it looks like charted out. You can see that the break-even point for the $70 strike price is $70.95. The 95 cents comes from the $95 premium divided by 100. If you like the way that looks, just hit sell on the app and you're good to go. Now, $95 in this case isn't a ton of money because it's very low risk for you. A share price of $70 for MetLife is almost 10% higher than the current share price at around 66 bucks. So it's not super likely to break $70. And even if it does, it's not really that big of a deal because you'll still get that nearly 10% gain plus the premium fee. So let's look at a riskier, higher paying option. Going back to the main options page, we again see the current price is $66. A much riskier bet would be to say we think the share price will be significantly lower than $66 32 days from now. Let's say we really think the price is going to fall in this company and we want to sell an option at $55. So we're going to click the call option at $55, which brings us to the contract page. Then click sell, and we can see the premium passive income here is much, much higher at $1,130 for the exact same amount of shares. That's because we're taking on much, much more risk. If the current share price of $66 stays the same for 32 days with this contract, when it expires, we'll be forced to sell our shares at just $55, a loss of $11 per share. Not good. Here it is charted out. You can see you're losing profit from your premium at any price above $55, and your money turns negative when the share price passes just $66.30. So unless you really, really think price is going to collapse, it's much safer to choose a covered call price above the current share price, like that $70 option. That way you can just collect the passive income premium with relatively low risk, and you don't have to stress and you'll get good sleep at night. Again, all of these examples are being done on Webull, which is linked down below. Okay, so now that we've covered calls, get it. Let's talk about buying put options. Remember, if you buy a put option, you are betting that the price will go down. Practicing this can be a great strategy because you can earn massive profit while your downside is limited once again to that premium fee. Going back to Bitcoin, the current price is $30,000. Strike price, $35K. We're paying a $500 premium fee. If Bitcoin goes down to $20K, we profit $15,000 minus the $500 premium. If Bitcoin goes up to $35,000 or $50,000 or literally to the moon, the most we lose is still $500, aka the premium! Real world example, this is super important. Let's say you think Apple stock is going to decrease in the next few days. Instead of shorting the stock, you could buy a put because again, the most you can lose is that premium fee. On Webull, we're going to search for Apple stock. Go to options, and we'll leave it on 4D, which means contracts expiring in 4 days. The current price is around $142 per share, but we think it's going to drop to the 130s. That means we can buy a put and profit if we're right. I'm going to click on the $139 contract on the right-hand side under puts. Here we can see the premium fee is $116. That's how much we'd need to pay for the right to profit off Apple shares declining in price. Putting this on a chart, we can see the current price is $142. The strike price is $139, which means anything under $139 is when you start earning your $116 premium fee back. Your break-even point is $137.84. If Apple falls to anything less than that when the contract expires in 4 days, you've made an excellent trade. Great work. You figure out your break-even point by taking the premium fee divided by 100 and subtracting that from the strike price. If you're new to options, I highly recommend drawing out these little charts before making any purchases because it makes it so much easier to understand what needs to happen in order to make money and the circumstances in which you lose money. And again, in this example, you're betting on Apple going down. But if you're wrong and Apple goes up in price or stays the same, you simply lose your $116 premium fee. Selling a put option is the opposite. You are betting the price of an asset will rise and selling that bet to someone who thinks it will fall. The most you can make when selling a put is the premium fee. The most you can lose is quite high, the total price of the asset. Back to the example. Current price is $30K, strike price $35K. We're receiving a $500 premium fee. If Bitcoin goes to $35,000 or anything higher, you will simply collect your premium fee and be on your way. If Bitcoin drops to say $20,000, you will lose $14,500, which is the $35,000 strike price minus the current price of $20,000 plus the $500 premium fee. Let's do another example to really massage this into your brain. You now think that Apple stock is going to take off because you just heard a rumor. You just heard that their new virtual reality headset is so good it can trick you into thinking that you have friends. You're bullish and lonely, but you're mostly bullish. So you're selling a put. To do that, go on Webull, go to markets, and then search for Apple stock. Select options, collapse the date menu by pressing where it says 4D. Again, all of these rows are various contract expiration dates. Let's go with 18D. 18 days out for these contracts before they expire. And remember, this is a put, so we're looking on the right-hand side of the screen. And we think the price is going to go up. It's going to go up from that current price of $142. $145 looks good, so we click on that on the put side. Switch it to sell, and we scroll down to see a premium credit of $680. That's how much we would receive in profit as long as Apple shares are any price above $145 18 days from now when this contract closes. Looking at it on a chart, we can see the current price is $142, so we're not in full profit yet. And we can see the line goes flat on the top. That's because the most we can possibly make when selling a put is the premium fee. The most we can lose when selling a put is a lot. In this instance, we start losing money as soon as the share price hits $138.20. We get that number by taking the strike price and subtracting the $680 premium fee credit divided by 100, because a contract is 100 shares. So a $145 strike price minus $6.80, which equals a break-even share price of $138.20. Now again, this is a great strategy to understand, but please be careful when selling a put because of that downside risk. Now, hopefully you're still with me. If you're not, there's no shame in going back and watching the last 10 minutes again. I actually recommend it just to really firm up what's going on in your brain right now. I spent hours and hours staring at graphs in order to understand this stuff. I mean, I had to think of turning letters into arrows, for God's sake. And you might be wondering, are options even worth the hassle? You're damn right they are. Once you really understand options, you can do all sorts of cool things, including making passive income and even take strategies to protect your portfolio. These are great ways of making money if you know what you're doing. The first advantage I want to mention is leverage. Options multiply the power of your money. Let's go back to the Bitcoin example. You could buy one Bitcoin at $30,000 and hope for the price to increase, but this would cost you $30,000 to own the asset. Or you could pay the much smaller premium for buying a call option, which sneakily has the exact same profit potential. I know which one makes more sense for me. For a relatively small outlay, you can massively multiply your cash. It also keeps you safe from market crashes. Say you've got an option to buy Apple stock, and then every single iPhone on the planet bursts into flames. For some Apple users, sadly, they'd still want one, but for most, it'd be disastrous. The stock price would plummet, everyone would want to sell, and no one would want to buy. But since you only have an option to buy the stock, not the actual stock, you're protected. There's a heck of a difference between owning 100 Apple shares and having the option to buy 100 of them in this situation. With options, you just walk away if there's bad news in the market. You've got way more flexibility. Now, I mentioned earlier that there's a secret workaround on crypto options for US users. I'll have them linked down below if you want to try them out. But this
This works the same way as options, except it's a bit more user-friendly, to be honest. In this example, you're essentially saying, I'm happy to buy Bitcoin at $27,000. This is a version of buying a short put. If it indeed goes below $27,000 when the contract closes, I will receive Bitcoin at the $27,000 price, plus the premium settlement fee, which in this case is 0.05%. That's the one-day return. If the price stays above $27,000, I will buy no Bitcoin and just receive the premium fee in USDT. Then I can just do this again and again and keep on collecting fees until the contract settles. The reason for the settlement fee is I'm taking on a little bit of risk. So let's say Bitcoin falls to $26,000 when the contract closes. This means I'm buying $26,000 Bitcoin for $27,000. You're not exactly losing money, but you are getting a worse trade. On the flip side of this, you can put up Bitcoin and earn a premium if you think that Bitcoin won't likely rise, essentially selling a covered call. What this is saying is I hold some Bitcoin that I'm okay with selling at $30,000. However, I don't really believe that it'll go to $30,000 in a day. If it does stay below 30, I will keep my Bitcoin and collect a nice 0.37% fee in one day, which is 200% annualized. If the contract settles above 30K, I will sell my Bitcoin for 30 and still collect the same fee. The risk here is if Bitcoin goes to 31K or higher, I need to sell for 30. So this can be a way to both hedge your portfolio and earn passive income, and the strategy really can be as risky or as safe as you like. Again, kind of like healthcare. Let's quickly cover the downsides to options because, of course, nothing is perfect in life. Other than my incredibly perfect fans who would love to take this opportunity to hit the subscribe button down below. The main thing I want to mention here is premium costs. Be wary of them.
Premium, dude!
The premium can get quite expensive, eating away at your profits, and the price of that depends on three things. First, the expected volatility. The greater the expected volatility, the higher the premium. This is why crypto premiums are often more expensive than stocks. Second, the length of time. The more time you want to give the price to change, the more you have to pay, and this makes sense because there's just more time for that price to be hit. And third, the smaller the difference between the spot price and the strike price, the higher the premium. Again, because it's more likely to occur if that difference is small. And again, if you don't exercise an option at all, then it's money down the drain. So this strategy can take a little getting used to. Start small, and once you get the basics down, this is a skill that you can take with you for life to earn passive income and really leverage your investment dollars. So let's just finally dunk your head underwater, and congratulations, you've been officially baptized into the exciting world of options trading. Again, if you're looking to learn more in-depth strategies regarding options and investing, check out our members-only group, FINOVA, linked in the description below. There you'll find stock and options coaches, crypto coaches, trade signals, buy alerts, and much, much more. It's a must join.
This trader makes over $99,000 per year trading crypto, and I'm going to show you the simple way he does it.
From these strategies, I got to the point where I'm earning between $16,000 and $30,000 per month. And I'm a very conservative trader. So it's very achievable for you guys to be able to earn $99,000 per year just by following these simple steps.
In this video, you're going to learn first, the big picture approach to trading that easily and safely grows your money. Second, the two most effective strategies that you can learn today. Third, the free tools that Kyle uses to trade every single day. And fourth, the exact strategy Kyle recommends to make $99,000 or more per year trading crypto, including the coins that he'd use to do it. There's an equation to make this happen, but good news is it's extremely simple. Here it is. The key to $99,000 per year. We're going to reveal each part of this equation piece by piece through this video. But before you can zoom in, you have to zoom out.
It is very realistic to make $99,000 per year as a trader if you follow these three principles. 1, follow testable rules that give you data that you can learn from. 2, use smart risk management that keeps you safe. And 3, compound your returns over time to reach your financial goal.
Now, you need to understand this part or nothing that follows is going to make sense. If you don't know what compounding is where you trade small portions of your overall pot to gain small profits, and then you reinvest those profits to grow your overall pot. Compounding is also the first piece of our equation.
I really want you to understand that these three principles will literally allow you to predict how quickly it will take for you to get to your financial goals. For example, if you were to start with a $1,000 account, risking to lose 1% to gain 2%, and you accomplished a 60% win rate with the rules that you've given yourself, you can grow your account from $1,000 to $50,000 in just 330 trades and it only grows from there. And that's where the patience piece comes in, because with $1,000 account, you're going to be risking to lose $10 to gain $20. But once you get to 50,000, you are going to be at the point where you're risking to lose $500 to gain $1,000. So your stop loss budget and your income scales as you compound your account. Let's first look at principle number 1, following testable rules. There are some trading indicators that you can compile together to make rules and earn a reliable trading income. But I'm going to go over a Bollinger Band strategy that has 3 indicators that you can build rules around that are very simple to follow. Indicator number 1 is the Bollinger Band indicator. Indicator number 2 is the money flow index. And lastly, indicator number 3 is the 500 EMA. I'll show you the rules for these indicators in action in a second, but I really first want you to understand how important it is to follow these rules. You can use a website called TradingView and go on replay mode. And what replay mode allows you to do is backtest these rules, and you will be able to see how many trades on average with the rules that you've given yourself in a week or in a month or in a year, exactly how many trades you're going to do. And that's going to allow you to predict what kind of income you can expect with the rules that you follow. And I share all of my rules on FINOVA, so whether they're mine or someone else's or the ones you're trying to make for yourself. If you're trying to earn $99,000 per year, then you have to be analyzing the rules on TradingView. It's the only way you're going to be able to know if you're going to be right or wrong in a percentage-based figure in a live trading environment. So just allow your account to compound, be extremely patient. Don't forget that I've started with $26 and now I'm trading with a short-term account. It's like a scalping-based strategy account of $100,000, and I have a long-form trading account of 2.7 million. So it just takes basically patience and basic math, and you can also accelerate your growth by using leverage.
Now, leverage. If you don't know what it is, this is where you borrow money or capital to increase your potential return. So with 2x leverage, a successful trade will double your return. So if you were actually going to make a 10% return, you're now making a 20% return with the same amount of money. However, leverage works in both ways. If you get it wrong, your losses are also doubled. This is why Kyle and I recommend that you only ever use small amounts of leverage, and you only even consider leverage after you have established your emotional resilience to trading with no leverage. You must master no leverage first before you get into leverage, and that reveals the next piece of the equation. So now we can see compounding small leverage profits plus blank equals our goal of $99,000 per year. Now I'm going to reveal the next part of the equation in a second, but first, full disclosure, we follow this exact strategy over on my crypto research and signals platform, FINOVA, and we are getting wonderful results just like this. At FINOVA, we have been working closely with Kyle's business for a few years now, and it was immediately evident that Kyle is a genius crypto researcher and trader. And because of that, we actually just recently acquired his entire research business, enabling him to come on board to FINOVA full-time as our head of research. There he shares his trades in real time, so any member can copy his results and understand why he made those actions. Here's our members getting in on it. Every day we're seeing these kinds of results. And right now, with the market activity and energy flowing into crypto, there's never been a better time to get involved. But just a warning, if you are interested, make sure you join ASAP as we sell out of spots every week. So hit the link below and join before they sell out if you're interested. Now, 2 strategies for $99,000 a year trading crypto. There's 2 main methods for building up your account and getting you consistently winning.
Trend-based strategies allow you to capture the largest moves in the market. What trend basically means is the perceived direction of the market. So, for example, if we're in an uptrend, the price is going up. If we're in a downtrend, the price is going down. So to use a strategy like this, what you're doing is you're preparing yourself with a set of rules telling you that we're about to go into an uptrend or a downtrend, so you can make money along the way up or along the way down. And you'll have yourself a set of exit condition rules telling you when it's time to get out. But there is downsides to strategies like this. The downside is markets are super volatile, so you got to make sure you know how to place your stop losses correctly. and they don't trend very often. Actually, they only trend about 20% of the time, and 80% of the time we're ranging. If you want to give yourself a more reliable sense of income, people tend to turn to range trading strategies. As a beginner looking to earn $99,000 or more per year, I would recommend you to stick with a range-based trading strategy for multiple reasons. Like, one reason is the fact that the market ranges 80% of the time. So you're going to give yourself much more opportunity to learn and develop as a trader. And if you stick with the higher market cap assets like Bitcoin or Ethereum, you'll find that your win rate is much higher as well with those kind of assets to practice with, because it takes much more money to influence the price of those assets. So the indicator rules that I was talking about before, the indicators you're going to need to follow the rules are the Bollinger Bands, the 500 EMA, and the money flow index. So here's what it looks like.
Now this is the most crucial part, bringing everything together. Here's the exact strategy you can use to make $99,000 or more per year. The equation is simple. Compounding small leverage profits plus range trading. That equals $99,000 per year or $8,000 per month profit. Here's Kyle showing you exactly how to range trade, click by click.
Okay, so right now we're looking at Bitcoin on the 1 hour time frame. So when I did my back testing with these set of rules to see how well they would perform, I got myself a relatively high win rate. So I do recommend trying not to veer away from this time frame. The 1 hour time frame is the most profitable one that I was able to back test. When I followed these set of rules on multiple time frames, like the 5 minute, the 15 minute, the 4 hour time frame, the daily, the 1 hour gave the most profitability, and it gave me the most opportunities as well. So I stick with the 1 hour. Consider that a form of rule as well. When you are building rules around your strategies, time frames are incredibly important. Next rule is the Bollinger Bands. You're seeing that right now on my screen as this weird green looking blob on my screen right now. Now, when it comes to setting up the Bollinger Band indicator, you want to go over here under the indicators tab on tradingview.com. Okay, and then you're going to search up the word Bollinger Band, and there's a bunch of different ones, but all we're really aiming to do is just grab the basic Bollinger Band indicator. And when you have it added to your chart, you want to click on this little arrow tab on the top left hand side over here. Okay, and that arrow allows you to adjust the settings of the indicator. So we're going to go over where it says BB, and we're going to click on the little gear icon, and it's going to pull up this little field. Now, when I did my testings with the Bollinger Band strategy, I found that the 50 length gave the most accurate readings and preparing for a reversal. So you have to adjust the length to 50, and then everything else can stick to default. Okay, and how I change the colors, you just go over here to style, and you can adjust all that if you prefer to. If not, it doesn't matter. It's just colors. We got the Bollinger Band indicator up there, and now we're going to add the EMA. The EMA is this white line you're seeing right here on our screen. I use this as a way with the rules of this strategy to control our bias, meaning if price is below the EMA, we're only going to be focusing on shorts. We're going to ignore any of the other rules that tell us that we might be preparing for a long. Even if things seem okay, just ignore the fact that it might be positioned for a long while we're below this 500 EMA. And the opposite's true for when price is above it. You prepare for longs rather than shorts when price is above the 500 EMA. How you find the 500 EMA? It's very simple. You just type EMA, and you will find exponential moving average, or moving average exponential, sorry. And I recommend favoriting all these indicators as well, so it's a lot easier for you to find, because when you type it in these fields, it always appears at the top here. So you click on that, and you'll notice when you click on it, this little blue line appears on your screen instead of this white one. So how I modified it to look like this and behave like this is I basically just double click on it, or the same way we did before with the arrow down below. You just go to the gear icon and you can make your adjustments there. Okay, and then you can adjust the color of the EMA as well. You can be white just like mine, or you can leave it blue, which is default. It doesn't matter, it's just a color. So it's all based on your own personal preference. You're gonna find that when you're building your own strategy, it's almost like making your own art form. So go over to inputs after you're done with the EMA, and you're gonna change the length from 9 to 500, and then it will match what you're seeing right here, okay? And then lastly, we just need to add the MFI, which stands for the Money Flow Index, which is also similar to the EMA, where it compiles data based on moving averages to give you an idea of when the market's going to be exhausted or overbought. So we're going to go up to indicators, and we're going to type MFI, and you'll see Money Flow Index. That's the one you want to favorite, and that's the one you want to add to your chart. And you can leave it as default. So it's simple, and you don't have to make any changes to how this indicator works. So now let's go over, now that we have all the indicators on our screen, let's go over how the rules work for this strategy. We're first going to be going over when it's appropriate to enter a short or to sell an asset and where our target is going to be, okay? So first thing we're going to go over is the Bollinger Bands right here. When price gets outside of the Bollinger Bands, that's when you're preparing to enter a trade, okay? Right here. Now, since we're focusing on shorts, we're going to look at when price escapes the Bollinger Bands to the upside. So when it escapes, this does not mean enter a short, but what it does mean, we're going to prepare for a short when we have our first hourly candle close back inside of the Bollinger Bands. And this is a move that just happened very recently, okay? This was about, let's see, Wednesday, the 10th of July. And we had price come up, and we got that price acceptance back inside when the candle closed back inside the Bollinger Bands. So this is one of our rules to enter a short. And then the other rule for knowing when we're going to be entering shorts is the EMA, like we talked about before, okay? So we had the EMA is telling us our bias. We should only focus on shorts when the price is below it, okay? So the price is currently below the EMA, so that's one rule that is telling us that we can enter a short. And then the last rule is just right here. We can see that we are overbought on the MFI. So overbought territory is between 70, the 70 level. When you hover your mouse over top of the MFI, you'll notice that there's numbers that will appear on the right-hand side. And the right-hand side will show you that right now we're above the 70 level, and we dipped above the 80 as well. So here we got this rule met, we've got this rule met, and we got this rule met. So that means we can enter a short. Now, the target for this strategy is actually very simple to follow as well. This orange line right here. This is the center moving average of the Bollinger Band. This tends to act as a form of support and resistance. So to avoid, especially beginners, staying in their trade too long and have it bounce and come up and then end up getting you stopped out, we just prepare to exit wherever the Bollinger Band center moving average is, this orange line. Okay, and we put our entry here on our short. We put our stop loss above the most recent high. And then we target the center moving average. And a good rule of thumb as well is if you find, even if the entry conditions are met, if it says, okay, we are preparing for a short, all the rules are met, this doesn't mean you should enter the trade. And the reason why I say that is because if you find when you use your short or long position tool on the TradingView website, and it doesn't say the number 2 or higher, that means you could have inconsistencies with your profitability. You want that to be a number 2 or higher, so you're aiming to gain 2 times more than what you're trying to lose. And that will allow you to be consistently profitable even if you only have like a 35% win rate, okay? You'll be at break even at 35%. Anything above 35% is profitable. So let's play this out because I'm in replay mode right now and see if this hits the target, okay? We're gonna play this out a little bit. And in this example, it hit the target, okay? And you might be able to learn new stuff in the future to tell you that you can stay in your trade longer, but this is a very beginner-friendly approach with a high win rate strategy to allow you to get in and out of a trade relatively quickly and capture quick gains. So we had price action dip out here, but we can see that with our longs, what we're looking for is the MFI level to be at, basically, there's this 20 levels at the bottom, and then the 30 level is also like an oversold territory. If we're at the oversold territory, then we can prepare for a long. If we are seeing price action above the EMA, our bias is long, so we could focus on long positions. And once, all we got to do after that is just make sure that we have a candle close back above it right here. And we have the candle close back inside the Bollinger Band, so then we can target here. And then we'll be in and out of our position relatively quick, having our stop loss here, our target here. Okay, so with this strategy, it has a very high % win rate. Most people have a 70 to 90% win rate with this strategy. My 9-year-old son, Jaden, he actually has an 80% win rate with this strategy just by sticking with the stop loss right below the price action. Okay, so just prepare yourself mentally that you cannot win them all, but sticking with the rules, you know what your statistical edge is and what the probability is of being right is, okay?
Now listen, I cannot stress enough how important it is to only risk small amounts and compound over time. Focus on growing that 1% of your portfolio. Don't focus on just smashing big wins straight away. This is for your own financial safety. This is for your ability to trade intelligently over time. This is for your ability to trade tomorrow. Don't lose all your money today.
Trading for beginners can seem complicated, even scary. I mean, it's high risk and make you lose thousands of dollars, but if you know what you're doing, you can also make thousands of dollars consistently. To help you do this, I'm going to show you a few things: how trading works and the one mistake you must avoid, the technical side of trading, how to mitigate risk and get out of a bad trade, and how to trade an asset using all of the above to make your first $1,000. This means you'll know exactly how to make a trade, and then you can even make your first one right alongside me. Ready? Trading is like investing, but supercharged. With investing, you buy and hold an asset like a stock or a currency for a long time, and you hope to make a large gain. In trading, you buy and sell assets over shorter intervals for smaller gains each and every time. A trader usually executes multiple trades per day, hence the term day trading. The goal of day trading is to take advantage of market fluctuations and human psychology to make a quick profit. You identify a small opportunity, get in, grab it, and leave before the door closes. Basically, if you think the price is going to go up, you buy an asset with $2,000 and then sell when your stack goes up to $3,000, and boom, you just made $1,000 in profit in a few minutes. In day trading, you'll be spending a whole lot of time looking at this. And if you're confused, you should be, because there's stuff going all over the place, up and down, but don't worry, I'm going to explain this to you later. Right now, though, I want you to take note of how wild and frequent the fluctuations in price are. This tells you one major thing. Day trading is high risk. Just as you can make money quickly, you can also lose money. Your goal in trading is to make small profits where you can, while minimizing losses. That is the most important part. Anyone can make a wild bet and just hope for the best. I'm going to teach you how to consistently make calculated, smart bets. There are a ton of ways that you can do this, many of which I'll dive into later, but one of the most common is looking for signs that suggest an asset is going to move in price. For example, let's say Saudi Arabia just declared that it's run out of oil. That's bad, but this will likely affect the price of oil. A skilled trader would see that, enter a position quickly, make a profit, and then get out. The less risky the opportunity, the better it is for you as a trader. The biggest trading mistake you can possibly make, which will lose you potentially hundreds, thousands, or even hundreds of thousands of dollars, is this: you let your emotions influence your trades. It doesn't matter how much you feel a trade is right, or how hyped your friend or the market is about a specific trade. That doesn't matter.
It doesn't matter!
If your trade is driven by emotions on any level, abort. Do not pass go. Get out of that trade. You must have a clear, rational trading plan that minimizes risk and makes logical sense. That's it. Emotions have nothing to do with this. If you're an overly emotional person and you feel like, oh, maybe trading's not for me, I don't know, maybe it's not for you. But if you're like, I think I got a good grasp on this, then continue watching the video. Now, yeah, there are other mistakes that you don't want to make, like making too many trades trying to chase profit, not managing your risk, or not diversifying your trades across different assets and markets. But for now, the single biggest mistake to avoid, one that will lose you money, is getting emotional. Save that for the movies.
You were my brother, Anakin!
There's no best time to trade. People will tell you all kinds of theories, but really, the only real best time to trade is when the market is most volatile and has the highest amount of liquidity. This will allow you to enter and exit trades with the most ease, which you want as a trader. And sure, some assets will have the most liquidity when the US and European markets are open and in session. But if that doesn't fit with your individual schedule, then maybe that's not the best time for you individually. That's important. What are you up to? You have a life, you have a job, you're a beginner at this. This trading thing is probably going to be a side hustle at first. It has to be sustainable and work for you. So in short, there's no secret. And I'd recommend you experiment with which time works the best for you and your trading schedule. There are a bunch of key terms that you want to know so that day trading lingo doesn't sound like this. And to save this video from being like a series of definitions, I'm just going to put them all on screen right now so you can pause this and return here whenever you want. Now let's move on to the good stuff. I know, trading can look super confusing, but the process of making a day trade is actually really simple, and I want you to know this up front. So even though I'm gonna do a full walkthrough at the end, take a look at me doing a quick trade. Go to your favorite trading app. My favorite for trading stocks is Webull. They're actually offering 12 free stocks right now for signing up. I'll leave them linked in the description, so check that out. And don't worry, we're also gonna cover crypto trading as well later on this video, but for stocks, sign up, fund your account, click the markets tab on the bottom, type in the ticker symbol that you're trying to trade. I'm going to go with Tesla. Click trade. Now we're going to do a simple market order for $100 and done. It's that easy. Now when you want to sell, simply click trade again, then the sell tab, make sure everything looks good, and boom, you're done. Now, I did that just to familiarize you with how simple the mechanics are of executing a trade. I'll show you how to do this in more detail in a bit. There are a whole lot of trading platforms, so do your homework here, but for me, I like Webull for stocks and I'm currently using Bybit for cryptos. Bybit will also be linked down below with an awesome cash bonus of potentially thousands of dollars for signing up. I'm actually currently using Bybit for a trading challenge on our membership site FINOVA, and it's been great. There I'm attempting to turn $100 into $10,000 only through trading. I started this challenge just a little while ago, and I'm making small, safe profits like this 4% gain. And we have other coaches making profits all the time like this 27% gain and this 12% profit that turned into 25% in a single day. If you were on FINOVA, you would have had access to all of those trades in real time. Plus, we have live coaching calls to cover all of this stuff in greater detail. And we just launched a year-long full-time traders course that takes newbies and trains them step by step on how to earn a living from trading, all for an extremely affordable price. I am so extremely proud of this community. So if you want even more hands-on help, definitely join FINOVA below. Trading is quick and volatile, which means it can be high risk. And while we all have different levels of risk tolerance, I would recommend only risking 1 to 2% of your entire account balance on any one trade. This will help protect you from large losses. Even for my tiny $100 trading challenge, which is far smaller than my total account balance, I started by trading just 10% of that $100 to limit risk, so I didn't just get wiped out on a bad trade. Once that grows to around $1,000, I'll only use 1 to 3% of the balance for my trades. You have to be safe. What I'm trying to say is if you have a $10,000 account, you shouldn't be risking more than $100 to $200 on any one trade. That's important. There are way more ways to manage risk beyond that, such as trailing stop losses, which we'll cover later. But for now, just remember that 1% to 2% rule, because it will protect you, not if, when disaster strikes. Technical analysis is a tool that helps you become a more well-rounded trader. That said, as with anything in trading, it cannot predict the future. Nothing can, no matter what fortune tellers try to tell you. And of course, we have to do the obligatory, this video is not financial advice. And now that the lawyers are satisfied, technical analysis is doing your homework on a trade, making sure it's not a scam, seeing how traders are engaging with the asset, and using tools to give you more information to make the best trade possible. This all helps us estimate whether the trends that are happening right now, also known as the price action, will continue in the future. To do this, you look at price movements and use indicators to suggest when may be a good time to buy or sell your asset. So how do you get started in technical analysis? The first is the candlestick chart. A candlestick chart is a snapshot of how prices are changing. For some reason, this looked like a candlestick to me. A red daily candle tells us that for the day, the asset closed at a loss. And you guessed it, a green candle tells us that the price went up. But even more important is to look at the opening and closing prices. If the candle is red, then the closing price is the bottom end of the candle, with the opening price at the top. The opposite is true for green candles. The bottom is the open price, and the top is the closing price for green candles. This tells us a lot about what the market is actually doing, especially considering you can set candles to show prices per minute, per hour, per day, really anything you wanted to set it to. But the detail doesn't stop here. There's also the wick. Slightly less cool wick. These ones. They tell us what the highest and lowest prices were for the time interval in which your candles were set. So if you have a 1-minute candle, then the top wick, that shows how high the price went within that minute. Change it to a 5-minute candle and the wick will change to show the price action within that 5-minute time frame. Wicks can extend well beyond the closing price of a candle, meaning the longer the wick, the more volatile the market actually is. And there's also specific meanings for red and green wicks. Long wicks at the bottom of red candles show that prices fell to what many considered to be the cheapest price within that interval. Naturally, people bought back in at that low price, driving the price back up. Sounds great, but remember, long wicks mean more volatility, so things can easily go the other way. Short wicks at the bottom of a red candle, this means traders may be continuing to sell, so proceed with caution. For a green candle, a long wick means the price significantly exceeded the closing price during that candle interval, meaning traders may have thought that this was the top and decided to sell in order to take their profits. Again, a long wick indicates volatility and may suggest the price will fall. A short wick at the top of a green candle is common when the price is at an all-time high. Some say that this is a good time to sell if you're looking to leave the position. A good time to buy, according to technical analysis, is to buy when there's a red candle with a long bottom wick and a short top wick. But guess what? Before you think any of that is easy, there are red candles that look like perfect buying opportunities only for the price to tumble afterwards, meaning you'd lose money. And this is because there's no tools in trading that can account for investor sentiment. There's nothing that can predict that news event that just broke, or investors freaking out about some Elon tweet. So you always have to proceed with caution. If anyone tries to tell you otherwise, if they try to say that they're future tellers or they know exactly what's going to happen in the market, they're probably trying to con you out of some amount of money. Candlesticks and wicks aren't the end-all be-all of technical analysis. There's also trend lines. Trend lines are the practice of finding the overall movement in price, otherwise known as the trend. Now, many exchanges will have automatically generated trend lines that you can look at, but you can also create them yourself, connecting from the bottom of one candlestick to another. With enough points, you can project your trend line into the future to help you determine where the price may be headed. That said, you're going to want to compare multiple trend lines to get a better picture to help draw conclusions from. Support and resistance lines are horizontal lines that you can draw onto your price chart as well. Support shows the lowest price at which investors are willing to buy that asset, typically when there's the highest demand. If it's continually bouncing off of a specific price, that's its support. Resistance is the highest price at which investors stop buying and start selling instead. You can build your trading strategy around these points because there's a lot of action in between those points and they're pretty predictable. When lots of traders start doing this, you enter a situation called trading sideways. Trading sideways looks like this, and it means the price isn't changing that much over a period of time. For example, take a look at this chart, but the fun doesn't stop there. Formations show you the typical direction an asset is headed. Here are some popular ones that you may see referenced. This pattern could be referred to as a wedge pattern. If the trend lines had connected, it would be a pennant pattern. Flag patterns are two parallel trend lines that can head up, down, or sideways. A cup and handle pattern is when the price increase has paused. The bowl shape is then followed by what looks like a pennant chart pattern. This may indicate a further breakout in price. A head and shoulders trend following an increase in price may indicate the price will decrease. A reverse head and shoulders trend following a decrease in price may indicate the price will increase. Now, it's important to note that humans love finding patterns in all kinds of things, and there are a million different chart patterns that can mean a million different things, but this doesn't mean that that expectation will always come true. Again, this just helps paint a more clear picture, but doesn't tell you the future. Using these to your advantage can be tricky. If you're a beginner, it's likely that you'll make a huge mistake, and let me explain. This image shows a price appearing to break through a formation. This is when most new traders will buy. But this is a mistake. The yellow circle is the moment this asset broke out of the formation, and it looks like it's headed for a trader's ideal price target. But this is the wrong time to buy, because this is where you need to be patient and wait for what's called the confirmation bounce, which is the green circle. The price bounces off of our resistance line and indicates the best moment to enter the trade. If it bounces to the upside, you enter a long position. If it bounces to the downside, you enter a short position. But not all trades are created equally, and to see why, you need to look at trading volume. Trading volume is the total dollar amount of assets that are bought and sold within a specific time frame. Higher trading volume generally indicates higher interest in a particular asset. Lower trading, the reverse, lower interest. When you combine this with trends, you get more information about how strong that trend actually is. Basically, the more money, aka trading volume, behind a trend,
8,000? No, this is impossible!
the more powerful it is. For example, two trends might look the same on a candlestick chart, but if one had $1 million in trading volume and the other had 10 million in volume, then the latter is a much, much stronger trend. Here's a tactic that you can use to help profit with this information. Monitor trading volume of an asset on days when the price went up and days when the price went down. If the volume is higher on positive days, this tells us that there's a potential for the asset to continue trending upwards in the future. This kind of information can help you know when to actually enter a trade, but when do you exit one? This may be the most important piece of trading, because if you're a beginner, you'll be trading spot and not using leverage. In essence, this means you'll be using your own money in your trades rather than taking on debt to trade even more. So when do you exit your trade? Well, if you're just trading 1 to 2% of your own money, you won't have enormous losses at stake, which is great. This gives you a bit more leeway on when you can exit, and you'll be far less emotional about those decisions. Remember, keeping those emotions as low as possible, it's such a major key. But here's the exit strategy. First, you want to have a profit target. This will give you a clear price level that you want to hit. It's super important to always go into a trade with a specific plan. Going back to that screenshot from the 27% profit trade, you can see that it says target 3 hit. That's because this coach always has multiple layers of target prices that he uses as stages where he can safely exit the trade. This is so extremely important, and you can even automate it using a stop loss order. This will sell for you once the price reaches a certain level, helping you to limit losses and helping keep those emotions
down and away. Here's where you can set them up on Bybit. However, a stop loss can sometimes limit your profits. Let's say your stop loss sells, but then the asset keeps on going up in price afterwards. You could be missing out on some serious, super profitable trades. Because of that, you can also use a trailing stop loss. This is a dynamic stop loss order that adjusts to the market price as it moves in the direction that you want. So here's an example. Let's say you enter in a position at $1,000 and set a trailing stop loss of 10%. That means the stop price will be set at $900. But if the market keeps going up to, let's say, $1,100, the stop loss will then adjust to $1,000. So it's always 10% below the peak price, meaning you can only ever lose 10% from the highest market price. If you're trading a short position, this would be the same, but in reverse, with your trailing stop loss above the market price rather than below it. Here's a trailing stop on Webull for trading stocks. They make it super simple. Change the order type, and then you choose a percentage or a dollar amount that you want to go with. Let's go with percent and 5%. This means the app will automatically sell if the asset drops 5% from current levels, meaning if it goes up, we'll net new profit. If it goes down, we can only ever lose 5%. So a trailing stop loss can protect your profits while allowing you to gain much more potential upside. That's huge, but you still need to mitigate risk. There are a bunch of ways to lower your risk in trading. We've talked about a few of them already: stop loss orders, trailing stop loss orders. We've also gone through the big one, not getting emotional. Again, no matter how much you feel the price is going to go up or down or any particular direction, you must ignore that and stick to whatever your trading plan is. Please keep the emotions down. If you learn one thing, that's it. But on top of that, you can also look at two different things. The first is market cap. If you're trading a crypto or stock, this is where you multiply the current price by the number of shares or coins in the market. The larger the number, the less volatile the asset should be, simply because it takes more money to move a larger asset. The next tool you can look at is the RSI, the Relative Strength Index. This is a figure displayed as a number between 0 and 100. The RSI measures the strength of an asset. It compares recent gains to recent losses to see whether the asset is overbought or oversold. More simply, when the RSI is over about 70, that's typically considered overbought. Below 30, it's considered oversold. And you can view it on an oscillator graph. Okay, but how can you use it? The first is for trade signals. If an asset is overbought, you could take this as a sign to sell. If the asset is oversold, this could mean there's a price increase right around the corner. Divergences between the RSI and the market price could also suggest that a trend is about to reverse. Likewise, if the RSI is rising alongside the price, it could suggest that a trend is quite strong. In general, the more tools that you master and utilize, the more you'll be able to mitigate risk on your trades. So let's do some actual trades. We're going to do a stock, then a crypto trade. The mechanics are very similar for each, but for stocks, you're going to want to make an account with Webull linked in the description. Get your free stocks, then find an asset to trade. We're going to check out ticker symbol AUR. But before we buy, we're going to set up some trend lines. We're going to do so on the top and the bottoms of the candles. We have kind of a descending wedge going on here with a support level at around $1.07. The price is currently at $1.25. We're going to use a limit order set at $1.25. A limit order means the trade will execute at that specific $1.25 price. Then after the order, we'll set up a trailing stop order at around $1.08, $1.07. We're looking for a target price of up around $1.40. After all looks good, we hit place order. After we place the order, that trade would then go down into either the working or the filled tabs. After we own the asset, we then go to the sell tab. This is where we set up the protection, and we change the order to a trailing stop order. Then we enter in the distance between our price action and the stop price that we're looking for. In this case, that would be 18 cents less, because the current price is $1.25, and 18 cents less than that will land us right around $1.07, $1.08, just below that support level. This again protects our downside in case we break
through that support level. Then we click place order to set that up just in case. And of course, as the price goes up, that trailing stop will follow that price upwards, protecting our downside and securing that profit. Now let's do a trade in crypto using some slightly different strategies. Here we are on Bybit. Again, you'll want to make an account below, fund your account, and then go up to the trade tab up top, and then go to spot trading. On the search bar, you can type in any crypto ticker symbol. But right now, we're going to check out the biggest movers in the last day and see if there's any action. This Apex coin has been doing quite well, so let's check it out. We're on the 5-minute chart right now, and remember that means each candle represents a 5-minute interval. We're going to go up to the Trading View tab, which gives us even more options on this chart. Click and drag that sidebar to help adjust things if you need a slightly different view, and then we're going to draw some trend lines. In order to do that, there's going to be a little icon in the bottom left. Click that to expand the menu, give you way more options. Then click the line icon and place it across the tops of the candles. Then add a trend line on the bottom. Our target price is around 37 cents, near the previous highs within this specific trend. That'd be around a 10% gain in profit. We're going to do a small market order, which means we're buying at the current market rate. Even if that market rate changes a little bit, we're still buying. Click buy, and now we're going to set up a stop loss. Now this trade has a decent risk of dropping below that trend line, so we're going to set up a really safe stop loss at 0.339, just below the bottom of that support level. This will help again protect our downside risk here. That way we don't get into a bad trade and lose like 20-30%. The most we can lose here is just a couple percent. Then you can view that pending stop loss on the tab below, and you can see at what price it'll execute if the price does end up dropping. And now we wait. But that's really it. That's trading for beginners. You've got more to learn, but now you know the basics to go ahead and get started. Subscribe. Why is this so sad? These 5 steps will help you retire in your 30s and ball out before you're too old to enjoy it, letting you quit your job for life. But you better get started quick. The earlier you start, the sooner you'll be able to retire. Don't let time fade away working jobs you hate. So step 1, to retire early, you need to start thinking of yourself as a small business, not some person who lives for the dopamine hit of the buy now button on Amazon. Which sucks, because man, does it feel good when that package arrives. But thinking of yourself as a small business will change your life. The first thing businesses do is they know exactly where their money is going, and they cut out inessential spending, which means you've got to do the same. But before you start turning yourself into an accountant, you need to prepare yourself for one thing that'll help with this transformation: delayed gratification. See, the more you spend, the more your brain enjoys it, pumping your system full of dopamine. This strengthens that harmful addictive habit of careless spending, keeping you trapped in that job you hate. But if you kick that habit, you can literally quit working forever. I'll explain exactly how later, but for now, focus on thinking about delayed gratification this way. The more you stop yourself from feeling good from spending in the short term, the more money you'll have in the long term. It's as if you've got this money counter ticking next to you. And to help illustrate, here's my friend Dan.
Hey. I'm
All right, Dan's gonna be doing a squat, and for every second he lasts, he's gonna get $1. Ready, set. All right, we'll check back in a second. On the expense tracking, there's dozens of apps for this. I use one called Personal Capital. It's free and does a good job tracking everything. I'll have them linked down below if you want to try them out. As soon as you start tracking every dollar for just 1 month, you'll get a punch in the gut, mentally, but it'll feel physical. I guarantee you'll be surprised about how much you spend. You don't even realize. Feeling strong?
I did legs this morning.
I got a deal for you. You're at 15 seconds. If you quit right now, I'll give you $100. What do you say?
No, I'm good.
Figured you'd say no, but part of me was like, is he just gonna take the $100 and be done?
Now, once you start tracking, you need to determine how much spending is on the essentials. This is the exact strategy used by an online community of people that help others retire early. I'll go into them and their secrets in a second, but first you need to focus on the stuff you absolutely need. Rent, bills, food, health insurance, minimum payments on any debt that you have to pay off. Add these monthly expenses up and multiply it by 12. This is your annual essential expenses. If you were a business, this would be your break-even point. How much money you need to make to start taking home some profit. It might seem weird to think of yourself as a business, but trust me, it's not that weird. A business takes in labor and money to produce stuff and take home profit. You take in food and money to produce labor and ideally take home profit. And how does a business grow into a larger, more successful business?
They track everything, eliminate waste, turn a profit, and reinvest into themselves. I'm sure you see what I'm getting at here. Are you ready to reinvest into yourself? If you're still here, then probably yes. Now comes the painful part. You have a picture of your spending. Now you need to ask yourself, what are the non-essentials? And the tough answer is pretty much anything that doesn't keep your heart beating or improve your work, provided you're comfortable with that level of frugality. But you need to be extreme if you want extreme results. I find the easiest way to do this is pretend you're looking at someone else's bills when marking what isn't essential. That'll help kind of take you out of the action. I've been here myself. I personally lived off past expiration food from this discount grocery store for years while I was trying to reinvest everything back into my businesses. And that seriously helped enable me to earn millions in my 20s. Now I live right by the beach in Puerto Rico, which is great when the weather's nice.
Dan, you're currently at 30 seconds. I have another deal. I'll give you 30 seconds rest, but your current money will cut in half. What do you say?
No, knowing you, I'm going to stick with it.
So what are some easier ways to cut spending? Well, I've got two. First is live at home, like with your parents, when possible. It's far from ideal, but if you can do it, you're cutting out rent payments, the most significant chunk of your paycheck. But the good news is you're not alone. 52% of young adults are doing it these days. Next, follow the stop flexing rule, which means stop flexing. If deep down you're buying something to flex how great you are, clothes, car, phone, 18th century samurai armor, don't do it. It's a huge money sink that you can use to reinvest instead and get closer to retirement. And let's be honest, no one gives a shit about your flexing. A much bigger flex is to be 30 and retired while everyone else is working paycheck to paycheck. So now you're thinking we go straight to investing, right? Well,
Knock, knock.
as Warren Buffett once said, there will be some incident. It could be tomorrow. At that time, you need cash. Cash at that time is like oxygen. When you don't need it, you don't notice it. When you do need it, it's the only thing you need. He couldn't be more right. While you want to save up as quickly as possible to retire early, you've got to realize that things can go bad fast. So get yourself an emergency fund like Warren Buffett. Save up a nice little nest egg of $20 billion. Okay. Not really, but you want 3 to 6 months of living expenses. This will cover your ass if you're unemployed, sick, your car breaks down, girlfriend steals your 18th century samurai armor that you shouldn't have bought in the first place, or you're looking to pivot into some new career.
Is life fair, or does it sometimes throw curveballs at you?
I think today I've been thrown a curveball. Thanks. If you make me tear my jorts, you're buying me a new pair.
Okay, you figured out your spending, cut it down, and got started with your emergency fund. Now you need to look at your freedom number. And no, I'm not talking about the number of times you can take your dick out in public. Freedom number is the total assets and investments you need to have locked in to live off of passively. To figure this out, take your annual expenses and multiply the total by 25. This is the 25x rule, and it'll tell you the amount you need to save. 25,000 times 25, you need 625K. 50,000 times 25, you need 1.25 million. 100,000 times 25, now you probably realize one thing. It's a lot of money no matter which you choose. But once you have it, you can use a little something that was discovered by 3 finance professors. It's called the 4% rule. This is where you withdraw 4% of your total investment each year to pay for your entire life. But the beauty is that because you save so much, your money keeps growing despite the payments to yourself, meaning you could live off that same stack of money forever.
I'd buy that for $1.
This is a rule of thumb, and inflation definitely plays a role, but as a general principle, it's pretty sound. For it to work though, you need the freedom number that you calculated based on your personal expenses. And to hit that number, you want to be saving as close to 70% of your income as possible, especially if you want to pull this off within a decade. It's not easy. It's probably the hardest thing you'll ever do, and that's why most people never do it. So I guess the question is, do you want to be most people? Going back to you being a small business, saving and investing is prioritizing long-term wealth over short-term cash flow. Cash flow means lifestyle creep, which generally means more pointless luxury. Wealth means your money grows with you and helps you retire early.
It might sound like a lot, but remember the alternative. Now, this doesn't mean you have to follow the rule to a T. Remember when I mentioned the community that helps people retire early? Well, they're called FIRE, which stands for Financial Independence Retire Early. And when it comes to how much you spend, there are different types of FIRE. Coast FIRE. It's where you save enough money to stop contributing to your savings and still reach FIRE in the future. Barista FIRE. This is where you have enough money to retire early, but you still work part-time for an income top-up and health insurance. Lean FIRE. This is where you live as frugally as possible and retire with a very tight budget. Traditional FIRE. This is where you accumulate 25 times your annual expenses and use the 4% rule to retire. Fat FIRE. This is where you retire early with more money and less frugality, living on a big fat nest egg. So you can choose which one makes the most sense, but regardless of which, you still need to invest. How do you invest in order to reach retirement as soon as possible? There's some pretty easy advice on this, and again, it comes from Warren Buffett. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. If you invested in a very low-cost index fund, where you don't put the money in at one time but average in over 10 years, you'll do better than 90% of people who start investing at the same time. And like most things Buffett says, he's right. Low-cost S&P 500 index funds have outperformed real estate and mutual funds, and they couldn't be easier to use. You just buy them and your money grows over time. They work by tracking the market. The market goes up, the index fund goes up. The market goes down, the index fund goes down. Instead of owning specific stocks, you own the entire market, which is about as diversified as it gets. Given how well it performs, this is going to be a great way for you to build your pool of investments over time, getting you closer to the point where you can withdraw 4% each year, paying for all of your monthly bills, maybe even more. By the way, if you're looking for the best app to buy stocks, here's one that I've been using for about 2 years, Webull. They let you do basically everything: buy stocks, get retirement accounts, fractional shares, options, anything you can think of. Plus, they're offering a deal right now, I just checked, where you get up to 12 stocks for free, just for joining and depositing some money. So if you want some free money, you want some good service, check them out, link down below. So here are some actionable steps for you right now. Pay off any high interest debts, like credit card debt. That cancels out any stock market return you could ever get, so take care of that first. Always focus on the highest interest debts first. Those eat you alive. Then invest in the S&P 500. Unless you have a 401k that offers a solid matching scheme, then do that first. That's basically free money if you have the option. Invest in an IRA. This will help you save money and cut tax at the same time. Keep an eye on your credit score. This isn't essential, but it'll come in handy later in life when you want to buy big things like houses. Oh, and also make sure you always reinvest dividends. You're in this for the long haul. But of all of these, paying off debt is the most important, so make sure you hit that first or it'll negate your stock market gains. Trust me, this is not a weight you want dragging you down.
All right, emergency over. No more wait. How long do you think you can go?
3 minutes. 2:59. My hands are asleep.
We need the Eye of the Tiger playing.
Come on. Hey Siri, play Eye of the Tiger.
You've probably realized that as much as you cut spending, increase savings, and invest wisely, your results are still highly impacted by your income. So how do you earn more? I mean, making more from your investments is great, but that's not going to help you in the short term. Only income streams are going to get you fast money. Your first is employment. And a good trick here is to look at whether you're getting paid for time or results. If your job is results-based, that position is simply way more valuable to your employer, as those results are directly related to them making money. Take sales. You make money because your employer is also making money. If you can make the shift to a results-based job, consider it, as you'll likely get paid much more. Beyond this, consider building another income stream, ideally one that's scalable. The easiest to get into is freelancing. If you have a skill, there are countless sites that allow you to market yourself and make some extra income on the side. However, if your gig revolves around you spending time on it, it's not going to be very scalable. So try to find something that has the possibility to delegate work out to others, or one that you can build now and reap rewards later without too much of your time.
When thinking of any side hustle, make sure you're playing to your interests and strengths. For example, I diversify my income streams into consulting on marketing, business, and content strategy, real estate. I own a moving and storage business. I have this YouTube channel, and I have an exclusive finance site called FINOVA. There I'm able to take the concepts that I introduce on YouTube and really put them under a microscope and teach much more in depth. We have live coaching every single day. We have exclusive research reports and a community of thousands of members helping each other and learning how to earn enough to dictate the direction of their own lives. That'll be linked down below with a 7-day free trial. The main idea here is a 5-step formula that works together. You delay gratification, track your spending, cut bad spending, save for emergencies and investments, put your money into proven funds, and then pursue more income over a period of years. The more you do each element, the more each element feeds into the others, shooting you like a rocket towards retirement. And it might sound difficult because it is. It's not for everyone. But if you can handle it, the math is on your side. What would you do if you could retire today? Would you travel the world, write a book, start that game-changing business you've always dreamed about? You could do anything. You could even subscribe to the channel down below. Where's all your blood?
Filling my jorts.
Filling my jorts.
There's something filling my jorts, and it's probably not blood. Hey, look, we're at 3
we beat
minutes.
3 minutes. Okay, we're coming up on $200 here.
What? You never mentioned anything about money.
Dude, it's $1 a second.
Oh, okay.
How don't you know this?
I wasn't listening.
You just wanted to do this? How do you feel?
I don't feel.
3 minutes and 30 seconds.
You should feel my leg, or not feel. You should feel the way my legs feel.
Stocks and the stock market for beginners. In this course, I'm going to take you from the very basics of what is a stock, what are dividends, and why companies have stock in the first place. And then by the end of this presentation, we're going to cover how to find good investments yourself, how to read financial statements yourself. It's really not that complicated if we start with the basics. You can do it. And how to pay as few taxes as possible legally on our stock market gains. So this course is perfect for anyone with beginner or intermediate knowledge of investing. Basically, if you're not an investment banker at Goldman Sachs yourself, I guarantee you will learn something new. And hey, if you don't learn something new, I will introduce you to my 100% money back guarantee. But good luck with that, because this entire course is 100% free. This whole project is actually a bit of an experiment, and you are my test subject. So YouTubers are generally opposed to creating very in-depth, nitty-gritty content for free for 2 major reasons. First, they make more money selling it. I estimate I'm giving up about $90,000 by posting this for free. But most importantly, number 2, people don't care. Most popular creators on YouTube feel people simply don't care about information unless they're paying for it. That's how you actually get someone's attention. So I'm going to pay really close attention to what the average watch time is on this course to test and see if YouTubers' assumptions are right. Do people care? So if you watch this for only a minute or 2 and then turn it off, I'll know that people indeed don't care unless they pay for content, and I'll have the answer to this grand experiment of mine. Now onto the course. This course has more than 50 sections to it. And I feel all the sections are important, but I've time-stamped all the major sections. So if you need to come back, or if you need to find a particular section, or if there's one area you're very curious about, you can do so quickly. Second, to help solidify the content, I have built a quiz that accompanies this entire presentation to test how much you've actually retained from it. Because what's important is how much you actually retain and you can take with you to the real world. So this quiz is built to be taken at the end, but you can do so alongside the presentation if you like an open book test. Whatever you want to do, whatever's the easiest way for you to learn, I'm totally open to it. And then third, I am really excited for you. I'm excited for you to watch this presentation and hear the feedback, because I spent around 50 dedicated hours, putting this together in the most simple, coherent way possible. I don't think that there's anything else like this. And I even went so far as building all of the charts and drawing all of the illustrations in this entire presentation myself. So I'm pretty excited about this. So grab some free stocks. Also, before we get started, there are various offers linked down in the description for free stocks with Webull, Robinhood, and M1 Finance. Feel free to utilize those if you like. And if you do so, those companies will send me a free stock too as a thank you for sending you their way. Without further ado, let's get into it. And here we are, Stock Markets for Beginners, a free course for Neandernauts. If you aren't sure of who Neandernauts are, who is the Neandernaut? That's you. You are the Neandernaut, by yours truly, Max Maher. All right, I'm going to start off with some intros here and some definitions to cover our bases before we get in real deep. We want to make sure you understand everything before we get in deep. And we're going to start off real simply here. What is a stock? A stock, also known as a share, those words can be exchanged for one another, stock and share, represents a small piece of ownership in a corporation. Your total ownership is also referred to as your equity in a company, your equity share, your equity stake in a company. So here on the left, I have a diagram of a pie. We typically represent the shares of a company as a pie. In this case, there's only 4 shares. Each share is worth 25% of the company. And then on the right here, we have a pie with a few more slices. I believe there's 14 slices there. And each of those 14 shares are worth 7.14% of that company. Now, most public companies have millions, if not billions of shares. So you don't own anywhere near 7% of a company by holding 1 share in normal circumstances. But you can see all that needs to happen is that pie needs to be split up into more and more fractions to create more shares of a stock. Moving on from here, you are an owner when you buy a share of a company, when you buy a stock of a company. So buying a share or stock in a company means you actually own that slice of the business, believe it or not. Buying 1 share of Coca-Cola, for example, means you are actually an owner of Coca-Cola. Doesn't mean you can go in there and start bossing people around, but you actually own a small little slice of Coca-Cola. And this is actually the right fraction. If you own 1 share, you own 0.232% of Coca-Cola if you buy 1 share. Now, what it means to own a share of a company. Owning a share or the stock of a company entitles you to a portion of that company's assets and profits, and also voting rights, depending on the kind of share that you bought. But we're going to talk about that in a couple minutes here, the different kinds of stock that you can buy. But doing some definitions, assets are a resource with economic value, which basically means it's worth money. An asset is a resource worth money that the company owns either because it's valuable in and of itself, something like cash, and or helps produce value like a piece of equipment. A tractor or a conveyor belt is worth money, and it also helps produce money. Those are both considered assets of the company. And you also are entitled to profits when you own a share of a company. And profits are the financial benefit that a company gets to keep after deducting expenses from revenue. So total sales minus total expenses equals your profit, equals the company's profit. Now that doesn't exactly mean that is all going to be paid out to shareholders, because some of the profits get reinvested back into the business. Only a small portion, in only some cases, gets paid out as a dividend, which we'll explain all of that a little bit later. Not all shares are created equal though. Share price means nothing without additional context to that share price. So repeat after me, share price means nothing without additional context, but that doesn't quite flow as well. So if company A's shares cost $10 and company B's shares cost $100, that does not necessarily mean that company A is cheaper than company B. This is a very common misconception, and you do not want to think that way. And that is because of market cap. Market cap is the total value of a company. In order to calculate market cap, you take the total number of shares, the total number of slices in that pie, and you multiply that by the share price, and you get the total market value of that company. So here's some examples, and this will highlight the share price discrepancy that I was talking about a second ago. So Coca-Cola, they have 4.3 billion shares. The current price is about $54 a share, which means their market cap is $232 billion. 4.3 billion times $54, $232 billion. Then we have GameStop, whose share price is actually higher than Coca-Cola by more than 4x. It's $217 per share, but the total market cap is $15.3 billion, far lower market cap, but that's because they have far fewer shares. So market cap is really what you want to look at when determining how expensive a company is, not share price. You need to know share price and total shares to understand how expensive a company is. And also here's a note down here, a stock split increases the number of shares. So sometimes you'll hear about like Apple did a 4-to-1 stock split. It means that each share of that company is now split into 4 shares and the value is also divided by 4. So if the share was $100 and there was a 4-to-1 stock split, that means you now own 4 shares worth $25 each. A reverse stock split is the opposite of that. So 4 shares to 1 share, for example. This does not change the value of the company. This does not mean the company is now cheaper, but companies do this because people tend to think that the company is now more affordable because the share price is lower. This is not the case. Do not fall into that trap. Moving on from here. Oh, it's all about the shares times the price, baby. I forgot that I wrote that there. Anyways, why do companies have stocks? Why do they have them? They have them to finance growth and the expansion of their company by giving up some of their ownership and some of their profits. So they sell off some of their ownership and some of the rights to their profits in order to expand the company, if there are profits. A lot of times there aren't profits quite yet when a company IPOs. It all depends on the individual situation. We'll define IPO in a minute here. So here's an example. And yes, I drew all of this. I did all the illustrations myself here. So Nice Buns and Company. Let's say you own 100% of this bakery, but you want to expand. You don't want to necessarily take out a loan. You want to sell a portion of your business in order to expand. This is what you can do. You decide you want to sell 25% of your company to finance that second location. So in order to do that, you sell 10 shares of your company to 10 investors for $20,000 each share. And this is the result of what happens after doing that sale. Each investor now owns 2.5% of your bakery. And by owning 2.5%, they are now entitled to 2.5% of the profits paid out to owners, and they own 2.5% of the assets. That doesn't mean that they can just go and sell 2.5% of the assets. They can sell their shares to someone else, but they own 2.5%. And the sale also means that you raise $200,000 to finance the second location of your bakery, Nice Buns & Co. And that means that you now own 75% of the company instead of the 100% because you sold 25% of your company. And this actually means that your bakery now has a market cap of $800,000. And remember, we get this by taking the total shares, which is 40 in this case. You sold 10 of the shares, but there are 40 total in the company, times the value of each share, which is $20,000. And that's how we get a total market cap of $800,000 for Nice Buns and Company. Moving on from here. What if you wanted to sell shares in the open market? What if you wanted to take Nice Buns and Company public? This is when a company IPOs, which is called the initial public offering. This is where a private company goes through all the regulatory and the underwriting process that allows them to then sell the shares of their company, if you wanted to sell that 25%, on the open market to the general public, to anyone. You and I could buy shares of Nice Buns & Co. So Nice Buns & Co. probably wouldn't be able to go public though, because they're simply not large enough, because this is very expensive to do, and there are pretty hefty requirements to do so on most exchanges. But that is what it means when a company IPOs and anyone is now able to buy a small portion of that firm. Now, moving on from here, the different types of stock. There are, believe it or not, different kinds of stock. Now, the most common one, you guessed it, is common stock. Basically, this is the one that most people are referencing if they say, I bought or sold a share of this company. It's typically common stock. Now, common stockholders get 1 vote per share of common stock that they hold, and they get their portion of assets, profits, and ownership in the company by holding their shares of common stock. And then we have preferred stock. Preferred stock still represents ownership in a company, but it has some pretty major differences. They usually don't have voting rights like the common stockholders do. They usually include a guaranteed fixed dividend. So a dividend is the amount that is paid out to stockholders With common stock, that is not guaranteed. That is not guaranteed whatsoever. With a preferred stock, it's kind of like a coupon that is paid out on a regular basis based on a percentage of the total amount that you invested. Also, with a preferred stock, in the event of liquidation of the company, let's say it goes bankrupt and they just do an asset sale, they sell everything they have and try to convert that to cash and pay off debts, a preferred stockholder would be paid out first before a common stockholder. And also, the company has the option to purchase back preferred shares at any time. And usually if that happens, the preferred stockholders get paid more than what those shares are actually worth, generally for the inconvenience of having to sell it, maybe if they didn't want to. And then finally, we have classes of stock. So companies can customize any of these criteria that we've talked about, from ownership, voting rights, dividend yield, you name it. They can tweak that and create different classes of stock. Now, not all companies even have different classes, but this is an option. A common example, or a more popular company that has classes of stock, is Berkshire Hathaway. They do this because their main BRKA has never done a stock split, and because the company has grown so much, the stock is hundreds of thousands of dollars per share. And they wanted to make this a little bit more accessible to the everyday stockholder. So they came out with a Class B stock that is 1/1500th the price of the Class A stock and has no voting rights. So that's one common example of a class of stock within a company. Moving on from here, what is the stock market? Getting back to the basics. So the stock market is a collection of markets and exchanges where you can buy, sell, or issue shares of a public company. So stock exchanges are the markets within the stock market. And these are the three major stock exchanges within the United States. We have the Chicago Board Options Exchange, the New York Stock Exchange, and the NASDAQ. So when you think of the stock market, you can kind of think it's like a market of markets. So let's say there was a grocery market, or you could almost say the grocery industry is anywhere that you could buy food. And then a grocery chain would be like one of these stock exchanges within the grocery market. That's how you can think of the full stock market and the exchanges within that market. Moving on from here, what is a stock brokerage? A stock brokerage is the middleman that connects buyers and sellers of a stock. And here we can see I'm buying 1 share of Tesla from Meet Kevin, and I drew this Earth. I drew that. If that's not worth a like on this video, I don't know what is. Now let's talk about the different kinds of stock brokerages. The first one is a full service brokerage. This is where a professional financial advisor manages all of your investment decisions, and they are there to answer any questions that you might have along the way. You pay a little bit more for this kind of service. Some examples here are Charles Schwab, Raymond James, and Fidelity. All offer full service brokerage services. And then we have discount brokerages. This is the most popular version. If you're thinking of a stock brokerage, this is generally some kind of discount brokerage. So this is a platform that allows just your regular everyday investor who wants to manage their own money, they want to buy and sell shares on their own, it allows them to do so. It's an open marketplace, and typically they offer $0 trades. Some examples here, again, are Charles Schwab. They offer the full service or discount, whatever you want to do. Webull, which I have linked down below, you can grab some free stocks with Webull. Robinhood, also you can grab some free stocks down there. M1 Finance, more free stocks down there. You have tons of options when it comes to discount brokerages. Tons of places to go, but you might as well go with one that gives you some free money along the way. And then we have robo-advisors. This is kind of a newer type of brokerage. This is a platform that offers investment management services, but it's carried out by algorithms and AI, not an actual person who's looking at all the numbers and deciding where the money should go. So it's a lower cost version of full service. Some examples here that are pretty popular are SoFi. Vanguard has some options for robo-advisors, Betterment, and there are tons of other options with that as well if you're interested. Now let's talk stock market sectors, in which there are 11 of them. So let's talk about each individual sector just very briefly as to what it encompasses, and then give some company examples for each and every sector. The first one is industrials. This is businesses that generally use heavy equipment. We're talking railroads, airlines, and trucking and logistic companies. Some examples here are Southwest Airlines and Union Pacific. Next up, we have energy companies. This is oil and gas industries and businesses that provide equipment and services to oil and gas industry. Some examples here, ExxonMobil, Chevron, BP, you get the idea. Next up is materials. They provide goods for manufacturing and building. Some examples here are Nucor, which is a steel manufacturer, Cemex, which manufactures cement, and DuPont, which manufactures all sorts of stuff. Next up is utilities. You can guess what this one covers. Any basic utility, including electricity, natural gas, water, you name it. Some examples: Consolidated Edison, American Water Works, utilities. Next up is financials. These are the money handlers. This is banking, insurance, brokerages, anyone who is like a middleman facilitating the transaction of money. Some examples here are Wells Fargo, Aflac, Chase Bank, and Bank of America. Next up, we have consumer discretionary. Now, this one isn't quite as intuitive as the others, so this is defined as non-essential goods and services. Typically, consumer discretionary industries fluctuate with consumer income. The more income consumers have, the better this sector does. The less income, the worse the sector does. A good example here was COVID. Consumer discretionary was hit especially hard during the COVID pandemic. And these can be low-cost items that aren't technically necessary, or luxury items. Some examples here are McDonald's, Disney, and Ford. Next, we have consumer staples, kind of the opposite of consumer discretionary. This is essential goods and services. Demand does not typically fluctuate on this sector with income or the necessary state of the economy because it's things that people need to buy either way. We have here food, hygiene products, and household products that fit within this criteria. Some examples are Coca-Cola actually is part of this, even though you might think that's not a necessity. They're part of it. Walmart and Procter & Gamble. Now, with Walmart and Coca-Cola, you might be thinking like they could potentially fit within a different sector. And yes, there is some gray area here where you could shift a company from one sector to another. They're just not perfect. It's hard to fit every single company into only 11 different criteria. Next, we have information technology. This is companies involved in technical innovation. Some examples here are Apple Computer, Dell, Dropbox, tech companies. Next up is communication services. This is telecommunications like cell phone providers and media and entertainment providers. Some examples: AT&T, Verizon, Viacom, CBS, entertainment companies. Netflix would fit in that as well. Real estate, this is the next sector. REITs are included here, real estate investment trusts. We're going to go in a little bit more in depth on that later. And real estate development companies, some examples: Simon Property Group and Crown Castle. And then finally, we have healthcare. This is pharmaceuticals and biotech. Some examples are Pfizer and Teladoc. Now let's talk about the reason why you're here, how you actually make money with the stock market. How do you actually make money with stocks? We have dividends and we have appreciation of stocks. So first off, what is a dividend? A dividend is a portion of a company's profit paid out to shareholders, typically paid on a quarterly basis, so 4 times a year. Typical dividends are between about 1% and 7% of the stock price paid out annually. So a very simple example here. Let's say you bought a share of a company for $100. That company pays out a 5% dividend. That means $5 is paid out per share per year, which would come out to a $1.25 dividend paid out each quarter. Now, an important note, you don't have to sell a share to collect a dividend payment. It's passive income. It's really awesome to build up passive income, but it takes quite a bit of stocks in order to live off of dividends. Next, we have appreciation. Now, appreciation happens when the market value of the shares you purchased increase. So here's an example. You purchased 1 share of Nice Buns & Co., that bakery that we were talking about a couple minutes back. The ticker symbol is BUNZ, buns. So you bought 1 share for $100. 3 months later, the market price of your 1 share is $130. Great job. Your 1 share of buns has appreciated by 30%. That is appreciation. You increased your position by 30%. But it's important to note that you only get to keep the profits of that 30% appreciation after you sell. Until you sell, it is considered paper gains. Paper gains until you sell. It's locked in once you actually sell. And a note on top of the note, once you sell, there is a taxable event. So you don't actually get to keep the full 30% because you have to pay taxes on your gains, capital gains taxes, which we'll talk about later on in this video. Now let's talk about types of stocks as an investment. The first one is income stocks. This is the safest stock. I say safest because no stock is perfectly safe, but it's the safest type of stock due to low volatility and steady dividend payments. So volatility, let's just do some definitions here. Volatility is a stock's tendency to change in price rapidly and unpredictably. So a high volatility stock means it's less reliable. You can count less on that stock having a stable upwards trend. It may be all over the place if it's high volatility. If it's low volatility, then it could either be flat or a nice stable upwards trend. Now, a blue chip stock is the opposite of a high volatility stock. A blue chip stock is one that has a long reputation of positive profits and steady dividend payments. Moving on to the next type of stock, penny stocks. Penny stocks are typically shares of companies that trade for no more than $5. Now, typically when someone refers to a penny stock, they're referring to a stock that is less than $1, but technically it can be a penny stock up to $5 per share. These are typically small, high-risk companies. Next, we have speculative stocks. You might be pretty familiar with speculative stocks. Stocks of exploratory companies attempting to break into new technologies or new markets, or this could be stocks where investors are betting on a large turnaround in the stock's price or the financials of a company. Meme stocks fall into this category, so that's why I put our meme overlord Roaring Kitty down in the corner here.
Chupapi muñeño.
All right, next we have growth stocks. Growth stocks are stocks of companies who are trying to grow as quickly as possible. These companies don't typically pay out dividend payments because they are putting all of their earnings into growing the company and trying to capture as much market share and gain as much revenue as possible. They are reinvesting all their earnings back into growth. Then we have cyclical stocks. These are stocks that are dramatically impacted by the state of the economy. We have things like airlines, new vehicles, and luxury goods. This is consumer discretionary. Remember, if we go back to the sectors, this would fit in within consumer discretionary. Then we have defensive stocks, which again is the opposite of cyclical or discretionary. And this is stocks that typically remain unaffected during downturns. They are products or services that people need. Some examples would be food providers, healthcare, and utilities. These are the same as the sector consumer staples because demand does not typically go down, or it doesn't go down quite as much as income goes down or if the economy is being hit particularly hard. Then we have our last type of stocks on the continued page, and this is value stocks. These are stocks in which investors believe the market has undervalued. The price for the stock is lower than what investors believe it should be, and they think there's a buying opportunity here. So this is broken into two major styles. The first one is the Ben Graham style. So what Ben Graham would say is what I have written here: I'll buy anything as long as it's cheap. He would buy any company as long as the share price was cheap enough, even if it was a bad company. This is sometimes referred to as cigar butt investing. And then we have Warren Buffett's style, who Benjamin Graham was his mentor. Warren Buffett took what he liked from the Benjamin Graham style and kind of turned it into his own. So his style is he wants great companies at a fair price. He would rather buy a great company for an okay share price than a bad company at a spanking deal, because he wants to buy a company and just simply hold it forever. That way he doesn't have to sell and he doesn't have to pay capital gains taxes on that sale. So the assumption with value stocks is the market is not always perfect, at least in the short run. It is not taking all the information in and giving a perfect price, at least in the short run. And because of this, Benjamin Graham, in his 1949 book, The Intelligent Investor, which is an amazing book, I'll have that linked down in the description. You should read it if you're interested in value investing. He describes how the market price for a stock is not always perfect in the short run, using this allegory of Mr. Market. So let me just explain this real quick. So imagine you are one of the two owners of a business, and your business partner is Mr. Market. Your partner every day, your business partner, either offers to buy your share of the business or to sell you their share of the business every single day. Your partner is either wildly optimistic about the company and its future prospects, or they are wildly pessimistic depending on the day, and it can flip 180 from day to day, or there could be a day where they're completely boring and like, whatever. So your partner is irrational, blows small events out of proportion, and is moody in the short run. And Benjamin Graham says this is the stock market. The stock market is essentially sending you a price quote every single day, and a lot of the daily price action is due to small events that don't typically matter quite as much in the long run. And here's an excellent quote by him and a great way to think about the stock market both in the short run and the long run. The quote is, in the short run, the stock market is a voting machine. In the long run, a weighing machine. So what does this mean? A weighing machine, a voting machine? In the short run, a stock price is swayed disproportionately by small things like news events, analyst projections, drama, rumor, hype, you name it, that affects the stock price dramatically. But in the long run, the stock market and the price of individual companies is determined much more by the value it creates. That's why I made this off-balance scale where it shows cash is more important in the long run than something like an Elon Musk tweet in the short run, which can sway markets for a day. But in the long run, it matters more. What is the actual value that's being produced with this company, with this asset in the stock market? Next up is an ETF. What is an ETF? An exchange traded fund. So an ETF is a tradable financial instrument that allows you to purchase a small portion of a diverse bundle of multiple securities. So ETFs can track a ton of different things, like an index, a sector, a commodity, or any other asset. We're going to dive into this so you can completely understand this. Just don't check out. Don't check out. You'll understand it in a minute here. So the most popular ETF is the SPDR S&P 500 ETF. SPY is the ticker symbol. Buying a share of SPY actually gives you a small little slice, a small little portion of the 500 largest companies in the United States. So we have a share. Remember, that's a small slice if you were to buy one share of any one of these 500 companies. One share of the SPY ETF gives you an even smaller slice of 500 companies, the 500 largest companies. So it gives you this nice diversification. So here is an example of a stock versus an ETF, not to be confused with livestock. You know, these are supposed to be cows, but now that I look at it, it kind of looks like I drew a goat. But anyways, so buying an individual stock, it's kind of like buying one cow. So let's say you have $100. You want to get into the milk game. The milk game is hot. So you have $100. You could either buy one cow for $100, or you could put a $100 stake in for 10 cows. So what happens here, if you have one cow, it's more volatile. That cow could produce more milk one day, less milk the day after that. You don't know what's going to happen. It's less predictable. But if you have 10 cows, you know the average of those 10 cows could give you a more predictable return. That is kind of like buying into an ETF. You get a little bit more diversification. You get a little bit more of a consistent return. There's going to be fewer low lows and fewer high highs as far as what your return is in that investment. And then we have an index fund. An index fund is a type of ETF that is built to match or track a financial market index. So a market index is a bundle of securities that represent a category in the financial market. So some examples of this could be a large cap stock, so stocks with a huge market cap, or small cap stocks, stocks with a small market cap, or growth stocks, value stocks, consumer defensive stocks, tech stocks, any number of categories that we already mentioned. This could be an index fund, and there generally is already an index fund on anything you could think of. There are so many index funds. So two popular index funds are the Dow Jones Industrial Average and the NASDAQ Composite Index. So when someone says, oh, you know, the Dow is down 0.5%, they're talking about the Dow Jones Industrial Average Index Fund being down 0.5%. Same with the NASDAQ Composite Index. So now when someone says, oh, the NASDAQ is up 1%, you know exactly what they're talking about, and you can come back and say, thanks, I sounded smart by the water cooler today at work. And then next we have mutual funds. Mutual funds are similar to an ETF, but it's a professionally managed financial instrument that pools money from investors, similar to an index fund or an ETF, but it aims to beat market returns, not match market returns, by purchasing a variety of different investments like stocks, bonds, or other assets. So mutual funds, like I said, are similar, but their performance is based much more on the fund and the fund manager's success than specific assets or a specific index performing well. And typically mutual funds, even though there's someone there trying to make the best return possible, typically they return a worse return than an ETF or an index fund unmanaged in the long run. It's nearly impossible to beat the market in the long run. Now, I know it's confusing with the differences between mutual funds, index funds, and ETFs, so I made this handy Venn diagram. Is it a Venn diagram if there's three? So I made this so we can tell all the similarities and the differences between an ETF, index fund, and mutual fund. So let's go over this. We're going to start in the middle with the similarities between all three. So first, investors are pooling money. So with all three of these, many investors from all over the world are pooling their money to give some more buying power in these individual funds. They also all are a way to hold many different securities. Remember, it's the difference between buying that one cow or buying the stake in 10 cows. And they all help you diversify by being able to be in all these different securities or asset classes or whatever the ETF, index fund, or mutual fund is that you're buying into, whatever the focus is. Now, if we go to the top left to what is unique about ETFs, we can see ETFs can be purchased anytime during trading hours. So that's different than index funds and mutual funds. With index funds and mutual funds, they can only be bought or sold once per day. At one time per day, those trades are executed. With ETFs, also, there is a very low investment amount. Typically, there is no minimum amount. You can invest $1 if you want to. And the average fees with an ETF are 0.44%. Now, if we go to the top right to the unique criteria of index funds, we can see the minimum investment amount varies. It can be zero in some cases, but it also can be as high as $3,000. So you may have to, depending on the index fund, buy a minimum of up to $3,000 in order to buy a chunk of that index fund. The average expense fee for index funds is the lowest of all three, with 0.09%, because they're largely unmanaged. They're a low fee way to diversify your money. And index funds really are the best place for most people to plunk down their money if you don't want to spend hour after hour tracking individual stocks and investments and trying to beat the market, which nearly no one can do. Index funds are a great option for nearly everyone, and most people should have a base of their portfolio, at least in index funds, and then potentially have some individual picks on the side. Now, if we go to the bottom to the unique criteria of mutual funds, we can see mutual funds are actively managed. So there's a fund manager making buy and sell decisions within a mutual fund. The goal of a mutual fund is to beat market returns, not just match market returns like an index fund would or an ETF would, depending on the ETF. They have high average fees. They have the highest fees of the three here, with average fees of 0.82%. Now, you can find fees lower than this and higher than this, and they have the highest minimum investment amount, typically between $500 and $3,000. Now, if we look at the similarities between mutual funds and index funds down in the bottom right corner here, we can see that buy and sell orders are only executed once per day. So if you make a buy order for a mutual fund or index fund today, it'll be executed tomorrow at market open in most cases, where with ETFs, it's more similar to just buying an individual stock. You place that buy order and it just goes through right then and there. So I hope that this Venn diagram helps clear the air as to the differences between ETF, index funds, and mutual funds. What are REITs? Real estate investment trusts. REITs are a company that owns, finances, and operates income-producing real estate. So we can think of it as a combination of a dividend stock, because nearly all REITs pay out a dividend, a mutual fund because of the diversification factor and the pooling of investors' money, and a real estate investment at the same time, because REITs are actually buying physical real estate and then taking profits from it and paying it out to shareholders. So REITs allow investors to earn income off of real estate without actually having to buy or manage the real estate yourself. And you get a nice little piece of diversification along with it. Now, I made this diagram just to highlight the key features of REITs. So we can see we made a little pie here with a bunch of houses in it. With a REIT, you're essentially buying a slice of a real estate portfolio. Now, some REITs are targeted in that they may focus solely on single-family homes or commercial properties, and some other REITs are fairly diversified in different types of real estate within the real estate asset class. So you'll want to take a look at the particular REIT that you may be interested in to see what types of real estate they are investing in. So some key features here is it gives you exposure to a different type of asset class that you might not have exposure to, which is a good thing when you're trying to have a balanced portfolio. Typically with stocks, we have a lot of exposure to the stock market and to consumer companies. This allows us a little bit more of diversification and diversification within diversification, because if you, for instance, buy a single family home as an investment property, if for whatever reason that doesn't produce income for
for the year because there's some issue at that property, you just don't make any income. However, if you buy a REIT, you're getting that small slice of many different properties, so you're more diversified. What this does is reduce the lower lows in terms of your investment and reduce the higher highs. You give it a more stable return with a larger portfolio that is diversified. Also, this can be any kind of income producing asset, including homes, apartments, commercial real estate, hotels, hospitals, cell towers. As long as it's any income producing physical asset, there can be a REIT based around that thing. And shares of REITs can be bought at any brokerage, whatever brokerage you want to use, you can buy shares of any particular REIT. And 90% of the taxable income must be paid out to shareholders. So it's kind of unique in that nearly all of them, as long as there is income, pay a dividend and have to pay a sizable chunk of all their income out as dividends. So it's a bit of passive income as well. What is risk in the stock market? Because unfortunately, contrary to popular opinion, stocks don't always just go up. So we need to talk about the risk because all investments come with some form of risk. In stocks, it largely comes down to 3 different types of risk. The first one is market risk. This is also sometimes referred to as systematic risk. This is the risk that entire markets can drop due to unforeseen events. COVID. And this can't typically be diversified away within a single asset class. So if you were to buy into stocks, you still have the market risk that the stock market as a whole could go down. Now you could diversify into completely other asset classes that tend to perform better in certain scenarios, but within a market, there is market risk. Next, we have specific risk. This is the risk associated with an individual company, an individual stock. Now this could be anything about the company. It could be its level of profitability or lack thereof. If sales are down, if the management is having issues or there's drama or there's some scandal with management or there's bad press or there's fraud within the company, this could be anything having to do with the risk of an individual stock or investment. And then third is interest rate risk. And this is the fact that stocks tend to go up when interest rates decrease and they tend to go down when interest rates increase. So there's risks with interest rates changing. Now we need to talk about risk tolerance and what is your risk tolerance because it is different for everyone. So in order to help explain this, I want to pose some questions and that way you can just take a minute, maybe pause the video and just think, what is my risk tolerance, and try to answer all these questions to get a better idea as to how you should potentially invest. So your risk tolerance, you can also think of this as how much are you willing to lose without losing your mind and panic selling in the event of a market correction or some temporary event that could lower market prices or stock prices. So a couple questions to ask yourself, and I really think you should answer these yourself. Number 1, are you concerned about losing money? Are you investing some amount that you're concerned about losing? If you're like, no, it's no big deal, then you might have a higher risk tolerance. Number 2, how much are you willing to lose? If you have $10,000 to invest, are you willing to potentially lose $2,000, especially in the short run, $3,000, $4,000? How much are you willing to lose in order to get a higher return? Because of course, higher risk, higher potential reward, potential. Number 3, how worried do you think you'll be when the market declines? If you're an investor for long enough, you will experience market and individual stock declines that will hurt. It will hurt. How worried do you think you'll be? And then whatever your answer is to that, multiply it by 2 because you're probably gonna be much more worried than you even think you are. And you wanna make sure that you don't make any irrational decisions. Number 4, how old are you and how much time do you have? The younger you are, the more risk tolerance that you have because you have more time to recoup your investments, because the biggest thing about making more money is having time. If you're older, you may wanna be more conservative with your investments. Number 5, how much money do you have? If you have $100,000, then $10,000 isn't as big of a deal. If you only have $10,000 in your name, maybe you don't want to be quite as risky with that. Maybe you want to place it into safe bets and then build up that nest egg. Number 6, how diversified do you want your portfolio to be? Of course, the more diversified, the more safe it is, but the returns are unlikely to be as high in a diversified portfolio. Number 7, what returns are you looking for? We want to be realistic with this. An 8% compounded return is great over the long run. You can't have unrealistic expectations. You can't expect your money to double every year. If you are expecting your money to double every year, you will lose your money in the long term. It's possible to make bets that double or triple or quadruple, but in the long term, if you're constantly trying to make these bets, you will lose money. And then finally, do you need the money for something else? Let's say you have $20,000 that you can invest right now, but you're going to use it next year to
to place a down payment on a house. You probably don't want to put that into something risky, so you have that $20,000 to put down next year when you need it. Maybe you want to put it into something a little bit more conservative. And then to help explain risk level, I built this tower of returns. So it's high risk at the top, medium risk, and then low risk. Now, of course, within the medium risk, it varies quite a bit as to the actual individual risk. So for example, let's just start with the middle. We have ETFs, we have REITs, we have high income bonds, but we also have real estate and mutual funds and large and medium cap stocks. In reality, a large or medium cap stock is quite a bit more risky than something like an entire ETF, especially if it's like an S&P 500 ETF, but those are medium risk. In the high risk category, you're looking at options, crypto options, or speculative stocks, meme stocks, or futures or collectibles, things like stamp collections. Gold would even fit in within the high risk category here. And then the bottom, low risk, if you're young, chances are you don't really want to bother with the bottom, but of course none of this is investment advice, but these are by far the most safe ways to store your money. And it's really more a store because you're not going to get a huge return. We have government bonds, we have bank accounts, which return next to zero. Inflation protected securities for high inflation environments. Of course, the return on that is very low as well. Cash, which you actually lose money over time with inflation. Then you have CDs, notes, and bills. Now let's cover some portfolio examples. Now there is no perfect portfolio and opinions vary wildly with portfolios. Some people say you should put all your money into Bitcoin. Some people say that you should put all your money into ETFs. These are just some examples. This is not financial advice. It's just some ideas. So up in the top left here, we have Warren Buffett's portfolio. He does about 10% in short-term bonds and 90% in stocks. Now, many people think of him as a safe investor, but in the grand scheme of things, he actually has a little bit more on the risky side of portfolios, being so heavy in stocks, especially at his age, at more than 80 years old. Then we have another legendary investor in the bottom left, Larry Swedroe, with a slightly less risky portfolio. So he does 70% intermediate treasury bonds, 15% small cap value stocks, 7.5% developed market small cap value stocks, and 7.5% emerging markets value stocks. And in the top right here, we have a general overview of portfolios you may want to consider based on your age. A general rule of thumb is you may want to put 1% allocation of your portfolio into bonds for every year old you are. So they say over time you should invest less and less in stocks because bonds are generally safer. So if you're 30 years old, the general rule of thumb is to have 30% of your portfolio into bonds. Now I know many people don't like bonds, especially right now when bond rates are extremely low, but I just want to cover general applications and general options here. So we can see a young investor, they're recommending 80-20 stocks to bonds. But then a late retirement investor, they're recommending a large portion in cash and a small portion in stocks and a larger portion in bonds. So of course, this really changes as you age. And again, there's no perfect portfolio. And then the bottom, I made this just average young investor. What if you're young, something you may be interested in doing as a potential option. This is a little bit on the more risky side, but it's not crazy risk. So with this, we have 40% large cap index fund, something like an S&P 500 or an S&P 500 growth or something like that. We have 10% crypto in meme stocks because I know every young investor is interested in these ultra high returns, the crypto, meme stocks, speculative stocks. So 10% allocation, I think that's fairly safe. On the safe end anyways, if you are young. 20% individual reliable stocks. So if you're someone who wants to try and do stock picks, you could do 20% and still have a relatively safe portfolio. And then 30% growth index funds. So growth companies. When you're young, you generally want to focus more on growth than on dividends because you want that to compound. You want your money to compound without having to pay taxes on that. In the long run, that will earn you significantly more money for retirement. Now you might be thinking, this is way too much to think about allocating portfolios. Like, I don't want to deal with any of this. You have other options. There are robo-advisors who can help you out here. There are actually ETFs that have set retirement dates. So let's say you think, okay, I want to retire in 2065. You can buy an ETF that automatically changes year over year, changing the allocation of your portfolio until your retirement age. So it would do something like be heavy on stocks right now, but then 40 years from now start to transition into safer securities. So there are options like that that are much more simple. And honestly, for most people, a simple option is best because Unless you're willing to spend many hours researching and understanding your investments and keeping up with them, it's probably better to do something like an index fund or an ETF to be safe, because rule number one, you do not want to lose money. Can you time the market? And the answer is not really, at least not consistently. It's possible to get it right sometimes, but it is impossible to knock it out of the park every single time when it comes to timing the market. Now, I guess, what does timing the market even mean? This means buying or selling stocks based on an expected price change. So you think the stock's going to go up, so you buy now. You think the stock's going to go down, so you sell now. And here's some examples of that. So, Apple's quarterly earnings are on Friday, and I know tons of people who bought the iPhone this year, so I'm going to buy now because I just know their earnings are going to be good. You know what? I think the market's going to crash, so I'm not going to buy any stocks for at least the next month or so. In theory, timing the market makes sense. It seems obvious, really. Buy now if you think the price is going to go up in the near future, sell now if you think it's going to go down. But it's much harder in practice, and no one can do it consistently. A perfect example of attempting to time the market is mutual fund managers. They have all of the assets and the technology you could possibly ever want at their fingertips, and they still aren't able to even match market returns on average. So here's a stat from 2019. On average, mutual funds returned at 26.14%. In the same year, which that's a great return, but in the same year, the S&P 500 returned 31.49%. So even mutual funds with everything at their fingertips struggle to match the market, much less beat the market. Hence, timing is very, very hard to do. But this isn't to say that it's impossible. It's just, like I said, not possible consistently. Remember, markets can overreact. They can overreact to news events, drama, political events, you name it. And occasionally, you're able to buy low because you called it right, but it just does not work, unfortunately, 100% of the time. Sometimes there may be a dip and you'll buy the dip, and that dip just keeps on dipping. And that's just how it goes occasionally. And that brings us to the next strategy, dollar cost averaging. What is that, you might ask? I got you covered. It's a strategy where an investor divides the total amount that they plan to invest into regular set purchases over time. Here's an example of that. So I have $20,000 saved up, and I really want to start investing and start earning money off of my money. But I'm kind of worried about plopping that $20,000 down and then seeing a 5 or 10% correction just because I happen to buy at the wrong time. So instead of just buying $20,000 today, I'm going to instead buy $2,000 worth of an S&P 500 index fund for 10 weeks. Every single Friday, I'm just going to buy $2,000 worth. That way, it'll flatten out the volatility a little bit, give me a little bit less risk, and I'm not going to have any emotions into the decision of buying. How to analyze a stock. This is where things get very exciting, but also pretty complicated. So I want you to hang in here with me. You might have to watch this section a couple times. There's no shame in that. You might have to watch it at half speed. There's no shame in making sure you understand this, because this is a true case of knowledge is power. Because once you understand how to actually analyze a stock, this is where you turn into a real investor, especially if you're trying to do individual stock picks. You want to be able to tear a company apart and look at the inner workings and understand the financial health of a company. And that's what we're going to cover here, at least the basics as to how you get started with it. So we're going to first cover fundamental stock analysis, and this is going to be quite a large section. And then we'll cover technical analysis a little bit after that. So fundamental stock analysis. This is the process of understanding the past, the present, and the potential future prospects of a company by taking into account basically anything you could take into account. Their sales, their financials, their rate of growth, their profitability, their health, the industry health, where's the industry headed, the management team's competency, much, much more. Literally anything that could affect a company, you can factor into your calculations for a fundamental stock analysis. So in order to start this off, we need to start with the basics, the financial statements. There are three main financial statements: the income statement, the balance sheet, and the cash flow statement. And they all relate to each other, kind of communicate with each other. We're going to break down each one individually, and then we're going to talk about how they relate. And we're going to do it in as simple terms as possible. And I think you'll be able to follow this and then know much more about financials after this brief section. So first off, the income statement, also known as the profit and loss sheet or the P&L. This is the first place you'll typically look at when you're analyzing a company. This shows the overall performance for a company during a time period. Typically that time period is either quarterly or annually. Quarterly being, after the earnings call each quarter, you get a new P&L, you get a new set of financial statements, and then annually, those 4 quarterly statements are compiled to an annual report. This starts with sales revenue and then deducts the costs of goods sold, the cost of actually producing the good or service that you're selling, and this gives you gross profit. Gross profit is then decreased by operating expenses, and that gives you the net income. So I have made an example of a fictitious company. It's called Max's Meats. Go figure. It's called Max's Meats, and we've made a fictitious income statement, cash flow statement, and balance sheet. We're going to just start with the income statement right now. Break this down piece by piece. So Max's Meats had $100,000 in sales in its first year of business. The meat business is a good business to be in. Our cost of goods sold, $40,000, and that gives us a gross profit of $60,000. Our expenses, general administrative, this is things like the back office staff, any general expense could fit into here. We have $5,000. Research and development, we were trying to figure out how thin you can slice beef jerky, so we spent $1,000 on our research here in the beef jerky market. Sales and marketing, fairly low, $3,000, because Max's Meats, they just sell themselves. We really don't need much sales in marketing or advertising. So our total expenses here, $9,000. We deduct that $9,000 from our gross profit of $60,000 and gives us an EBITDA of $51,000. Now, EBITDA is earnings before interest, taxes, depreciation, and amortization. Some investors would rather use EBITDA instead of net income because it isn't subject to quite as many fluctuations, but we're not going to get into that on this video. And then our net income is $51,000. So now that we understand the income statement, we need to understand the statement of cash flows. The statement of cash flows takes in the net income and then adjusts that net income by factoring in non-cash expenses, because the net income only tells us so much. So the statement of cash flows displays the change in cash on a given period. Usually that period, again, is quarterly or annually. So the change in cash in that period, it displays the beginning balance of cash within that period and the ending balance of cash in that period. So let's look at our example here again for Max's Meats, our fictitious company, our statement of cash flows. So we have our net income of $51,000. We have a decrease of accounts receivable, or increase depending on the situation. So what is accounts receivable? Accounts receivable is money that we have yet to receive. So we sold some of our product, we sold some beef jerky or something like that, and our customer has yet to pay us. So there's a $2,500 deduction that we need to factor in because we have not received that cash yet. And then on the other flip of the coin, the other side of the coin here, we have accounts payable of $1,000. So this is the opposite. This is money that we have yet to pay in our expenses. So we have a supplier that we had a $1,000 charge. We have yet to pay them. So the cash hasn't actually come out of our accounts, and we need to factor that into our cash flow so we know where we're actually sitting at present day. And then we have net cash from investing. In this case, we're just going to leave that blank because we're going as simple as possible. Our net cash from financing, this would be if you bought an asset like a truck or some fancy beef jerky slicer and you got a loan on it, it would be factored in here. And then we have common stock. So in this example, the founder of this company, which I guess would be me, I'm Max of Max's Meats, added $10,000 to the business in common stock. So I added $10,000 to the business bank account, and that needs to be factored in to the total cash position. So we take that $10,000 and we add it to our cash up here of $49,500, and this gives us $59,500, which is the total cash coming into the company this year. Total cash coming in this year. And then we have the cash at the beginning of the period. This is zero because this is our first year of business. So if this was our second year of business and in the first year we had $50,000, there would be $50,000 here. And then cash at the end of the period is just again $59,500. If we had that last year $50,000, we'd be adding $50,000 plus $59,500 together, and that would be the cash at the end of the period. But again, this was the first year in business for Max's Meats. I don't know why I do this to myself. Next up, we have the balance sheet. The balance sheet is the last of the three, and then we're going to talk about how they commingle with one another. So the balance sheet displays a company's assets, liabilities, and shareholders' equity at a specific date. It's kind of like a snapshot, usually at the end of a quarter or the end of the year. It's like a snapshot net worth of the company on that specific date. So it begins with cash and cash equivalents, and then it shows changes in the accounts, and then it should end with a balanced account. That's why it's called a balance sheet, of the same amount that it starts with up on the top. And this shows the financial position of the company. Again, it's like a snapshot. Net worth snapshot. So if we look at Max's Meat's balance sheet here, we can see the cash is $59,500. The accounts receivable money that we expect to come in is $2,500. So in this case, because we expect to be paid from our customer, we're going to add that to our net worth. Because the customer owes us a debt, we're adding that to our net worth. So our total net worth is $62,000 of this company. Our long-term assets and equipment, that is still blank because we're keeping this simple. Our liabilities, our only current liability is that $1,000 in accounts payable. So that's what we owe our supplier, $1,000. That needs to be deducted from our company's net worth. So our total liabilities, $1,000. And then our equity section. First off, we have common stock. So that $10,000 that I added to the company, that needs to be factored into the net worth because, of course, it's within the company's accounts. Retained earnings, this is the total of the company's profits and losses since the beginning of the company. In this case, it is $51,000. And that $51,000 plus $10,000 in common stock gives us $61,000, which is the total equity, the total net worth of the company after all conversions. Our total liabilities and equity combined is $62,000. And yep, that matches our $62,000 up top. So our accounts are balanced and we are good to go. So now we understand what each of these statements does individually. We need to zoom out a little bit and then talk about how they communicate with one another and relate to one another. So starting with the income statement, nothing has changed here. We have our revenues minus our expenses gives us our net income of $51,000. That $51,000 is taken from the income statement and put up on the statement of cash flows. Here, $51,000. So I've color coded this to the cells that should match, the numbers that should match within these three statements, so then it's a little bit easier to see how they communicate with one another. Now, there's nothing, again, changed in the statement of cash flows here. Our cash at the end of the period is $59,500. And then we take that $59,500, and that's what starts the balance sheet up here of $59,500. And then on the balance sheet, this is where we're really pulling numbers from the other statements. This is where we're going to see it kind of all come together and see how they communicate with each other. So we have the $59,500, accounts receivable, $2,500. So that is pulled from the statement of cash flows. And then we go down to our liabilities to accounts payable, $1,000. Again, that is pulled directly from our cash flows. So that should match. When you're looking at a company, that should match. The accounts receivable should match from the cash flows and the balance sheet. Common stock, again, we pulled that directly from the cash flows. It matches. And retained earnings, this $51,000 should be the same as the net income on the income statement. And then finally, at the end here, $62,000. This matches our $62,000 up above, and we are good to go. This is how they communicate. This is how they commingle with one another. Now, again, like I mentioned before doing this section, you might have to watch this section more than once. That is totally fine. But you want to know, you want to understand this section more than any other section. You want to understand this if you're trying to do individual stock picks, because it will help you so much in analyzing a company. Now, this is a brief overview of financial statements. If you want a more in-depth look, there's a book that I really recommend, and it's called A Step-by-Step Guide to Understanding and Creating Financial Reports. I will have that linked below because that is really helpful if you want to go much more in depth, because we could have a 10-hour video just on financial statements. It can get so complex, especially when you're looking at huge public companies with far more accounts and far more expenses and turnover ratios and things like that. We're going to get a little bit more in depth, but I recommend that book if you want to get very in depth on this subject. Now that we have an understanding of financial statements, we need to talk about financial ratios. Financial ratios are an extremely useful tool when trying to analyze a stock, analyze a potential buy, because what this does, it allows you to compare a company to its competitors, compare a company to standard metrics of these ratios, and compare a company to industry averages. This helps you build a much better picture of the health and the value of a company. So we're going to cover a few popular ratios that are very useful to understand, and then we're going to show how you actually find the data to calculate those ratios within the financial statements that we just discussed. So, starting with the PDE ratio, the price to earnings ratio. This is the most popular financial ratio, and this tells us how much an investor needs to invest in a company in order to receive $1 in earnings. So if you have a PDE of 15, this means you need to spend $15 on stock in that company in order to earn $1 in earnings in 1 year with that company. If the PDE is 5, you only have to spend $5 in order to earn $1 in earnings. If the PDE is 100, if it's a high PDE, that means you have to spend $100 in order to earn $1 in earnings, and you get the picture. Some companies don't have a PDE, and this is because they are not profitable. So it's impossible to calculate because there's no earnings. A high PDE indicates that the market expects a company to grow in the future. So we see this with companies with a lot of hype around them or brand new companies who are barely profitable but have high expectations. A low PDE indicates the market may be undervaluing the company, or there's some kind of news that has come out where investors feel it should be worth less compared to either its competitors or the average PDE. So how do we calculate PDE? It's literally the stock price divided by the earnings per share. So if we go over to the computer, we're on Market Watch here, we're just taking a look at Tyson Foods. We can see that the stock price is $72.76 per share. So we're going to take that and then we're going to divide that by the earnings per share. In order to get that, we're going to go to the financial statement and then to the income statement. We scroll down to EPS, that's earnings per share. Take a look, it's $5.79. So we take that stock price divided by $5.79, and that gets you the PDE. In this case, it's about 12.5. Typically, a PDE of under 15 is considered a value investment. Next up, we have the current ratio. You can think of this as a company's ability to pay short-term debt obligations. That's debt obligations that are due within 1 year. So how well do current assets satisfy the current debts of a company? And that's how you calculate it. Current assets divided by current liabilities. And the ratio for this can vary pretty wildly based on industry because some industries are just naturally much more asset heavy and liability heavy than other industries. For instance, the airline industry tends to have a ton of liabilities. So judging an airline to another company in an industry that has low liabilities can make you think the airline may be worth less. So it's important to always compare both with general guidelines and industry guidelines and competitors to see where a company lands as far as these ratios. So a current ratio of less than 1 is generally bad. That means that the company has a lot of liabilities compared to its assets. Now let's show how you find these numbers within the financial statements here. So we need current assets. In order to get current assets, we go to the balance sheet. We remember what the balance sheet does. We scroll down a little bit here to total current assets. We see it's $7.6 billion. And then we need total current liabilities. So we're going to scroll down here and look for total current liabilities. And we got 4.23 billion assets divided by liabilities. One thing to look out for, make sure you're actually looking at current liabilities, not total liabilities. Those are completely different numbers. Total liabilities, you can see that is much higher in this case. Next up is the P/B, the price to book ratio. This tells us how a market values a company compared to the value of its assets on the balance sheet. So the market capitalization of the company compared to if there was an asset sale, how much those assets could actually sell for. In order to calculate the price to book, you take the stock price and you divide it by the book value per share. Now this one's a little bit harder to calculate than the last two that we described, but it's still not too bad. So book value per share has a calculation in itself. In order to calculate that, you need stockholders' equity minus preferred stock. Now many companies don't have preferred stock, so in a lot of cases it's just going to be stockholders' equity, and then you'll divide that by shares outstanding, the total number of shares in the company. And a price to book of under 1 is generally considered a bargain. So first off, we need to find stockholders' equity. So in order to do that, we're going to go to the financial statements, go to the balance sheet, and we're going to scroll down here towards the bottom, and we look for total shareholders' equity. It's $15.25 billion. And then we need to find the preferred stock, and we can see the preferred stock is right here. This company does not have any preferred stock, so we just use shareholders' equity, $15.25 billion. And then we need to divide that by the total shares outstanding. On the case of Market Watch, then you can just go to the company overview, and it'll tell you the total number of shares here, and that is 294.77 million outstanding shares. So it's just that equity divided by the total number of shares, and you got your ratio. Next up, we have the D to E ratio, or more commonly called the debt to equity ratio. This tells us the level at which a company is taking on debt relative to its net assets. So a high debt to equity ratio means the company is aggressively financing its growth with debt. It's taking on debt in order to grow as quickly as possible, which of course increases the risk in that investment. So the D to E is calculated by the total liabilities in the company divided by the total shareholders' equity. Maybe pause this and go on a financial statements and just see if you can find total liabilities in the balance sheet and then come back to this video. Okay, you back? Also, a D to E of around 1 is generally considered good. However, this can vary again by industry, so you always want to compare, but over 2 is considered risky. Now let's show how we calculate this. So we need total liabilities. In order to do that, we're going to go to the balance sheet and then scroll down to liabilities and shareholder equity. And then we want total liabilities. Remember, not current liabilities in this case, total liabilities, that's $19.07 billion. And then we divide that by total shareholders' equity, which we can find right here, $15.25 billion. And there you go. Also, one important thing to point out with financial statements, we're going off of the year of 2020, but as of right now, there's actually 2 quarters that have come out with this company, their quarterly earnings. So that means the calculations that we're doing are based on 2020 numbers, which may not be the most up-to-date numbers. If you want the most up-to-date numbers, you're gonna have to go to the quarterly numbers, and in some cases, you will have to multiply quarterly numbers by 4, or depending on how many quarters you have, or go back quarters and add numbers in order to create a whole year, if you're trying to get the most recent ratio possible. Now, many sites will offer these ratios as well. You don't have to always calculate them yourself, but it's important to understand it, and sometimes it is hard to find these ratios, so understanding it makes your life a whole lot easier when you're really trying to dig into a company. Now we have return on equity. This tells us how good the management is at returning a profit on the equity available to them. How much profit can they make on their existing equity? In order to calculate this, we take the net income and divide that by the average shareholders' equity. And with this one, you want to be in line or higher than competitors. This is a very important one that you compare to competitors, and it's a very useful metric. So let's show how you actually find the numbers here. In order to find net income, you go to the income statement, you scroll down, and you'll see net income. We see $2.06 billion. Now we need the average shareholders' equity. So this is if you're looking for a specific period, a return on equity, you'll want the beginning number and the end number, add them together, divide them by 2, get the average. But if you are just looking for a singular date, like the year of 2020, then you can just use shareholders' equity, which of course we know where that is at this point. We scroll down here, total shareholders' equity, $15.25 billion. Now the last ratio that we're going to cover is the return on assets ratio. It's important to note this isn't all the ratios. There are so many, it's basically unlimited the number of ratios there are. These are just some of the top ratios. But now that you understand how to find the basics here, you'll be able to calculate other ratios on your own. So the return on assets ratio tells us how well a company can generate profits from its assets. This one is extremely important in my opinion. So the return on assets ratio is calculated by taking the net income divided by the total assets. Now over 5% is generally considered good, but again, you're going to compare this to competitors. Also, it's important to note that some industries naturally make more money with fewer assets and are worth more because of it. Now let's find how we can calculate this. We're going to go to the income statement, find net income. We know where that is already. Net income right here, $2.06 billion. And then we need to go to the balance sheet and find total assets. So it's net income divided by total assets. So we're just going to scroll down about midway here, and we see total assets, $34.46 billion. And there you go, your return on assets ratio. Now, I said the return on assets ratio is extremely important, and that's because some industries naturally make more money with fewer assets and are worth more because of it. A business that earns more money on fewer assets is going to be valued higher because it's easier to earn an extra dollar in profits. So I made this example to help highlight why this is true. So we're really breaking down this ratio. So we have 2 companies. We have Timothy's Trucking Company and we have Pamothy's Programming Company. So Timothy's Trucking Company has $100,000 in assets and $20,000 in net income.
with a return on assets ratio of 0.02. Pamothy's programming company, she has very few assets. All she needs is a computer, a keyboard, general stuff, and she can do her programming. So she only has $10,000 in assets, but makes that same $20,000 in net income. That means her return on assets ratio is 10 times higher than Timothy's trucking. Now, what does this mean? You can kind of picture this if we reverse the ratio, if we turn it into an asset to income ratio. If we look at it in terms of asset to income, $100,000 divided by 20,000 is 5. In this case, it's 0.5, 10,000 divided by 20,000. So what that means, in order to earn an additional dollar in profit, on average, there's some economies of scale, but in order to earn an additional dollar in profit with Timothy's trucking company, he has to spend $5. He has to spend $5 on assets in order to earn $1 in net income. With Pamothy's programming, she only has to spend 50 cents on new assets in order to earn an additional $1 in net income. Now, of course, like I said, there's different economies of scale and that it doesn't always go in a linear fashion, but you get the picture. Naturally, the more profit you can earn on fewer assets, the more valuable the company is because it takes less money in order to earn more money. Well, I somehow managed to chip my tooth in that last section. My front tooth. I don't know how I managed to do that, but either way, the show must go on. So now we need to narrow down our choices. We understand what stocks are. We understand financial ratios. We understand financial statements. We understand what risk is. So we need to take all of this and put it into a real world example, narrow down our choices, and understand which company we may want to think about investing in. So we're going to do this kind of Warren Buffett style, how he would take a look at a company, whether it's valuable or not, and then do a competitive analysis to see, does this company have a competitive moat around it? Is it hard for other companies to beat this in the long run? Because Warren Buffett would want to buy for a relatively cheap price, buy a great company, hold on to it forever through the grave. So we're going to narrow down our choices. In order to do that, the easiest way is by using a stock screener. So here in the computer, we are up on FinViz on their stock screener. I really like this stock screener specifically. And I put in some criteria to narrow down our choices because this starts with every single public company and you want to narrow it down to just the few that you really want to look at because we're going to spend a lot of time digging into the financials and what this company is all about. So you want to make sure that you're starting with a company that has good chances of you wanting to invest in it. So just covering the criteria quick that I'm looking at here. I did the market cap over $300 million, which is pretty small. Dividend yield over 2%. We know what dividends are. I did the country USA. Now you may want to do foreign countries. You may want to do a completely different search. This is just a Warren Buffett style search. And if we go up to the fundamental tab, this is where we use the ratios. So we're looking for a PDE of under 15, a current ratio of over 1.5, a price to book of under 2, and that's it. Just those few criteria, that narrowed down every single stock in the entire stock market to 14 options. 14 options. From here, we can take a look at these 14 options, choose maybe 5 or so, and really dig into those 5. Now, we can see Tyson Foods, that company that we were talking about earlier, is on here. So of these 14 companies, the one that jumped out to me as most interesting was Viacom. So I went ahead and put all of the data from Viacom onto this spreadsheet. I pulled all the data, put it on this spreadsheet. Also, if you like this spreadsheet, after we do this little analysis, the download link will be down in the description. It's completely free. All I ask for is a like, a subscribe, maybe a share on this video. You know, it's up to you. So the first part here is just the basic stock screener criteria. We're familiar with all of these ratios. We're familiar with everything here. And we know that Viacom hits these criteria because they were as a part of the screener. So we know that. And then we have the competitive advantage aspect. Warren Buffett looks for a competitive advantage. Is there a moat built around this company that is hard to beat by competitors? So there's a lot of different ratios that we can use in order to help determine, hey, does this thing have some sort of competitive advantage? The first one is gross margin. I have notes here all on the sides as to what each of these is. So gross margin used to analyze a company's efficiency in producing and distributing its product.
and how this is calculated. So we have a gross margin here of 39%. SGA to profit, that's selling, general and administrative to profit. With this ratio, you want to take a look at the financial statement and make sure that it is relatively stable over time. If the selling, general, and administrative is staying the same but profits are increasing, that is a great sign. Research and development to profit, in this case, they didn't have a whole lot of R&D. Depreciation to profit, we have a ratio of 40%. You want to do a competitive analysis for this. So you'll want to pull their closest competitors and see, hey, how do they fare? Receivables to sales ratio, 27%. Again, you want to compare that to competitors. Return on assets ratio, we're at 4.39%. We really want that up over about 5%. But with this, it doesn't have to hit every single one. It's more like a grading scale where the more the better, but if it misses one or two, that can potentially be okay as long as it makes up for it in a different area. Return on equity ratio, we want this between 15 and 20%. We're sitting at 15.03. That is great. And again, you want to compare all of those to their closest competitors. That way you really see where they stand. Because if you have a company that is in a healthier financial position than its competitors and it's selling for a relatively cheap price, that is a company you may want to buy. And then we have a few other things here. Interest expense, how much are they paying on their debt? You can find this on the income statement. What is their net income compared to revenue? 9.1%. Again, you want to compare that to competitors. What are the earnings per share? So earnings per share, you really want to see that stable stair step over time. I wrote chaotic here because with Viacom, they're kind of all over the place, but they are trending upwards. Cash on hand, 2.98 billion. Cash on hand can mean a couple things. It either means the firm has a competitive advantage, which you want to see, or the company sold off a business or a ton of bonds, which could potentially be bad. Inventory, with this company, they don't have a ton of inventory, but if you see the inventory increase and net earnings increase at the same time, that is a great sign. Goodwill, typically, if you see a big jump in goodwill on the financial statements, that means that there was some kind of acquisition. So that's something to consider. Additional stock, if you see treasury stock, that's a good thing. That means the company is buying back their own shares, which effectively means your shares are worth more money. Preferred stock generally isn't great to see. Generally, great companies don't have preferred stock. And then investments and debt. I like to see a company who can pay off all of their debt with net earnings in 3 to 4 years. So in this case, it's 9.22. So it's not the greatest, but sometimes other ratios can make up for pitfalls like I mentioned earlier. But then this isn't the full picture. You want to take this, you want to compare it to competitors, you want to compare it to industry averages, and you also want to compare that industry to other potential industries that you can invest in because you want to put your dollar in the area that has the greatest odds of future success. So there's a few other things that we want to take a look at when analyzing a company. First off, who is the management? If you go onto this company's website, on any public company's website, you'll be able to find leadership. I like to look at the leadership and see what they've done in the past, especially if there's new leadership. I really like to see who they are, what they're all about, because they're the ones who are leading the ship. I also like to take a look at competitors, like I've mentioned, industry analysis. You can a lot of times type in the industry and see what the growth trends are and the projected growth trends. If the projection is very high, then it may be an industry that you want to invest your dollars into. News catalysts. I really like, before I buy a company, to check out basically all the news articles I can find within the last 6 or so months, just to see what's going on, what's up with the company, is there drama, what's the general consensus. And then earnings calls. This is huge. Every quarter, public companies do an earnings call where analysts can come in and ask the executives questions. I can't stress how great it is to listen to these calls because you can actually get a sense of the executives, where they're at, and kind of almost who they are as people. And it gives you a lot more context around the numbers that we're looking at. It is extremely helpful. So I strongly recommend taking a listen to a couple earnings calls before you dive deep into a stock. And if you do all these things, is checking all your boxes, then maybe you want to make a solid investment in whatever company that you're narrowing down if you're aiming for a value investment. Now that we understand fundamental analysis when analyzing stocks, we need to talk about technical analysis. This is the type of stock analysis that someone like a day trader would use in order to find which stocks to buy and sell on any given day. Now, a technical analyst attempts to evaluate what will happen next in a stock's price by studying its past. They believe that the past price action can be very telling as to what could happen in the future, both in buying and in selling, betting that it could go up or could go down. Now let's talk common items taken into consideration when using technical analysis to determine what's going to happen next with a stock's price. The first one is price trends. Is the price of a stock trending upwards? Is it trending downwards? Is it trending sideways or flat? And will that continue into the future? The next is chart patterns. Many technical analysts believe that price action moving in specific ways can tell us what will happen very likely in the future. Then we have moving averages. What is the average price over a given span of time? That could be 30 days, that could be 200 days. What is the average stock price compared to the current stock price? Then we have support and resistance levels. A lot of times when you're looking at a stock, you'll see the price bouncing up and down on the charts. Let's say it's at $22 right now, and you've noticed at $20, every time the stock goes down to $20, it tends to bounce back up. That would be called a support level. Now, if it was at $22 and you've noticed that every time it hits $24, it bounced back down, that would be called a resistance level. And then finally, we have volume of shares traded. An increase of the volume of shares traded could mean that the volatility of that stock, the likelihood of it going up or down, increases as well, which means that stock could dramatically trend upwards or downwards as a result of that increased volume. So now let's say you've done your due diligence, you've dug into the financials of a stock, and you're thinking, you know what, I want to buy some of this stock. I think that this stock's going to go up. But how do you actually make a purchase? So we're going to discuss this. Let's discuss the top two most common order types. We have market orders and we have limit orders. By far, market orders are the most popular. This is an order to buy or sell immediately at the current prevailing stock price. Now, it's important to note that the last posted price is not necessarily the price that you'll actually pay due to market volatility and the liquidity of the market. It could fluctuate. Now, this generally is not a big deal, especially for smaller orders. You're likely going to pay within a couple cents of whatever the price says currently. With extremely large orders, then you can have prices executing at various price ranges or price points, and your order might not be exactly what it says on your brokerage. And then we have limit orders. A limit order is a buy or a sell order that will execute if the price reaches a specific number. So let's say the price of a stock that you're looking at is $20 and you want to sell some if the price happens to hit $25. You could set a limit sell order at $25, and then once the price hits $25, your shares will automatically be sold at that price point. Now, it's important to note that a limit order is not guaranteed to be executed, because if it never hits $25, then it simply will not execute. So in order to explain this further, let's go over to a brokerage and I will do this step by step so you can see me actually making an order. And this is a brokerage called Webull. If you don't have a brokerage yet, if you're looking for one, or if you want some free stocks, they are linked down below. They actually have a promotion going on as of the recording of this video that gives you 2 completely free stocks valued between $30 and up to $2,000. It's more likely to be around $30, but hey, it's still $30 free. All you have to do is deposit $100 into your account, and they send you 2 free stocks, plus they send me a free stock as a thank you for sending you their way. So let's do a couple orders here. We have Palantir up. So in order to find a company, you want to type in the ticker symbol here. We have Palantir, and we're going to buy 10 shares as a market order. So we're fine with the prevailing price right now. We're fine to the price of $25.37. The time in force, we're just going to leave that on day. And then you just click place order. It's really that simple. If you wanted to sell, you would just have it on sell. It would sell at the prevailing rate if you happen to hold shares. And you just click place order. Now let's do a limit order. Okay, we want to buy 10 shares again, but we're going to do it this time at a limit price, let's say, of $24. If the price goes down to $24, we want to buy 10 shares. That's effectively what it's saying. Now, time in force, we have some options here, either day, or we can do good till canceled. With day, if the order is not executed by the end of the day, it will be automatically canceled. With good till canceled, it only cancels once you manually cancel it. So we're just going to leave it on day, and then you just click place order, and this would execute if the price dropped down to $24. Conversely, if we wanted to sell, let's say at $27, if we wanted to sell our shares, we'd just type in 27, we'd leave it on day, place order. If the price happened to go up to $27, it would automatically execute that sell order. So it's not too confusing. It's pretty easy, especially with this brokerage. They make it pretty darn easy. Most online brokerages are fairly easy to buy and sell your stocks. Now let's talk about everyone's least favorite subject, Taxes. Because, you put in your due diligence, you understand the stock market now, you valued a stock and you found a bargain, you bought that stock, and now you're ready to sell, you sold for a profit, and you still need to pay taxes on that profit. So we're going to talk about how taxes work when you sell a stock and how taxes work when you get paid a dividend on a stock. And then we're going to cover some strategies on ways that you can save some money on your taxes in your investments so you don't have to get crippled and crushed like this guy. I tried to make it my face on this little cartoon that I drew, but I ended up looking like a thumb. I went with this guy instead. So let's get into it. Capital gains taxes. This is the taxes that you pay when you sell your stocks. There's two kinds. There is short-term capital gains tax and there is long-term capital gain tax. So in the short-term bucket, this is tax on the profit from a sale of an asset that you held for less than 1 year. The taxes, if you hold less than 1 year, are higher than if you hold longer than 1 year. So if you buy a stock and 6 months later sell it for a profit, you're going to pay more in taxes than buying a stock and selling it a year and a half after your purchase. If you hold less than 1 year, you pay taxes at your normal income tax rate. And then long-term capital gains, the tax that you pay on the profit of the sale of an asset that you held longer than 1 year, is significantly less. In some scenarios, 0% depending on your income. We're going to break down both of these even further. So short-term capital gains. Under a year. This is a chart that breaks down the rate that you pay, the rate in taxes on your gains based on your income and your tax filing status. So if you're single and you make between $40,126 and $85,525, you're going to pay 22% on your gains. If you are married filing jointly and you made between $171,000 and $326,000, you're going to pay 24% on your gains. If you're married filed jointly and you earn under $19,750, then you're going to pay 10% on your gains. So you can see the taxes are fairly high when paying short-term capital gains. That's what makes it even harder to day trade and to do short-term trades, because not only are you not getting the compounding effect of your money making money for you, you have to pay taxes on every time you win, and it's hard enough to win as is. So then we have long-term capital gains. It's a little bit more simple with taxes on long-term capital gains. So we have the filing status again and the rate that you pay. So if you're single and you earn up to $40,000, your rate is actually 0% long-term capital gains. If you're single and you make between $400,000 and $441,000, a huge range there, you pay 15% long-term capital gains. So we compare that to the short-term, this is significantly less. If you're married filing jointly, you can make up to $80,000 and pay 0% long-term capital gains. Buying and holding is the best strategy tax-wise. It's the easiest to win tax-wise. And then we have dividend taxes. So there's two different kinds of dividends. There's qualified dividends and there's non-qualified dividends. Just about any company that you're investing in is going to be qualified dividends, with the exception of REITs. If you happen to be buying into a REIT, beyond a REIT, it has to be a fairly complicated or fairly unique investment to fit the non-qualified dividends area, but we're going to cover it either way. So qualified dividends, the taxes on your qualified dividends are paid at your long-term capital gains rate. So those lower rates, you can go back to that chart if you want to compare what exactly that would be. Qualified dividends are dividends paid by a U.S. company, a company in U.S. possession, a foreign company residing in a country that is eligible for benefits under a U.S. tax treaty, or a foreign company that has a stock that could be easily traded on a major U.S. stock market. So you can see most companies that you would invest in fit within the qualified dividend criteria. And then we have non-qualified dividends. With non-qualified dividends, you pay your taxes at your short-term capital gains tax rate. So whatever your normal income tax rate is, that's what you pay on your qualified dividends. Some examples here are REITs, real estate investment trusts, a MLP, which is a master limited partnership, and dividends on employee stock options. And those are just a few of the more popular examples of non-qualified dividends. But again, most of them are qualified dividends. Now from here, let's talk about how you can legally avoid a little bit of that tax burden by using a retirement account. We're going to break down the two most popular retirement account types. The first one is the classic 401k. This is an employer-sponsored retirement plan that allows you to invest a portion of your income pre-tax.
So let's say you had $1,000 that you wanted to invest. You would not have to pay your 20 or so % in taxes first before putting this into a 401k account. And that's why people like these accounts, because you get to invest a dollar amount that is higher because you haven't yet paid taxes on it, but then you do pay taxes when the funds are dispersed after retirement. We'll talk about that in a second. So your investment options with the 401k are a little bit limited, and this varies pretty wildly depending on your provider, but many times you're limited to either mutual funds or ETFs. Your contribution limits are higher on this one than the other option. The limits here are $19,500 if you're under age 50. If you're age 50 and older, the limit is $26,000 a year as kind of a catch up to allow you to build up that account a little bit higher. And one huge benefit with the 401k is your employer can actually match a percentage of your wages as a contribution, especially if you work for a large company. Many of them have some kind of employer match, and it is an awesome way to get some more retirement money. If your company offers that, it's generally a good idea to do so because of the tax benefits, and hey, they're throwing in extra money for you. Why not do it? Now, it's important that you will pay taxes after you retire and start receiving this money. The thing is, though, that the taxes are paid at your income tax rate when you're retired, sometime after you're 59 and a half years old. So many people will opt for the 401k because they feel their tax rate is going to be higher when they're working than when they're retired, which makes sense because you're working and making that income. So hopefully you're paying taxes on a lower tax rate. Now, it isn't a one or the other kind of scenario. You can have multiple types of retirement accounts, especially if you're really balling and you can just max out all sorts of retirement accounts. And that brings me to the next option, the Roth IRA. So this is a retirement plan that is set up directly between you and a stock brokerage. And basically all stock brokerages offer some kind of Roth IRA account. So whatever your favorite brokerage is, there's some link down in the description. You can use them and they have a Roth IRA. It's very common. With the Roth IRA, you have more freedom in your investment choices. You can really invest in anything, any securities you choose. Oh, and something important to mention, just putting money into your retirement account, both for the Roth and the 401k, does not necessarily mean that it's invested. It could just be cash sitting there. So you want to make sure that it's actually invested into something. I've heard of this multiple times. People thought that they are investing in their retirement account and they're just simply sitting there in cash because they didn't think like, oh, I have to actually put this in something like an ETF or an index fund. So that's something important to note. The contribution limits for this are significantly lower, $6,000 per year if you're under age 50, $7,000 per year if you're age 50 or older. So in order to make a full contribution, if you're a single filer, you have to make under $125,000 per year, and then that phases out, that contribution phases out between $125,000 a year and $145,000 a year. And then if you're married filing jointly, you can make up to $198,000 a year to get that full $6,000, and then that phases out to $208,000 per year. And at that point, you can no longer use your Roth IRA account. Now, the difference with taxes here is you pay taxes on your income before it gets placed in the Roth IRA account. So you make that $1,000, you pay your 20% in taxes or whatever your rate might be. You get to invest the $800, and then that compounds, but you don't pay taxes when you receive the disbursement. So no taxes on the back end. So it accrues, you get to pull it out tax-free. Now, it's important to note that it's only tax-free withdrawals if you're withdrawing after age 59 and a half. There are some penalties that can be accrued if you withdraw before that age. Now, I know that it's kind of confusing, the differences between the Roth IRA and the 401k. So here is a chart that breaks down all of the various differences. We talked about a lot of these. Some of them we didn't talk about, so feel free to pause this if you're really trying to decide which one is best for you, and then you can see all the various differences here. But you can do both, and if you choose one, it's not the end of the world. It's not like, it's not like you're gonna go bankrupt if you choose one or the other. So feel free to pause that, take a screenshot, whatever you need to do to make a comparison here. And wow, that is it. That is the presentation. I can't believe I'm finishing this up because got stuff falling over there because this took me so long to put together. You don't even know how many hours this has taken me. You can see my eyes are literally bloodshot doing this. So the question is, what now? And I have some suggestions for you. First off, take the quiz. I made a quiz to accompany this entire presentation. Take that, see what you understand, see what you don't understand, and then maybe watch some sections again that you didn't quite understand on the quiz. And then share the results with me. Tag me on Instagram at Maxwell_Monk
her, tag me, and I will help celebrate your victory if you got a good score on the quiz. Also, continue your education. We're not done yet. I'm not done yet. You're not done yet. Keep reading, keep learning, watch more content, subscribe to this channel because I post tons of stuff like this. Subscribe to other financial channels. Keep on learning. Watch this content again. A suggestion that I have is copy the link to this presentation, put it in your calendar, set a notification for a week from now, and watch it again and see how much you actually remember. Chances are you're probably only going to remember like half of it. And you'll watch it again and you'll maybe understand 75%. And you watch it a third time, you'll probably understand 95% of it. Share this also with someone who you think could use some more financial knowledge or think that they would enjoy this, a spouse, a cousin, your weird uncle, whoever you think could benefit from this. Another option is join our Patreon. We have a huge group of people who are dedicated to learning and investing, and it is extremely helpful to have this community of other people. That way you're not making any rash decisions. I'm on there. I post my buy alerts whenever I do my due diligence and then buy a stock. We have private live streams, there's private content. There's a lot going on there on the Patreon. You'll get this entire presentation. You'll be able to download it if you want. All you have to do is join that Patreon. That's linked down below. Also, show off your knowledge. I think one of the best ways to really reinforce learning something is to explain the concept that you learned to someone else, because it forces your brain to really understand what's going on, and it makes you recognize what you don't actually know, and then you can go back and learn those concepts again. And then finally, grab your free stocks. If you don't have a brokerage yet, if you already have one, there's some free stocks in the links down below. There's some current offers for Webull, Robinhood, and M1 Finance. Webull tends to give the largest amount in bonus by making an account, and then Robinhood and M1 Finance are pretty good as well, but you get free stocks with all of those. So do all those things and you should be pretty set when it comes to the beginnings of becoming an investor. And congratulations for making it through this. And thank you for watching. I enjoyed making this. I hope you found it useful. And of course, I hope you have a profitable day. So I wanted to discuss something that I'm very passionate about, value investing. And this is because I've seen a lot of videos lately telling people to invest in specific things like risky stocks, high-tech startups, cryptocurrencies, gold. I mean, you name it, there's someone out there telling you to invest in it. And which, don't get me wrong, all of these things can generate a return. Heck, they can even generate an amazing return in some cases. However, in many cases, these kinds of investments are usually closer to gambling than they are any kind of educated investing. Yes, if you're a crypto expert and you read all of the updated journals on the new tech that's coming out, and let's say the coin's founder seems to be promising and reputable and you can trust them, this would lean more towards educated investing. However, most people aren't going to spend the time to become an expert in an investment. So by default, most of these things are closer to a gamble than they are an investment for most people. What isn't talked about enough is good old value investing. Why? It's just simply not sexy. I mean, you're probably not going to get a 7,000% return in 2 years, but on the flip side, you're much, much more likely to get a return, period. And it's a much more solid strategy to build long-term wealth. So in this video, I'm going to keep it very non-technical. I'm going to define value investing in layman's terms in the most simple way I possibly can, give an overview of how a value investor thinks and what a value investor looks for in their investments. So starting off, what is value investing? So, I sat and thought about this morning for quite a while, and the most simple way I can define it is it's the process where you, the investor, decide on investments based on which companies you believe deserve more capital, aka your money. So this might seem obvious, like, well, yeah, obviously I'm going to put my money where I think it should go. But that's not exactly what I mean. This is not always the same thing as putting money where you think you're going to get the highest return. Just because something might get the highest return doesn't mean it's the most deserving of your capital. I'm going to get into this. It's going to make more sense. Trust me. So you could assume that gold is going to net you the highest return out of any other investment in 5 years. However, that is different than gold deserving more capital than any other investment. It's because gold doesn't allocate capital in order to generate a return. Gold just goes up in price. So, in value investing, you're looking for a company that has a disparity between how much capital it has and its ability to allocate capital better than anyone else. Its ability to make a higher return than anyone else. But here's the kicker. Here's why it's difficult. Typically, businesses that are able to make the best return on a consistent, stable basis price themselves out of a decent investment. Yes, company A returns more on assets than anyone else, but their price is probably so high, you're not going to make that great of a return at its going rate. So this is where the analysis comes into play. As a value investor, you have two basic assumptions. The first assumption being the market is smart and usually accurate. The second assumption being usually accurate does not mean perfectly accurate. So think about that just for a second. Usually accurate is not the same as perfectly accurate. A value investor believes that the markets are not perfectly accurate because the markets overreact to good and bad news. Good news generates a disproportionately high spike in price, where bad news generates a disproportionately low dip in price. So as a value investor, you are seeking opportunities where the market overreacts and prices an amazing company at rates lower than they should be, lower than what the intrinsic value of a company is, the real value of an amazing company. But thinking a company is undervalued is not enough in itself to prompt a purchase. A real value investor will sit down and look at every piece of data they possibly can find before making the most educated purchase possible. It's tedious, it's boring, it's a lot of work. Warren Buffett, who is probably the most famous value investor of all time, worth multiples of billions and billions and billions of dollars, says you should spend as much time deciding on an investment as you would deciding on a spouse. This is because he wants to buy and hold, creating this proverbial investment marriage where he just owns that company forever because it's so great. So what is an amazing company? An amazing company in terms of value investing includes a few things. An amazing company generates a high return, but not too high of a return. 10 to 15% is great. 200% returns, I mean, yes, that's great, but that's not stable long term. We want long term. An amazing company also has a competitive advantage over its competitors. An amazing company is in a better financial situation relative to its competitors. An amazing company has competent management. And an amazing company is expected to do all these things for the foreseeable future. So, with value investing, the overarching goal is to make a cash-flowing investment in a high-value business with some form of a competitive advantage. Investments that you wouldn't mind making the investment and not seeing the stock ticker for 10 years because you're so sure that it's a great company, they're doing the right thing, they're going to make a decent return whether you're looking at the stock or not. So if value investing has piqued your interest, I'd be happy to dive deeper into this strategy, go over a more technical analysis, go over spreadsheets that I use to compare financials and identify like solid investments. Let me know if that's something that you guys are interested in. If you want to learn more right off the bat, there's a few books that I really recommend Number one being the intelligent investor. Benjamin Graham is like the father of value investing. He does a little bit differently than Warren Buffett does. He aims more at just price and not so much an amazing company, but there's some amazing lessons in that book. And also there's the little book of value investing. That one's a lot easier to read. I recommend both of those. I'll have them linked in the description if you're interested in checking those out. So that's all I have on this for today. I'd like to thank you for watching, and I hope you have a profitable day.
How to dramatically increase your credit score and quickly, and most importantly, for free with no BS. So up until recently, I've never really paid a whole lot of attention to my credit score. I mean, I've had credit cards for nearly a decade and I always just pay them off on time, and I have an 800 plus credit score without really putting any thought towards this. Until recently, I bought a forklift for my business, and I was shopping around for just various finance options. You know, with the interest rates so low, I just wanted to see what was out there. And I applied at one lender and I was denied, and completely shocked as to why I was denied. I mean, the business is plenty profitable. My credit score is great. I mean, there's enough income with the business to purchase this forklift several times over just with cash. So what's going on here? And apparently I was denied because my debt to income ratio wasn't quite what they were looking for. I didn't hold enough debt in order to get more debt. And this did not make sense to me. So I had a realization that I just simply did not understand completely how credit works, and this led me to absolutely dive into this subject. And while diving in, I found some absolute gems that anyone can use to dramatically increase their credit score quickly. We're talking about potentially increasing your score by 100 plus points in just a few months without buying any programs, and like I said earlier, without dealing with any BS. You shouldn't have to spend any money besides what you just normally spend on your life. You just have to switch up a few things. So in my research, I found that there are really 3 types of credit scenarios, and I'm going to address all 3. 3 scenarios where you're trying to increase your credit. My goal here is to make the most comprehensive and easy to follow, simple credit video on YouTube. So here we go. The first scenario, scenario 1, is you have poor credit or okay credit, and you just want to increase your score as fast as possible. Maybe you're looking at buying a house. Maybe there's some other lending that you need soon. You want to bump that up as quickly as possible. There's another scenario where you have 0 credit. You don't know where to start, but you want to get some credit. Maybe you're trying to finance a car in the future. You just want credit for the future and you have none right now. And then scenario 3 is you have okay or poor credit and you're trying to increase that to its highest possible potential, and you're willing to do that in the long term, like 2 to 5 years from now. Each of those scenarios have slightly different options, so we're going to go over each scenario. But first we're going to chat about how your credit score is calculated, because understanding how this works will help build your knowledge here, so you can understand what you need to do to build up this score. So taking a look at this chart, you can see all the various factors that go into calculating your FICO score, aka your credit score. From least important to most, we can see at the bottom of the list, new credit accounts for 10% of your score. Types of credit used is 10% of your score. Basically, like a mortgage is more important than your Buckle Mall credit card, for example. The different types of credit have a little bit more weight, but that's only 10% of your total score. Length of your credit history is 15%. This is how long you've been using credit, and what is the average length of each of your forms of credit. We're going to discuss that a little bit more later. Next, we have the amounts owed, and that is 30% of your score. So that is very important. What is the total you owe, and how much of your credit do you use? What is the utilization of your credit? Now this one makes a huge difference, and you'll see that this comes into play in a big way in a little bit here. And then finally we have payment history, which accounts for 35%, and that one is pretty obvious. Do you pay your debts on time? Do you have outstanding debts? So depending on the individual situation, we're going to focus things slightly different with one exception. You must pay all of your credit bills on time. If you're missing payments, your score is going to stay low. There's just no way around that. You absolutely have to pay off your debts on time. There's no way to miss payments and dramatically increase your score at the same time. So pay off your debts and your credits on time. I can't stress that enough. If you're able to pay your bills on time, you are absolutely able to increase your credit score dramatically in just a few months. So we're going to start with the first scenario here, where you have no credit and you just don't know where to go or how to secure any credit. Maybe you've tried applying, nothing's working. I know that this is the case for millions of people. I've talked to friends and family who have had this issue and they just can't figure it out. And the first and biggest solution here is becoming an authorized user. Now, for whatever reason, this isn't talked about very much, and it's like a true life hack. Now, this is only going to work for some people, though, so if it doesn't apply for you, don't worry. There are other options that will work well, too. This is just kind of like the life hack version. So this is the easiest way. To increase your credit this way, you need to become an authorized user on a credit card or two of someone who has a very high credit score already. So if you have a parent or a spouse who has great credit and they trust you to be an authorized user on their credit account, you can become an authorized user, and within a couple of months, your credit score will take off like a rocket. It will increase hundreds of points potentially, I mean, depending on where your score is at right now. You can't go from 800 to 1,000 because that's not a thing. It's so weird. The bank is basically like, oh, you know Susie with the 800 credit score? Oh, you should have let us know. Here's some credit for here. Let me give you some credit just because you know Susie with the 800 credit score. So this works if you have low credit or no credit, and it seems too good to be true. But there are, of course, risks. If you're signed on as the authorized user for someone, they could potentially be hurt if you use their card and go on a spending spree or cause some issues to them. So there are some risks there, and I know not everyone has this option to be an authorized user. So let's move on to ways that anyone can take their score from 0 to a good or great score. You have to start getting credit, obviously enough. Now, you might have tried applying at various credit cards and you're just simply getting denied because you have no credit. So here's what you need to do. You need to go to a bank, preferably a big bank, like a big name bank, Wells Fargo, Chase, whatever big bank, because they're actually treated a little bit more highly when it comes to credit. Go to a big bank and get a secured credit card. Put a few $100s on it and pay that thing off every single week to a balance of $1 before your statement date. Then when you get your statement of $1, pay that off in full. And I'm going to explain exactly why in the next section of this video, but that's really important. And if you really want to double down here, you can get multiple secured credit cards, or you could get a secured credit card and a secured personal loan. If you really want to double this down, and then do the same thing, pay it off completely to $1 before your statement date, and then pay off that $1 after you receive your statement. One caveat here is if you open several accounts, don't just start spending like you're royalty because all of a sudden you have access to more funding and more credit. Don't spend anything extra. Don't overspend. Otherwise, you're going to get yourself into worse problems in the long run. And really, it's that simple. You just get that secured card, you follow that protocol, you're good to go, and your credit score will go through the roof. And I'm going to go more in depth on that $1 thing just in a second here in this next scenario. So this next scenario is you have okay or you have poor credit, and you're trying to increase your credit score as quickly as possible. Maybe you have a big purchase coming, or for whatever reason you need to try and get that thing bumped up as quickly as possible. This one's a little bit more complicated than the last one. First, you can still use that authorized user trick that I mentioned earlier. If that's applicable to you, absolutely do that, because that will make your score jump up easy. I mean, watching this video alone is worth learning about that trick, because that trick, it's mind-blowing how well that works for people. Next, you want to go to www.annualcreditreport.com. This is a free service. It's not a sponsor. I'm not affiliated or anything like that. And look at your detailed credit report for the big 3 credit agencies, all 3 of them. This is free once per year, so absolutely do that if you've never done it before. Make sure all your reports are completely correct with 0 errors. And if there are any errors, dispute those errors. It's usually just a couple clicks to dispute them. If there's anything that looks unfamiliar, dispute it. Dispute everything. And to highlight how important this is, here's a statistic that I found. The FTC found that 1 in 5 Americans have errors on their credit reports. And 1 in 4 of those people have an error that results in them paying higher interest on a personal loan. So absolutely take a look at that and report any errors. So now we've done that, the errors are disputed. If there are errors and they're disputed, that's going to by itself increase your credit score. Now what you want to do is focus on your credit card utilization, or your credit utilization. This is assuming that you're already paying off all your debts on time, because remember, that is most important. Pay off all your debts on time. Then we're going to focus on credit utilization. So this is a huge factor in how your score is calculated. This is that 30% chunk. This is the percentage of your available credit that you use every single month. So for example, let's say your credit limit is $1,000. If you spend $400 a month and your statement is $400 on each of your credit card statements, that means your credit utilization is 40%, which that doesn't sound so bad, but how this is calculated, they look at that as bad. To have the best possible results, you want that credit utilization under 10%, and really 1% is ideal. And you might be thinking this sounds ridiculous, and I agree, it seems absolutely ridiculous that 1% seems ideal. Who in their right mind could spend 1% of whatever their credit amount is and still survive? But I don't make the rules here. I just found some workarounds that you're going to be able to keep your current level of spending while fixing your utilization and bumping up that credit score. So there are two ways to keep your current level of spending but fix your utilization. First, you can increase your credit availability by either opening new accounts or requesting higher limits on your existing accounts. First, try requesting higher limits, but opening new accounts initially will drop your credit score. So if you're trying to bump this thing up as quickly as possible, you probably don't want to open new accounts. So what we're going to do is work the system by playing by its rules. This is what I mentioned earlier. You can kind of trick the credit utilization system by paying off your credit card every single week as opposed to every single month, and then leaving that total balance to $1 before your statement. So let's say your statement happens on the 30th, you're going to leave that at $1 on the 29th, then your statement goes through at $1, you pay off that $1 completely. And the reason for this is most major banks report your credit data to the credit bureaus after your statement date. And by having a balance of $1, they're going to report to the credit agency that your credit utilization is around 1%. And this is going to dramatically increase your score. This is where people see their score go from 600 to 650 in 2 months, or 600 to 725 in 4 months. And it's honestly, it's kind of insanity. So I cannot stress enough how important credit utilization is. So here, do this. Set a reminder on your phone and title it Max Says Check Your Credit Score. And for the next 4 months, follow that protocol of paying off your credit cards weekly. Every single week, pay off all your credit cards and then leave a $1 balance before your statement date, and then pay that in full after you receive your statement. And 4 months from now, when that alarm goes off, come back here and let me know what your credit score increased to. Let me know what that increase was. I'll be waiting, and you know what? I'm excited for you in 4 months from now when you see the results, because it's going to be mind-blowing. All right, now the third scenario. This is the scenario where you have okay or poor credit, but you want it to be as high as possible in the long run. You don't need it to jump up super fast right away, and you're willing to take some short run hits in order to have the highest score possible years from now. If we're focusing on the long term, we don't worry about those little hits of opening new accounts. So with this, we're really building on everything we already talked about and adding a few additional steps. So number one, you can become an authorized user on the account of someone with good credit if that's available to you. Do that if it's possible. Number two, check annualcreditreport.com. Report any errors, any and all errors. Number three, and this is where things start to differ. Open new credit card accounts at large banks. Again, large banks are a little bit more attractive when it comes to calculating your credit score than a relatively unknown bank. It's probably not going to make a huge difference, but for sure a bank is going to be more effective to increasing your credit score than like a store credit card would be, like a Walmart credit card or something like that. And you want to have 3 or 4 lines of credit open. This will help your utilization and show that you can juggle more than one account and you're a more reliable debt payer. But this is going to temporarily dip your credit score when you open new accounts. This is because of the age of your accounts. Remember, that was a factor. You want the average age of your accounts to be as high as possible. Well, if you open new accounts, that drops down the average, but in the long run, you're better off that way and your utilization is a little bit better. Now, number 4, call your existing credit cards and request an increase in your credit limit. Again, this will help out your utilization. Number 5, use that credit utilization trick where you pay off your credit card weekly. Leave that at a $1 balance right before your statement, then pay off that $1 balance after you receive your statement and just do that. Not only is it going to help bump up your credit score, but you're also going to have a better idea as to what you're spending, so you don't just receive this bill at the end of the month and you're like, oh geez, I overspent. So now every week you're seeing this thing and you're like, okay, I gotta calm things down a little bit. And now you have a much better understanding of how the credit system works if you watch this video. So I'd like to thank you for watching. I hope to hear back from you in 4 months from now, and I hope you have a profitable day.
You can become a millionaire through real estate. There's a simple 8-part equation I personally followed to make $80,000 in equity every year for the last 5 years from just one property. And I'm going to show it to you. But there's a few things I want you to know up front. Number 1, saving money, being patient, and building your credit. Those are all your best friends in real estate. You need all 3. You'll see why in a minute. Number 2, making millions in real estate is not a get-rich-quick scheme. The math is essentially foolproof. Anyone can understand it, but it's still hard work. You have to remember that. Number 3, just as easy as you can make a lot of money, you can also easily make mistakes and lose money, things you must avoid. This is real estate investing for beginners. I'm going to break down how to make millions in real estate, the problems that people make that make them lose money, as well as the method I personally use to make over $400,000 in equity from one single property, starting with the money-making matrix. You've probably heard about the 4 key ways of making money in real estate. They all flow into one another, creating this big matrix formula. The 4 keys look like this. You make money as your property appreciates in value. You make money as you pay down the loan on your property. You make money as your rental property provides you additional cash flow. And finally, you make money from the tax benefits that come with the property, allowing you to keep even more of the money that you make. Each one feeds into the others. The more you pay down the loan on your property and the more your property appreciates in value, the more equity you have, which is the difference between the 2 figures. Let's say you have a property that's worth $500K and a loan paid down to just $100K. You have $400,000 in equity in that property, money that you, not the bank, will get when you sell. Not only that, but the more your property profits in cash flow, the more money you'll have to improve the property, helping it appreciate, or pay down your loan faster, helping to increase your equity even more. On top of that, tax benefits mean you get to keep even more of the money you make, giving you more money to feed this cycle even further. So it's a simple, bulletproof investment, right? Not exactly. I'm going to show you my 8-step process in a second, from the most important step that you can use literally today all the way to the exact properties you need to buy. At first though, the real estate business seems obvious. Just find a cash flowing property, watch it fill your pockets with money, repeat until you're a millionaire. Pop bottles, buy a super yacht, go hang with Jeff and the gang. Except that's a fantasy. In real life, it's not quite that simple. Like, sure, the 4 key ways do all work together and you should use them. But in real life, you're going to face 2 major problems. Most good, experienced real estate agents will tell you this. You have to be skilled to find that diamond in the rough, the property with massive cash flow potential. You have to be lucky to get in on the wave of appreciation. Like, yes, you can do market research and determine your best chances of appreciation, but you can't bank on it. That's not a good business strategy. And you'll see pretty quickly that if your property doesn't cash flow and it doesn't appreciate, then this whole millionaire plan completely crumbles and falls apart, leaving you with a dud investment and a mortgage to pay off.
Not a great plan.
In order to avoid these problems, you need a system that helps you find cash flow positive properties and helps you avoid the mistakes that are inherent to being human. Getting overly excited about buying stuff. We all do it. You'll do it. And because I'm a YouTuber, I've got an equation to do just that. Quick but relevant story. When I was younger, I dropped out of college to try my hand in the world of business. But at the start, I made one choice that continues to benefit me to this day. Like,
every single day. I went to the library and read as many finance books as I could possibly get my hands on. It wasn't glamorous or fun, it didn't make me any immediate money, but it worked. It taught me concepts and strategies, like I said, that help me to this day, whether it's reading cash flow statements or income statements or just understanding the general rules of the finance game. This knowledge gave me a whole lot of initial confidence that helped me get out there and make good decisions later. For you looking to get into the real estate game, it's no different. You need to read great books on real estate. This is one of the key steps for avoiding the problems that I outlined earlier. One good book can literally change your life. There are other super important steps I'm going to take you through, such as understanding the market, but for now, if you want to make money in real estate, you have to take this pursuit seriously and do some learning beforehand, which you're already doing, watching this YouTube video. But I can only go so deep into the nitty-gritty details on a YouTube video, so you'll still want to pick up a good old-fashioned printed paper book, or a Kindle if you're into that weird shit. Here's some books I'd recommend. Links will be in the description. And then once you're done reading, you're going to need to If you want to get into properties, you're going to need to make a down payment, which takes a whole lot of cash. For most properties, you need 15 to 20% of the property value up front. I'd aim to have at least 20%. This means if you're looking to buy a $500K property, you need a $100K down payment. That's a lot, but it's also the reality, so what are you going to do? However, the more you put down on the property, the bigger your safety net, and you want to emphasize safety. I have a major safety tip later that you got to follow. So to do this, you're going to need to prioritize saving money, and on top of this, you'll likely get a mortgage from a bank, so you must have a solid credit score. The higher it is, the more likely you'll get a good mortgage with good rates. Aim to build that to at least 740. And here's something most first-time real estate investors aren't aware of. Your credit score, like the one that you see when you log into your bank account, that's not the same score that mortgage lenders use. I'm actually in the process of buying a new home right now and ran into a major issue because of this. It's a long story, but Citibank made a mistake on a credit card account of mine and tanked my score by like 100 points, from like 810 to 710. Let's just say I won't be using Citi credit cards again, but that aside, I thought the credit issue was cleared up as my score was slowly climbing back. It's now showing like mid 700s. However, that's my regular score. So when my credit was pulled by the mortgage lender, the error was still there, dramatically, terrifyingly hurting my mortgage lender score. So I did a bunch of digging to figure out how I can actually see the mortgage lender score to try to fix this thing, and the easiest way is through my FICO. Unfortunately, it's a paid service. It's like 30 bucks, but it saved me thousands of dollars because I was able to fix the issue before the loan was finalized. Let me show you what I mean. Here you can see my regular scores. Then I go to mortgages and I'm screwed. They're way lower, meaning my mortgage payment will be much, much higher. The only saving grace is I was able to fix this and my score should bump up within like a month or so. If you're curious about your true score, I'll have my FICO linked down below. But the moral of the story here is watch your credit closely. Don't take on unnecessary debt, and watch out for Citibank. Then, everyone has their dream home, meaning when they get into real estate, they can't wait to dive in, see properties, and lose their mind when they see that perfect white picket fence and 2-car garage. But this is the worst way to go about real estate investing. There's a big reason why, and I'll get to that in a second, but first, your immediate issue is that you have no idea what you can actually afford. Your expectations of what house is perfect for your real estate portfolio might be way off, leaving you wasting your time.
Give me rent.
You'll get your rent when you fix this damn door!
Instead, get as much information about your employment, income, and assets for at least the last 2 years, and then go speak to a lender. Show them all your info and make sure your books are as accurate as possible. Otherwise, they'll be giving you lending estimates that aren't representative of what you can actually afford, which is a giant waste of time. I'm stressing this because one of the most important parts of real estate money making will be the mortgage that you get. If you struggle to get a mortgage, you're dead in the water. Lenders will typically estimate the PITI, principal, interest, taxes, and insurance, before giving you a solid offer. So you want to do as much as possible to help them make this accurate. Oh, and by the way, I know all these steps can get a little bit overwhelming, so I made a free checklist for this video that'll be linked in the description, which brings us to the next insanely important section.
Nope, you're not buying just yet. Now you need to see which properties are out there so you can get a sense of what the market is like for your particular budget. You need to see enough properties so that you know what's overpriced, what's underpriced, and what's a fair price within your market and within your budget. Ultimately, you're looking for a good deal. And you're building the confidence to be able to spot a deal and recognize when you see it, that's a spanking deal.
Thank you very much.
So there's another reason for this as well. And it's why I told you not to jump into looking at properties. The reason is for every property you like, there's dozens of people that like that same property because chances are it's a hot property. So you need options in order to secure a property. Otherwise, odds are someone's gonna beat you to it. This just happens. Seeing lots of properties doesn't just mean, visiting houses and comparing one with another. That'll help you get some understanding of whether you're getting a fair price for your budget or not, but you have to think about cash flow. Cash flow is rental income, your profit after expenses. So you want to determine what kind of cash flows are coming in for properties, again, within your budget. Start with the assumption that most properties are complete duds, and then look for reasons why they may be profitable, instead of just assuming all properties are profitable. Check out rental sites to see what kind of rents on similar properties in your area are making. That's super important. And then estimate what you'll be spending on your mortgage, taxes, and insurance. Now, these rates can vary a little bit depending on who you are, your credit, your cash up front, and the property location. But a good starting point is this website, Smart Asset. It'll give you a very rough estimate of the potential expenses. You'll want to double verify all those numbers though. If what you see looks good, double verify it. Please always do that. And beyond that, include a budget for repairs and maintenance. Things will go wrong and they'll eat into your cash flow. A simple guide for repair expenses is the 1% rule. Maintenance will cost about 1% of the total property value every year. So if it's a $500,000 property, a good starting estimate is $5,000 in annual maintenance expense. Make sure to fit that into your cash flow calculations. This is the super boring part, the number crunchy part of the process. But if you're going to do the next steps, one of which is that amazing tax trick, then you're gonna have to do a good job here. All your profits come down to these calculations at the end of the day. You're gonna wanna, 3 years from now, 5 years from now, you're gonna thank yourself for doing all that math up front. Now, once you have the total expenses figured out, compare it to the rental incomes to see if your income is higher than your expenses. If it's not, then you're looking at a dud investment, which will give you a terrible cash-on-cash return, and it's just gonna be a struggle. Just avoid a struggle when you can. Now, cash-on-cash return, this is the return on the actual amount of money you invested into the property. Naturally, you want this to be as high as possible and to be, positive, not negative. Here's my example. I bought a property when I was 21. I thought the market was high at the time, which isn't a great start, but the area was perfect, and I did it in such a way where I had essentially zero risk. So I was really confident in this property. I did a little bit of house hacking, which meant I was living in the house while also renting out the other rooms at the same time. After a few years, I was actually profiting by living in my own house and building massive equity every single year of ownership. Like I said, $80,000 for every single year I've owned this house. I now moved across the country to Puerto Rico, but I still rent out the rooms. And I keep one open for myself for when I'm back in town. Simply renting a few rooms in this house brings $2,700 monthly. Mortgage and insurance costs about $1,700. Other expenses are like $200 a month. So it's cash flow positive. And I still have a place to stay when I'm back in town for business. And, the house has appreciated 13% annually, earning me over $80,000 in equity every single year for the last 5 years. That's the power of real estate. Now, I'll eventually sell it and roll those funds into commercial real estate, specifically a storage facility, which I've been learning a ton about, read books. But back to you, right now I really need you to remember this rule. If you want to make money in real estate, don't ever buy a property that doesn't bring in more than it costs. Super simple. I guess these equations are simple, but actually making them and following through with them, that's the tricky part. And you're only ever going to be able to cash flow on properties if you put in the hours to search for them up front. Do the work up front. You don't want to try to figure this out later. Now, the one exception here is value add opportunities. If you find a property that needs a little bit of work and you fully understand how much is needed to complete that work,
this can be an excellent cash flow strategy. That's where you can make a ton of money, but again, you just have to have the skills in place, and you have to have the time to figure out the problems that will inherently pop up. Now, all of this brings us to a pretty important step. By now, you've followed a strategy that will help you mitigate the risks of making money from real estate and take advantage of the money-making matrix that I outlined at the start of this video. So you should have identified a few properties that are relatively good deals for your budget and have positive cash flow potential. If you have, now it's time to start making offers. This is the fun part. This is where it becomes a bit like playing poker. Once you've put your chips in, don't get emotional, don't overpay, just see what happens. You won't get every property that you make an offer on. That's just part of the game. People are going to outbid you, offers will get rejected, it just happens. Regardless though, you gotta keep your head clear, be a professional, and make sure you're paying a fair price. Don't panic, don't pay too much, and don't obsess over a specific property. It can get really easy to obsess. If you've done all that work, and then it's like, oh, I could just pay like 40 grand more and then they'd be mine. No. Don't be emotional. Research, 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 smart offer, do it again, be patient. That's the key. Bonus tip, buy your property under an LLC. That will protect you. People can sue you for all kinds of reasons, especially if they get hurt on your property, which will happen if you get enough properties, someone will eventually get hurt. For under $100 in most states, you can set up an LLC. This will save you thousands, if not hundreds of thousands of dollars if an issue ever arises. I set up an LLC for every single business and service I start. I've been using this company called Northwest Registered Agent to do it. You can set up an LLC in literally a few minutes. I'll have a discount link for them in the description. I just can't stress the importance enough of that legal protection. Super important. Now, let's say you've bought a great property. Let's move on to the next crucial step. This part, super simple. Get the property in good condition, get professional pictures taken, important, and get it listed. Once people respond to your ad, show them the property ASAP. Rentals happen fast. Your house is your product, so make sure your product is flying off the shelves. Don't overcomplicate it, just make sure those pictures are incredible and make sure you respond quickly. You will get a renter if you do those things. With that, you should be making positive cash flow and improving your equity. Now, all you gotta do is save money, drop another deposit down, get another property for your portfolio, and build your income piece by piece. Bonus tip alert, if you're selling your primary residence, you can dodge capital gains on any gain when you sell up to $250,000 in profit. This is a huge tax benefit you must be aware of, especially if you gain a lot of equity in a single property. And this can be repeated every 2 years. Plus, if you're lucky enough to be married, this goes up to $500,000. It's IRS's 121 exemption. I encourage you to check that out. It becomes a huge deal if you're looking to renovate and flip houses that you actually live in. Some people quite literally use this to buy and flip their primary residence for a huge tax-free cash inflow every 2 years. Making millions in real estate will take a lot of work. But the equation is extremely simple. Do your research, put in the effort to understand the market, find good properties, and don't lose control of yourself when you make an offer. If you play the game sensibly, you will make money. Do it long enough, you will make millions. I've bought over 300 cryptos. Some terrible, losing me hundreds of thousands of dollars, and some amazing, making me over $1 million. I'm gonna reveal 5 cryptos that made me money: XRP, Litecoin, Solana, Render, and Bitcoin. But even more important than the names of these coins is why they made me money. So let's talk about my crypto failures and the valuable lessons I learned from those. Then we'll get into some of my crypto successes and how those will inform my future decisions. And you'll get like 10 years of experience all for free. Here's the most important lesson I ever learned in crypto. In 2022, I was into a bunch of altcoins, from meme coins to stable coins, DeFi, you named it. I probably purchased a little bit and made a video on it. And there was a certain duo that stood out from the pack, Terra and Luna. Both tokens were for a DeFi platform that offered you 20% returns on stable coins. This was amazing. It was a cool idea. It had so much hype. Institutions and people all around the world had deposited billions of dollars into this platform to earn that high yield. Even the creator of this project, Do Kwon, was well known. People loved him, even though he was the weird dork who mocked poor people. There was some weird stuff going on, but this project seemed to be guaranteed money and people ignored the weird stuff and they loved it, and I got swept up in the hype. So how did the project do? Well, it went amazing for a while, but then the whole thing crashed and I lost about $200,000 alongside millions of other people who also lost their savings. Even KSI saw $2.8 million turn into just $1,000 on this platform. Luna and Terra turned out to be a disaster at best, a scam at worst, but I learned a valuable lesson, maybe the most important lesson in crypto. Don't ever believe the hype.
My God! Okay, it's happening. Everybody stay calm.
This collapse was as big as the Lehman Brothers collapse in 2008. Many big institutions bet their entire portfolios on Terra Luna and lost everything for themselves and their clients. Even the big guys get it wrong sometimes, so don't be a sucker. And it didn't even end there. The reason why most cryptos fail. There's some other really important lessons I learned from a much quieter project, Meld. This is a DeFi project that lets you lend on many different blockchains. A super cool idea, DeFi with integrated fiat banking baked right in. This feels like it's ahead of the curve. If crypto becomes truly mainstream, then this is something that will have such a valuable use case. But here's the double lesson. People care about use cases right now, today. What value do you provide me today? That's what people are always asking. And even more, crypto projects live or die by sustaining attention that they get right now, today as well. Meld has kind of struggled on both fronts with a price that's been on a highway to nowhere for quite a while now. Get these two lessons wrong and it's not a good sign for your project. The ideal crypto project, number one, solves a problem that is a problem right now, today. And number two, can remain exciting in the public eye. It's unfortunately just important that a crypto can do both of these things in modern day. Now look, this is just my opinions and my observations from buying way too many cryptos and doing so much research over the years. None of this is financial advice. I encourage you to do your own research as well and only ever trade what you can afford to lose. But if you want to see another valuable lesson that I learned, check this out. The trap that 99% of people fall for. Cardano, okay. Bear with me while I explain what they do. They claim to be an on-chain, asset-backed stablecoin protocol and decentralized exchange stable asset liquidity pool. That's a lot. What does that even mean? In reality, not a lot. There's some evidence that looks like they were allegedly a scam or incompetently managed. I don't know exactly, and there's even more evidence that the project is just totally dead. But here's the lesson. Technical jargon can be a trap. It often is. Smart people and projects can explain what they do simply. Someone who is truly smart about some topic can explain to a 5-year-old what they do. If they can't, ignore them. Ignore jargon and focus on what a project or a person is actually doing. What's their use case? Does it make sense? What's the value? Are they making moves in the industry? Do they have solid partnerships? This will tell you so much more than jargon ever will. Now this next lesson, it's so obvious that you're already doing it without even realizing. Learn from other people's mistakes. You heard me say I lost $200,000 on a scam. And hopefully that makes you second guess making an investment the next time something sounds too good to be true. Hopefully I save far more than 200K in your guys' portfolios by just saying, here's this mistake I made because I thought that I had it right and I didn't. You can actually take this one step further by surrounding yourself with the right people. Look for people who are actively pursuing the same goals as you and learn from each other. This could be as simple as like a group chat or a Discord server, whatever works for you. Learn from other people, innovating and doing the exact same things. This is exactly what we do on my crypto research platform, FINOVA. Our head of research, Kyle, he has traded crypto from a portfolio of $26 to $2.7 million. I've said this before, I'll say it again because it's insane, but that isn't without making 1,000 small mistakes along the way. Over time, he's amassed an 80% win rate on his research, on his posts in real time for members. Members know when to buy, what to buy, and how to stay protected because they're building off of his experience, his 1,000 mistakes and everything he's learned, which means members have profits like this, and this. Can you get these kinds of results by yourself? Absolutely. If you're willing to do the studying, you can do it yourself for sure. Or you can just skip ahead of the line and directly learn from experts. I don't care who you do it from, but you can make your life a little bit easier. If you want to get involved with FINOVA and get access to our trades as they happen day in and day out, hit that link below. And if you don't love it, if you sign up and you don't love it, we have a 100% money back guarantee, so there's really no risk in joining. See you over there. Now, the fundamental truth of crypto. If you've been following my page for a while, you'll know that I've researched thousands of cryptos, many of which have had pretty good promise. Well, crypto is about to give me another hard lesson because nano. This was a cool one. It was a cryptocurrency designed to address the Bitcoin scalability problem. The problem is Bitcoin can't handle massive transaction volume. Nano was created to have lightning fast confirmation times and low fees, making it a huge value add to Bitcoin users. Sounds good, but Nano was tied to an Italian exchange hack where 17 million Nano was lost. The price of Nano sank from 32 bucks down to $1. So much for Nano. Luckily, I only had a small investment in this one, so I didn't personally lose a whole lot, but this brings me to a valuable lesson. The fundamental truth of crypto. Crypto is extremely volatile, and even solid projects with everything going for themselves can bust. Do not be overexposed to any one project. Bad things can happen. Alongside this, I want to talk about helium. I really like the idea behind this one, crypto for the Internet of Things. Like, that's rock solid, combining two technologies that are getting more and more popular right here, right now. It just makes sense as a business. Helium's even partnered with brands like Telefonica to roll out mobile hotspots in Mexico. So again, real world use cases. But the rules are the rules. And this one just doesn't get the attention it deserves, so it just hasn't made me much. One thing you'll notice a lot about crypto projects is even the best ideas can get ignored by the market. And without attention in crypto, unfortunately, you're pretty much worthless. You have to master attention as a crypto project, as well as being a fundamentally good business product. But what about the good ones? 5 cryptos that have made me money. Let's look at XRP. This has always been a crowd favorite. It's an open source, permissionless blockchain built for business, built for transactions. B2B business can make serious money in the real world, so this has got some attention. This has a business model that just could be absolutely massive. Some even suggested that this thing could 30x, which I made a video on this in the past, and I pointed out that if it did 30x, that would require a $20 trillion market cap at the time, which is bigger than gold. Was I right? Yeah, it didn't 30x. Although it did do quite well and hit 31 billion in market cap. So there's that, which brings me to the lesson. If a project checks all the boxes, it has a solid use case, it's relevant right here, right now, and it has high levels of attention, it might look like it's perfect, and it might be perfect, but you can't let that and its hype set unrealistic expectations. Like expecting a small cap crypto to pass Bitcoin, it's just simply unrealistic. But that doesn't mean you shouldn't hop in and get some nice juicy profit and then hop out with your gains. But there's 2 even better cryptos to help highlight my points here. Litecoin is the first one. This was one of the first altcoins in general, starting way back in 2011, I believe. It's very similar to Bitcoin, except it's faster and has lower transaction fees. Its similarity to Bitcoin has led it to be called the silver to Bitcoin's gold. I like all of this. It's a solid idea. It's tied to some big crypto projects, but how did it actually perform? Well, price-wise, Litecoin saw huge pumps in both bull runs, but a more quiet response in 2024's bull run. However, it's still been pretty solid, a reliable pick for both short-term trading and long-term strategies. Like, as far as crypto goes, this one has proven to be extremely reliable in its money-making ability, which, if you've been paying attention to this video, reliable profits are better than the chance of occasional big wins. That's how you really build your stack over time. And another big lesson was hammered home by Solana, a faster, more efficient Ethereum alternative. Solana had a huge pump to 258 bucks in 2021, but then it went down to $21 in October 2023. Since then, it's gone back up over 140 bucks. But why? Well, it's tied to an incredible amount of projects. CoinMarketCap even has its own tab solely devoted to Solana-based projects. That's nuts. That is really crazy in the crypto space. So sure, Solana, it's had its ups and downs, but this connection to projects is definitely something to look for in crypto. Buying into a blockchain that has many cryptos built on it is actually safer because you're essentially buying a tiny slice of hundreds of crypto projects, the ones that are built on that blockchain. But what about something smaller? Well, there's an even smaller crypto that has worked out very well for me, Render. I've spoken about this one before. It's a blockchain that allows users to share unused GPU power to help projects render graphics and visual effects in various AI applications. This is a solid real-world use case that helps people in industries all over the world, like movies, video games, advertising. If we go back to the lessons learned, this definitely meets the relevant criteria. Now, of course, Render is still riskier than a larger, more reliable project like a Solana or a Litecoin. However, for a smaller altcoin investment, Render's one that I've had money in for a while. Yes, it's had its ups and downs throughout the year, but I see this one climbing back up and I see myself keeping this in my portfolio for a while as this price continues to increase. But Render isn't my favorite overall, nor did it make me the most money. You know what did? And it also reinforced one of the best financial lessons I've ever learned: Bitcoin. I've been talking about Bitcoin for years now. I first bought it back in 2013. My thinking at that time was, this seems weird, this seems fun, let's just try it out. I wasn't serious about crypto yet, but over time, adding my portfolio, Bitcoin has been the most reliable, solid earner in my entire portfolio by far. I've had quick wins with other coins, but this one has just been plodding upwards. Even though I've cashed out a few times, my position is still up over $300,000. And what I like about Bitcoin is it not only grows your money over time, but it's got extremely high trading volume. It's much more resilient to price swings. This makes it a solid defensive hedge against more cryptos within your portfolio. And this is exactly how I like to use Bitcoin, as a steady, reliable earner. That allows me to take risks on smaller cryptos that have incredibly high volatility. If those go well, I catch the upside. If those go bad, Bitcoin helps keep me safe, which is my biggest lesson in crypto. The lesson that's made me more money than anything else. Balance out massive risk with proportionately reliable investments. That way you can capture that big win without being ruined by a big loss. That said, if you've been paying attention, you'll know that crypto is fundamentally volatile and any project can go bust, even Bitcoin, theoretically. So surely a large position in Bitcoin violates my rules, right? Not exactly. I also make sure my crypto portfolio is only a small percentage of my overall investments. As a percentage, I could afford to lose all of my crypto. It'll suck, but I won't be wiped out altogether. I won't have to sell the house. So to balance out this risk, I have other money in more secure investments like treasury bonds, like basically the most secure investment you could have. Also cash flowing businesses. But as far as cryptos go, Bitcoin is fantastic. I mean, just look at the stats. It's one of the best performing assets of the past decades, helped many people I know get insane returns, including my head of research, Kyle. He primarily used Bitcoin to build that massive portfolio of his using just 4 simple rules to trade Bitcoin. To find out what those rules are, check out this video on screen. I've made over $1 million in crypto. Let's react to my subscribers' portfolios. There's small portfolios, $10,000 portfolios, $100,000 portfolios, even multiple $1 million portfolios. But which ones are the very best and which ones are going to self-destruct? Okay, what do we have here? This one grew from $40,000 in October to a high of $114,000 in April, now floating around $100K. So far, so good, but how is it broken down? $74,000 is in Bitcoin, and the rest is diversified into a mix of smaller projects. We have meme coins like Floki, there's a little bit of Ethereum, there's a little bit of Solana, and $3,000 in Kronos, which is actually his second largest investment outside of Bitcoin. Bitcoin is more stable, obviously, so this gives his portfolio a nice defensive hedge against volatility of these other coins, but Bitcoin's the dominant one here. This is really useful though, given that he has money in meme coins or other high-risk tokens. Don't be a meme coin investor without proper risk mitigation, even within crypto. Think of Bitcoin as risk mitigation within the crypto space. But I do have a point here that I need to make. A mid-cap crypto that's on his list that I noticed, it's Kronos. This is actually his second largest holding after Bitcoin, but Bitcoin is much, much larger. Kronos is a boring but interesting project. Let me explain. It's an open source interoperable blockchain that supports dApps, which that just basically means it's a blockchain that makes building applications a little bit easier. There's nothing sexy about it, but it is a solid project with a solid use case, which I love for a mid-cap. That's a sensible pick for growth potential. Sometimes boring can be good, especially if there's a business model there. Overall, he has a super secure portfolio with 74% allocated to Bitcoin, meaning it's more likely to survive the long term, and some solid mid-cap picks. Honestly, I give this guy an A. All right, this portfolio is kind of the opposite of the previous one. There's no big stable hedges here, like Bitcoin, straight into mid-cap, straight into the small caps. This guy has giant balls. 10% in Cubic, 7% in Relio, 6% in VeChain, 5% in Propbase, 5% in Caspa. I can only assume that the remaining 69% is in random tiny coins like meme coins or other projects. This guy's a madman. I gotta admire his style a little bit. He definitely bets on sports on the weekend. Like this guy he's going all in. I gotta appreciate that a little bit, but let's be honest, this is an insane portfolio. Super aggressive, designed to capture the upside of crypto volatility. I will say I'm a big fan of VeChain. That's one that stands out to me. They have one of the best use cases in all of crypto. Essentially, they use blockchain technology to help track items in real world supply chains, like from manufacturer to the store to, someone's home. However, I gotta say, this portfolio needs more large cap hedges against, the downside of crypto volatility. There's so much that could be lost in this portfolio. So while his loose cannon approach, it's entertaining to watch these people, I'm giving this a C-. All right, this next guy, he heard the words invest in crypto and he just straight up said yes.
Yes, please.
He has money in everything. His largest positions are in VeChain and Cardano, which I like, of course, but really he is spread everywhere, over 50 investments. This is extremely risky investments for the most part as well, with massive exposure both to the upside and the downside of the volatility of crypto. But here's the thing, assuming the numbers are right on his percentage invested, his level of investment within each coin of the 50 coins is very low, keeping his exposure per token per project very small. So if he loses in any one crypto, that'll be a very small proportional loss relative to his entire portfolio. So we'll call this butter style investing because this guy is spreading it thin. He seems to be gearing towards those freak pumps. I mean, with this kind of portfolio, you're basically betting that one of these just pops off and does a 30x and makes you rich, but you're also essentially betting that a few of these will totally crash and burn. It's very similar to how angel investors invest in startups. They're looking for the 1 in 100 company that'll pay for all of the losses of the 99 companies plus some, and that's where their profit comes in. So of course, you still need to be very disciplined in your picks if you do this kind of crazy investing. That's where I'm a tad concerned because I don't know how diligent he was on 50 picks, and realistically, how diligent can you possibly be for 50 picks in terms of tracking all of these investments? It feels a little bit like a roulette table rather than a portfolio. I can't totally recommend this simply because it'd be so hard to do it right and track all of these, but I respect it. I'll give it a C. Okay, take a look at this portfolio. I don't know if you can see this, $2.8 million in crypto. I wanted to highlight this one because it's a bit different than the others. First, it has millions of dollars in it, which is interesting. And second, this is Kyle's personal portfolio. He's our head of research over at FINOVA. I thought it would be valuable to show you how he does things differently than most people, even in regards to his portfolio. So 95% of his portfolio is in Bitcoin. As far as crypto goes, that's an extremely, extremely low risk portfolio. He has 3.5% in USDT, the stablecoin, and then he has some other small investments in Link, Ethereum, Litecoin, and Atom. I asked him, why so much Bitcoin? And he said he holds Bitcoin because it owns over 50% of the total market cap of the entire crypto space. We all know that, but he had a really interesting point on this. He said because it has pairing liquidity in everything, meaning you can trade basically everything for Bitcoin, you essentially own a small piece of the upside of every crypto that has a trading pair with Bitcoin. I've never thought about this before, but it makes a lot of sense. He also said he's no stranger to altcoins, but he typically sticks to conservative, solid picks like, top 20 market cap altcoins. He said that he's tried to do a lot of smaller alts, and this is what happened. Now, the real question is, how did Kyle build this massive Bitcoin portfolio? His strategy is super unique. He made his money in Bitcoin not by buying it and holding it, but by doing a specific strategy called inverse perpetual trading. This is where he bets on a future target price for Bitcoin, and then he funds his trade as the price moves toward his target. It's a higher risk form of trading, but with his individual rule book, he managed to grow $26 in trading. He traded that up to like 15K. And then he started doing these inverse perpetual trades. And over the course of a few years, that $26 turned into $2.8 million. It's like the most insane story in crypto. The problem with this story is it literally sounds too good to be true, but all the receipts are there. And you can see him in action for yourself. Kyle, he shares all of his trade signals and rulebook with FINOVA members. That allows them to copy his results. They have great results. He's racked up a win rate of over 87% across hundreds of trades. His research is consistently getting members wins like this, this, and this. Given Kyle's portfolio is conservative with limited and controlled exposure to risk, and just the results speak for themselves, I mean, I gotta give it an A+. If you're interested in getting access to Kyle's trades and his rule book, as well as courses and signals from other coaches, sign up using the link below. Just grab a spot quickly because they do fill up every single week. Now this next portfolio you're gonna have to take with a little pinch of salt. It's pretty wild. When I asked members to send me their portfolios, someone sent me this. $1.6 million in XDC. Now, XDC is the token for the XDC hybrid blockchain. This guy said that he put in roughly $20,000 into XDC when it was priced at $0.0003 per token. And now that $20,000 is worth $1.6 million. Hats off to him for the insane gains. That's honestly legendary, and it gets even crazier. This is his only crypto holding. That's it. That's his whole portfolio. XDC. He owns no other cryptos because he thinks XDC will replace Ethereum. It's a wild story, but personally, I would take some profits. I'd probably diversify a little bit. There's plenty of other ways that you can make money in crypto. Like you could, take a little bit off the top. I mean, what do you think of this? I think he's either a prophet, a madman, or maybe both. I can't recommend this strategy as far as going all in on one altcoin. This is just insanely high risk, but hey, he has amazing results. I'll give him an A for results and balls, but I gotta give it a C as far as a portfolio just because, there's just so much downside here. It's extremely risky. Next up, we got a $42,000 portfolio split between a wide range of cryptos. You got juggernauts like Bitcoin and Ethereum. You got mid caps like Render, Solana, a bunch of meme coins like Snack, Floki, Nike, a ton of coins. But just look here at the bottom to see how he structured his portfolio. Around $22,000 into larger, more secure investments like Bitcoin and Ethereum, giving him, a good hedge against risk. Then you got around $15,000 in slightly riskier mid caps, which gives him, exposure to potential pumps, less safety, but more potential upside. And then around $4,500 going into super risky tokens. This is an example of someone who is intelligently trying to make a risky portfolio. He's giving himself around 50% exposure to high risk, high reward options with smaller holdings as things get riskier. He has slightly more proportionally in those tokens relative to small cap meme coins, meaning he has that chance to catch a huge altcoin pump, but the other 50% of his portfolio, that's the safety net in Bitcoin and Ethereum. That means he won't likely be completely wiped out if things go bad. It's a smart way to do it if you're trying to have a bunch of risk and a bunch of upside potentiality. Personally, I'd put more money into the big cap cryptos, more than a 50% allocation, but I'm gonna give this portfolio a B+. If your overall portfolio is an amount that you can afford to lose, then this is really solid. All right, here we got something weird. 11% Ethereum, 10% Bitcoin, 9.7% Kronos, 8.6% Solana, 7.2% Kaspa, 6.5% Jasmy Coin, 3.8% LCX. For the most part, this is fairly evenly distributed across large and mid-cap cryptos, but what concerns me is the 43.7% in miscellaneous. If this is random small cap coins, which I suspect it probably is, then this is a very, very risky portfolio. The mid caps, while nice, aren't secure enough to call secure. It needs more money in large cap cryptos to help balance this risk out. Based on the information that I have here, I'm gonna have to give this a C-. It's just too risky. You know what? Let's keep the ball rolling with the next risky portfolio. 14% in Multiverse X, 6% in Cardano, 5% Kaspa, 4% DAO Maker, XDC Network, Chainlink, and Solana, and 56% in other. Again, it's a little bit hard to say, with this one, other than this guy wants risk, unless that 56% is Bitcoin or Ethereum, you're looking at a portfolio that is 44% small to mid-cap cryptos, other than, Cardano and Solana, which are larger. Don't get me wrong, I like some of his picks a lot. I'm bullish on Cardano. Solana is solid. 14% in Multiverse X. That's a little bit wild, but I've made crazier picks, as you'll see in a second. And something else here, a hack that you guys need to know for large and mid-cap cryptos, if you're in the US, you can actually trade these coins inside a retirement account, which means if this guy had gains on his Cardano or Solana, he could have zero taxes on his gains. There's a few services that do this, but personally, I use iTrust Capital for it. It's an interesting strategy to look into. Just make sure it aligns with your personal tax strategy. Now, I have to do a little bit of guessing with this portfolio with, the other chunk. It's likely allocated to shit coins and other, just risky potential pumps. So I'm just gonna have to give this a C-. It's just too risky. Okay, now we got this guy. $600,000 down from a high of $667,000. Not bad. Over $300,000 in Bitcoin. That's 52% of his portfolio, acting as a stable hedge against the rest of the portfolio. There's also money in stable coins, USDC, there's also Ethereum, BNB, ADA, Render, some solid reliable picks. He's gonna need them because the next 20% of his entire portfolio is in SNEC, a high risk meme coin. Now let's slow down a second, because this is actually my portfolio, and I should probably explain what is going on here. First off, this doesn't tell exactly the whole story. These coins, this portfolio is up about 200%, which is great, but I've taken about $700,000 out of the crypto market in the last 3 years and reallocated that into a variety of lower risk things like this, nearly $500,000 in US Treasury bonds, which is basically the safest investment you can possibly make, but still 20% in SNEC in ultra risky meme coin? Why? Well, number one, I'm a little sick in the head. Number two, I helped build the product. So to me, this is more like owning equity in a small startup since I have some influence in the brand, which I wouldn't have with a random project. It's a little bit different perspective that I go into investing into something like this. Plus I just believe in it. SNEC is building some great products like the exciting SNEC.fun, and we have the best crypto community on earth. That's worth something. So I'm willing to take a bet on them. Really, that's it. Overall, I give my portfolio a B+, which means Kyle's is the winner. Congrats, Kyle.
The ultimate beginner's guide to cryptocurrencies. We're going to cover Bitcoin, how Bitcoin and cryptos work, altcoins, types of crypto investing, crypto terminology, crypto myths, how to buy crypto, cryptos you may want to buy, portfolio examples, and a whole lot more. So let's go ahead and jump right in. So our current banking system isn't great, and we didn't fully realize how bad it was until we got a taste of something 10 times better. Bitcoin.
The hottest currency in the world, the Bitcoin.
Bitcoin.
Did anyone read that article about Bitcoin I sent you?
Before Bitcoin, it wasn't possible to make electronic payments to someone without the help of a third party, which is expensive and slow, especially when sending payments to another country. And then add in the fact that banks and payment processors have access to user data and will sometimes even sell this data for their own benefit. And these systems still exist today. I mean, we have some front-end systems like Venmo to make small transactions that seem instant, but there is a ton going on behind the scenes. And that is exactly why 13 years ago today, Satoshi Nakamoto created the idea of Bitcoin, a new secure digital currency system that provides true peer-to-peer transactions from anywhere in the world. No third parties, no middlemen, low fees, and totally decentralized. A currency run by the people, for the people. A lot of people view the creation of Bitcoin as the start of democratization of finance, giving power back to the people. And then 13 years later, the concept of Bitcoin has proven to work well, and people are realizing its potential, and this is why we're seeing the crazy increase in price of Bitcoin year over year. Now let's talk about the blockchain. We know what Bitcoin is. Next is how exactly it works. This will be the most technical section of this video, but you can handle it. We'll break it down piece by piece. So the technology behind Bitcoin and cryptocurrencies is called blockchain. Blockchain, put simply, is a public, verifiable, and tamper-proof ledger of transactions. Breaking this down, public means anyone can look at the transactions. Verifiable means you can compare the transactions with others to make sure it looks accurate. Tamper-proof means, well, there's no funny business. This is because there are so many copies of the transactions that you just can't get away with changing one copy. You'll be caught. And a ledger of transactions is quite literally a list of all the transactions. If you buy Bitcoin, that transaction is added to the list and it is kept there forever. That's how the system works. So here's an analogy to kind of piece this together and visualize how it works a little bit better. So imagine you and two friends are working on a paper in Google Docs. You can all see the doc at any time, and you can also see the full history of changes. So if one friend adds a good sentence in there, you can see that he added it. Great, this helps out the paper. If another friend adds an incorrect sentence, you can also see this. It allows you to say, hey, that sentence is wrong. We gotta get that sentence out of here. This allows you three to come up with an agreement, also known as a consensus, as to how the paper should look. It prevents any funny business and is totally transparent. That's the general idea of how it works. Now, why do they call it a blockchain? As transactions are completed, they're added to the public ledger. And that ledger is stored in blocks of data. Now you can think of each block of data as a little house that fills with data, and we'll visualize the data in the house as furniture. Each house stores three things. So it first stores the transaction data, which is the furniture. It also has an address, so you know which house is which, and it has the address of the neighbor. So imagine each house has a sign outside pointing at the neighbor, and on that sign is the neighbor's address. And here is where it gets really secure and really cool. So a house's address is determined by its contents. So imagine if you moved some of the furniture around inside the house, the furniture being data, the address of the house changes. Now what this does is alert your neighbor that something has changed, because remember, the neighbor knows your old address. This prevents tampering from happening. Your neighbor knows that the furniture moved. Your neighbor knows that the data changed. So if data in the block is changed, neighbors are alerted and the system knows there is an issue and they can kick out that issue. Now, who puts the data in these blocks? This is done by a network of nodes, which are basically computer programs that crypto miners run. You can think of crypto miners as like the maintenance crew and the security in our little blockchain neighborhood. Those houses full of data, they're maintenance and security. They're building new houses and they're making sure everyone's address is still correct. Now, I know that this might be a little bit overwhelming, but don't feel bad if you need to watch that section a couple times just to really understand it. But realistically, you don't have to completely understand it. All you need to know is that the network Bitcoin exists on is virtually unhackable, completely transparent, and no one has control over it. Now, the reason I say virtually unhackable is because it's technically possible, but it would require someone to convince 51% of all Bitcoin miners to join in this evil scheme. And if they did join, they would lose money. So it's very unlikely to happen. Over the course of the last 13 years, Bitcoin has gone from a fraction of a cent to $60,000 per coin and everywhere in between. And in that time, many other projects have emerged, all hoping to use blockchain technology for better and better uses. The new coins that have popped up are referred to as altcoins. Now, one of the first to really take advantage of blockchain technology for more than just a currency was Ethereum. Now, I could do an entire video just for Ethereum's use cases, but the major difference is that Ethereum's network also has tokens that are completely programmable. So instead of just being a currency, it can be anything else, including images and videos, also known as NFTs, contracts called smart contracts, and much, much more. And innovation in blockchains did not stop there. Projects have been popping up like crazy, all of which use blockchain technology in new and creative ways. So one example here is VeChain. VeChain is a blockchain network that aims to help track and maintain real-world goods in supply chains. There are perfect real-world use cases for cryptocurrencies that are being explored as we speak. Now let's talk about crypto investing, the fun part. Bitcoin and all of these altcoins fluctuate in price like no tomorrow. I mean, crypto's prices could swing 8% in 60 seconds and no one would think twice about it. This ain't your dad's S&P 500, let me tell you that. But of course, this has attracted investors looking to diversify, as well as Wall Street bets apes looking to YOLO their life savings into an altcoin. There really are two investors in crypto. And if you're watching this, I think it's really important to decide which type of investor you're aiming to be before you plan on investing, and to have a plan first. So the first type is a hodler. This is the type of person who's in it for the long run. You invest in projects that you feel like have strong underlying value, and regardless of price swings, you don't plan on selling in the near future because you feel like that project will be worth significantly more in the long run.
You had a balance of 93 cents, and at an average of 2.25% interest over a period of 1,000 years, that comes to $4.3 billion.
Now, this type of project typically stays away from small projects or at least minimizes exposure to them. And the second type is a swing trader. This is someone who's looking to cash in on those 8% swings that I mentioned earlier. Someone who speculates on the short-term price movements of a crypto in order to make a fast return on their money in exchange for, occasional losses. No matter your investing style, I think it's always good to learn more and to have a community around you. And if you're looking to learn even more, you'll want to check out my Patreon that's linked in the description. In there, you're going to find a ton of stuff. You're going to find private content, live coaching, my thoughts on the market, my buy alerts, and a private group of dedicated investors. Now, we only open a few spots at a time, so you'll want to make sure you grab one of those spots before they sell out again if you are interested. And now let's talk about crypto terminology to help you better understand any future YouTube videos or articles that you come across or sound a little bit smarter at work.
I understood that reference.
So we're going to rapid fire some words and brief definitions, so feel free to watch this section a couple times if you really want to get them to stick, because I know I've spent a long time just learning these words and be able to rattle them off like this. So we're going to start with a couple refreshers. First off is altcoin. This is any cryptocurrency besides Bitcoin, an alternative option to Bitcoin. Then we have blockchain, a secure and decentralized ledger system. This is the technology behind most cryptocurrency networks. Fiat, a currency that's backed by a government and not backed by a commodity like gold. The US dollar is a fiat currency. Crypto address. This is a destination for a cryptocurrency being sent. It's really no different than when you mail something with the post office and you write an address on it and the mail goes to that address, except it's with crypto. Exchange. An exchange, or more specifically, a crypto exchange, is somewhere where you can exchange one crypto for another, or exchange fiat for crypto. There are centralized exchanges like Coinbase, and there are decentralized exchanges like Uniswap. And decentralized exchanges are not controlled by any one entity, unlike centralized exchanges. And then we have dApps. It's an app, but it's decentralized. Hence the D. This is any application that runs on a network that is decentralized. All applications running on Ethereum are dApps. DeFi. This is finance, but decentralized. Just as simple as dApps, it's a blanket term for anything financial that is the decentralized alternative to traditional finance. So getting a crypto loan would be considered DeFi. Next up, gas fees. This is a small fee, well, depending on the network, small fee that you pay to a network for sending crypto to a specific address. This is an important part of crypto systems because it prevents spammers and helps to uphold the network. Then we have mining. Mining is a process where computers solve complicated math problems called hash problems in order to earn the right to verify new transactions on a network and be paid in that network's currency. And then we have staking. Staking is essentially where you lock up your cryptocurrency to help facilitate the network, and you're paid back that cryptocurrency as passive income in return. Then we have hard fork. This is when a significant change is made to a crypto, kind of like a software update. In some cases, a crypto forks into two separate currencies, a new version and an old version. Well, most of the time this doesn't happen. There have been instances where the previous version remained due to disagreements, and a new version crops up. Bitcoin Cash is an example of this. It's a product of a Bitcoin hard fork that created Bitcoin and Bitcoin Cash. And then we have smart contracts. This is the core feature that makes Ethereum so great. It's like a legal contract, but it's digital. It's created, managed, and executed by the network. No middleman is involved, and it is amazing. And then we have market cap. This is the total value of all coins in circulation put together of a specific cryptocurrency. This is helpful in determining the value of a crypto project as a whole compared to another. Remember, the price of a coin doesn't matter. The market cap does. Always look at the market cap when you're comparing cryptocurrencies. And then we have whale. This is someone who owns a notable chunk of one crypto. A whale is really anyone with enough of one crypto to move the price when either buying or selling. Now that you know the terminology, let's talk about crypto myths that you may have heard of before, and we can address them head on. The first myth, crypto is a bubble.
Patrick?
Yes, SpongeBob?
I don't think this bubble can get much bigger.
Nonsense!
And this isn't necessarily true or false. Some think that crypto is just one big joke and it's this huge speculative trading bubble of people moving money around that's bound to collapse any day now. Others think cryptocurrencies will be used for literally everything. But the reality is, it's likely somewhere in the middle. Projects like Ethereum have actual real-world value. But it's still very hard to determine how much these projects should be worth. it's hard to determine if they are overvalued or not. The second myth, crypto is just gambling. Well, there's no denying that crypto is highly speculative. The reality is that a lot of crypto projects have or aim to have real-world value. Third, governments can just ban crypto and then it's going to go to zero. So yes, there are governments who just simply dislike cryptocurrencies due to criminals taking advantage of the anonymous nature of crypto networks. But at the end of the day, governments don't really have much control over the currencies themselves.
But here I come, the government.
So while they can do everything in their power to prevent people from using fiat to buy crypto, it will continue to exist. And plus, there will always be certain countries who embrace crypto totally and will benefit from that, and that will kind of peer pressure other countries into accepting it. And fourth, cryptocurrencies are just like the US dollar and can be used to buy everyday stuff. Now, hopefully one day. Unfortunately, in most cases, you can't just go to the grocery store and buy your groceries with Bitcoin. And while this might happen one day, we still have a long road ahead of us and a whole lot more regulation that would need to happen for cryptos to be used every single day like the US dollar. And then the fifth and final myth, cryptocurrency is just for criminals. Okay. Criminals do love crypto because they get to stay away from banks watched by the government. But that doesn't mean it only helps criminals. I mean, put it this way. I bet murderers loved when knives were invented, but I'm pretty sure knives can be used in a few other ways besides, stabbing someone in a murder. Let's talk about how you can buy crypto. Now that you're all caught up to speed, you're a crypto expert, if you will, we need to actually get some crypto in your wallet. You have two options here. You have centralized exchanges or you have decentralized exchanges, aka DEXs. If you are brand new, you should definitely stick to centralized exchanges. They are much easier to use. So here are two centralized crypto options that I personally use. First one, you've probably heard of it, is Coinbase. Coinbase is the most popular exchange for beginners and for a good reason. They offer a really easy to use and intuitive UI, an easy to use app, and many fiat options. Now, the one big downside though, is they have high fees. But despite their high fees, if you're brand new to crypto and everything in this video is new to you, I would still highly recommend going with Coinbase and not worrying about the next option, just until you get used to crypto in general. But the second option, the one that I primarily use, is KuCoin. KuCoin is great for your all-around crypto needs. They have extremely low fees and a vast selection of altcoins that you can buy, stake, lend. You have far more options. Although no exchange is perfect. First, there's a much higher learning curve. It is far harder to use than Coinbase. And second, they don't support fiat transfer. So in order to get money onto KuCoin, you actually need to use another exchange like Coinbase to first buy crypto and then transfer it over to KuCoin. So KuCoin paired with Coinbase is a pretty awesome option. That's what I do personally. And I have a KuCoin tutorial that I'll pin above that shows how to do all this. But again, if you are brand new to crypto, don't worry about KuCoin, just use Coinbase. It's super easy to use. Both those options will be linked down in the description. So you're all set up and ready, and assuming you want to make money, what you should buy should really be based on your risk tolerance. Bitcoin and Ethereum are considered lower risk options when it comes to crypto, and beginners generally should stick to buying those two until you're more familiar with everything else. Bitcoin is a store of value for millions of people and companies, and it's unlikely to disappear. Ethereum is the backbone of thousands of blockchain projects, and that's unlikely to go anywhere anytime soon as well. So if you're looking to invest in crypto, but you want as little risk as possible, Bitcoin and Ethereum are the way to go. However, it's worth noting, despite being lower risk in the long term, they still can fluctuate pretty heavily on a day-to-day basis. Now let's say you're willing to take on a little bit more risk and you want to put your money in more than just Bitcoin and Ethereum. Well, you're in luck because I have many videos on my channel diving deep into various crypto projects like Cardano, Solana, Chainlink, VeChain, and many, many more. I will link a playlist in the description so you can check out all those projects and feel out which one you believe has the most potential. But always make sure to do your own research before buying anything. Never buy a cryptocurrency just because someone tells you to.
Let me see your identification.
You don't need to see his identification.
We don't need to see his identification.
Now let's look at 4 portfolio examples. That way you have an idea of potential options for your crypto portfolio. The first one we're going to call Bithereum. Don't want to learn much about crypto, you want fairly low risk, 50-50 Bitcoin and Ethereum it is. This is probably the lowest risk crypto portfolio, but again, that's low risk. Long term, there can still be heavy day-to-day price fluctuations. The second one, we're calling this I dabble in crypto. This is a majority Bitcoin and Ethereum for the lower risk and a small portion in larger altcoins like Cardano, DOT, and Chainlink. The third portfolio, we're going to call this Mr. Balanced. A balance of all the top cryptos weighted slightly towards larger projects with lower risk. This is a popular portfolio for those who want some of the potential upsides of smaller altcoins, but still want to stay fairly grounded in terms of risk. And the fourth and final portfolio here, we're going to call this Altcoin Gore. So this is a little bit of everything with very little regard to risk. Honestly, if you're new to crypto, stay away from doing this method. Something like this, it's not exactly a horrible idea because it does have upside, but it will most likely require a lot of work, a lot of rebalancing, keeping up with the news, and has far, far, far more risk. Now let's talk dollar cost averaging. Due to the volatility of crypto, it's probably not the best idea to go and just throw all your cash into crypto all at once. If you buy all at once, you might end up buying at a peak or at an inopportune time or at a higher price than you want to. So a good option to avoid this is dollar cost averaging. This is where you slowly buy in over time, over the course of days, weeks, or even months, depending on how much you have to invest. This averages out your buy-in price, so you're not buying on peaks or on valleys. So it prevents you from getting super lucky, but also prevents you from getting super unlucky. You're hedging your bets. Put it this way, would you rather flip a coin before you eat to see if the meal is going to cost you $10 or $30, or would you rather just pay $20 every single time? Dollar cost averaging is paying $20 every single time. So an example of this with crypto could be something like buying $100 in Bitcoin once per week for 10 weeks rather than buying $1,000 in Bitcoin all at once. All right, one last time, let's quickly remind ourselves of the risks of crypto before we completely jump in. So first off, again, crypto is very volatile. Don't invest money that you need in the near future. And number two is hacking. So cryptos are still a very new technology, and while larger projects and exchanges are very secure, smaller cryptocurrencies and smaller exchanges can be vulnerable to hacking, which of course we need to consider as a risk. And then third is human error. Mistakes can and do happen all the time, like sending crypto to the wrong address or losing certain security passphrases. The thing about crypto, it's not reversible. There's no customer service for you to call. So don't be afraid to double check everything, watch tutorials on everything that you're unsure of. Don't be afraid to do that. You're doing it already, so you're already ahead of the game. And that's gonna do it for your introduction to cryptocurrencies. From here, my recommendation is to simply learn as much as you possibly can. Watch videos, read articles, and if you like my style, consider joining my Patreon for additional content that will be linked down below. I would like to thank you so much for watching. Like this video if you enjoyed it, and I hope you have a profitable day. Doing taxes on your crypto gains can be a nightmare. Because of the volatility of coins, tokens, and NFTs, tracking your real-world capital gains can get messy pretty quick. And since crypto is a relatively new way of investing, many investors will try to fly under the government's radar. But I'm here to say that this isn't the smartest move. Failing to report your capital gains from crypto correctly could land you with significant fines and set you back far more money than you made in profit.
I declare bankruptcy!
But I want to make things simpler for you. This is the best guide on the internet on how to account for your crypto. Because if you get this right, you may even be able to save money on your tax obligations. Now, to start this off, I want to remind you that I'm not a financial advisor. Always consult with a professional before doing anything crazy. Now, I get asked a lot if people really need to pay taxes on their crypto trades. The short answer is yes. The IRS seems to have systems already in place to gather information from undisclosed sources about who might have earned income from investments in digital currencies. In 2019, they sent letters to 10,000 individuals letting them know, hey buddy, you may have forgotten to pay your taxes on your crypto. And they won't stop there. With taxes on crypto formalized in the Infrastructure Investment and Jobs Act, it's not going to get any more lenient. The good news is that there are just a handful of situations in which you have to include your crypto activities in your tax report, and I'm going to cover as many as I can in this video and give you a free guide as well. So to keep things simple, there are 3 big events that you should see as taxable. The first is selling your crypto assets within 1 year. This is because the government sees cryptocurrencies as property. Any income you make in the sale of coins or tokens is a taxable event. If you hold onto the coin for over 1 year before selling, this is considered a long-term capital gains tax. What you end up paying depends on the tax bracket that you fall under. This chart from Investopedia sums it up pretty nicely. You'll notice that if you fall under the first pillar, you'll basically not have to pay anything on capital gains. But again, that's only if you're riding your positions long-term, more than 1 year. If you're single or you're filing your taxes as an individual, you can earn up to $40,400 in gains without having to pay taxes on those gains. Also, the limit on tax-free gains goes up if you're the head of household or if you file with a spouse. So there may be some tax advantages there to getting married.
What a luxury, you know?
Now let's compare that with short-term capital gains tax using this graph from the IRS. Income on crypto trading that comes from selling your holdings that are less than 1 year old get taxed just like ordinary income. So right away looking at this, 2021 federal tax rates actually start at 10%, even if you earn just $1 this year. That's not including tax credits, of course. And note, the numbers from this chart represent your total income, not just the income you made from buying and selling crypto. If you made that same $50,000 this year with $10,000 in gains as a single filer for short-term capital gains tax, you'd pay 22% compared to 15% if that's long-term capital gains. So it pays to hold long-term if possible. Another issue comes up when you use your crypto to pay for goods and services. This is because spending an asset like Ethereum or Bitcoin works the same way tax-wise as selling that asset, unfortunately. And if you are paid in cryptocurrency as part of your income or salary, you'll be taxed on this based on the price of the crypto on the date in which you were paid. Meaning if the value goes up by the time you sell or spend, unfortunately you have to pay tax on those gains. And this is at least until more governments recognize crypto as actual federal currencies. If you were paid in crypto or use crypto to buy things, you'll want to keep track of the date, amount, and price of the cryptos when you both receive them and spend them for proper tax accounting. But don't worry, later in this video, I'll have an easier way to keep track of all of that. The next part is figuring out the taxes you'd have to pay every time you spend or sell. This is typically done with the FIFO, first in, first out method. Basically, the crypto you receive first is the first to be considered spent or sold. Now, it is possible to use LIFO, last in, first out, to save some tax, but you'll want to be careful with this and consult with an accountant if you want to take that method. Going back to being paid in crypto, if you're converting your crypto to cash on the spot, right when you get paid, then this is as straightforward as counting up the amount in US dollars and listing this in your tax report as ordinary income cash. There is no conversion, there's no capital gains on that. But if you hold your crypto any amount of time before selling it or spending it, this is when you need to report that change in the price of the asset as unfortunate capital gains. Now, the third category is exchanging your coins for other crypto. Some people, many people, mistakenly assume that swapping one crypto for another is considered a buy and therefore assume that this isn't a taxable event, just like buying Bitcoin with US dollars. But unfortunately, that is not the case. If you buy Doge with Bitcoin, you're gonna have to pay tax on your Bitcoin gains. I know. It's unfortunate. Remember that crypto is not yet considered a currency by the US government or most governments, so they don't see this as a regular buy. They see this as trading one property for another. So let's do an example here. To help guide us, I've created a crypto gains and profit calculator. Did I spend literally 15 hours making this calculator work properly because I thought it would be a good idea for the video? Unfortunately, yes. Do you get it for free without even giving me your email address? Also, yes. All I ask is for a subscribe and watch through to the end of this video. To the example, you bought $1,000 in ADA in October. A month later, you decide that you really want to buy a Solana Piranha NFT. Who can blame you? So you go to the pre-launch sale and find out that one NFT costs 1.5 SOL. To buy this, you're going to go ahead and just exchange all of that ADA for SOL. And this is your first taxable event. Your ADA has gone up from $2.05 when you bought it to $2.30. According to our calculator, you have a realized gain of $121.95. That's the gain that you would have to pay tax on. And this is because in the eyes of our tax overlords, you have sold your ADA and bought SOL. You need to pay your tax. Now, here's the crazy part. You're going to have to repeat that process again when you exchange your Solana for your fancy new Piranha NFT. If your Solana goes up in value significantly, you should probably track this. However, to be honest, you shouldn't consider it the end of the world if your position shifts a few cents between that exchange and buying the NFT. Of course, none of that is financial advice. Now, the NFT itself also counts as property, but as long as you don't sell it within 1 year, you don't have to count that appreciation as ordinary income. Now, something else that is taxable but free money is using that link in the description for BlockFi. With BlockFi, you can earn interest on your cryptos and get up to $250 in free Bitcoin by making an account, but remember to pay your taxes. Now, what about losses? If you go through with any of these activities and you find that upon some kind of sale or exchange of your asset, you've incurred a loss in the value of your crypto, this counts as a capital loss. And it's important to report your losses as well because you can actually use this to offset your taxable income. Here's an example. You bought a stock and it increased in value by $500. Congratulations. We'll say it's taxed at 10% or $50 in total tax within the year. But you also bought and closed a position on a crypto in the same year that lost $50. You could write off that $50 tax by filing the loss alongside your stock portfolio gains. Based on IRS guidance, you can actually write off up to $3,000 in capital losses if you're filing as an individual. This can be strategic for you. It means that you could technically call your first $3,000 in YOLOs per year a tax write-off. Not financial advice. So we've so far covered the basics. These 3 examples of taxable events just about summarize how the IRS currently views some common transactions in crypto. But there's still some questions that the government hasn't answered. For example, in DeFi, activities like staking and yield farming tend to vary in their mechanics based on the dApp that you use. This makes it hard to pin down if your earnings should be taxed like ordinary income, capital gains, or non-taxable exchanges of assets. Now, let's break this down. Your earnings in DeFi are considered ordinary income when you decide to use your tokens in order to receive more tokens. So take an example of staking Cardano to earn more ADA in exchange for validating transactions. Because you receive more ADA for doing this, it works just like our previous example of getting paid a salary in Bitcoin. The same applies for mining on a proof of work blockchain. This is all ordinary income. Also, if you do have Cardano, you should consider staking it in my stake pool, ticker symbol MAX1. You'll earn around 5% interest annually on your ADA, and 5% of the revenue that we make goes to the Organization for Autism Research. So it's a pretty cool pool. But it gets a little tricky when you instead lend your crypto to a lending platform like Aave or Compound. These platforms have an additional layer of complexity because of liquidity pool tokens, or LPTs. When you lend ETH on Compound to contribute to their liquidity pool, you get a CETH in exchange, a sort of receipt for the amount that you invested. The thing here is the IRS has not yet decided whether that counts as an exchange, and therefore we don't know whether that's a taxable event. Breaking this down, your CETH token may increase in value over time, and if and when you decide to take your share of ETH out of the pool, this then becomes a capital gain. You need to account for both the price changes in ETH itself and the increase to your ETH stockpile through lending it, because you get paid back in ETH. And then you need to indicate in your filing if your profit or loss is short-term or long-term, because that affects how your income is taxed. If you held your CETH for more than a year, it could be considered under that 0% tax bracket of capital gains, so long as you don't hit the other income limits. Also a note here, for regular crypto lending like stablecoin lending, this is considered ordinary income on your taxes, which is a little bit more simple to calculate. Now, that was one example. Other DeFi platforms may have different mechanics on how they work, different kinds of tokens and different rules about when you can enter or exit a liquidity pool. It's important to understand this before you go into yield farming or liquidity staking, because it can affect your taxes. Some traders trade across several exchanges within a day, sometimes facilitated by bots. Typically, bots are used either for arbitrage opportunities or automated trading in crypto. This is where there's a bit of a gray area. I've yet to find anything explicitly in writing how this is taxed. However, it's safe to assume the worst here and consider that these gains are short-term capital gains because the trades happen on a daily basis, so that would make the most sense. Now, if you're a professional trader, you may be able to write off some of your incurred taxes by citing business expenses in your tax return. You can cite utility expenses and basically any other reasonable expense that's necessary to run your business. Deduct those expenses from your total crypto income pre-tax, and then you only get taxed on the remaining profit. It's a business. So if a large chunk of your time is going into regular trading activities, I would recommend looking at registering yourself as a business, but make make sure you consult with a tax professional because this is only going to work for full-time people who are willing to pay extra in accounting, and make sure that this is done correctly. Just make sure you do it correctly if that's an option for you. Also, if you happen to be someone who is worried about your crypto tax bill, I recommend either tracking things manually, just to get your mind off this, use that free resource in the description if you want, or you can use an integrated accounting app like Token Tax or Coin Tracker. These services range in price depending on the number of transactions that you make per year, but it typically costs you less than about $10 a month. And another thing that you can get a ton of value for only $10 a month is my Patreon. There you'll find additional content, my buy and sell alerts that are up more than $100,000 this year, a private investor community, coaching, and a whole lot more. I look forward to seeing you over there. So I'd like to thank you so much for watching, and I hope you have a profitable day.
How to make your first $10,000 in crypto, the ultimate beginner's guide. In the last 10 years, Bitcoin has made more money than gold, bonds, the stock market, even real estate. Bitcoin just wins. If for 1 year you invested $10 weekly into gold, your money would have grown by 6%. But with Bitcoin, it would have grown almost 70%. We live in a historic time where gains like this are possible for anyone. So the questions are, how do you make money with crypto? What does all this terminology mean? And how do you start today so you can make your first $10,000 tomorrow? I'm gonna teach you everything I know. The first time I bought crypto was 10 years ago when Bitcoin was only 300 bucks. Funny story, back then I bought Bitcoin using a service called Local Bitcoins, where you had to actually meet up with a guy in person and give them cash for Bitcoin. Sketchy. But I was lucky, within a few years, my small investment turned into about $15,000 in profit. Except I made the #1 rookie mistake of all time in crypto. I completely lost access to my wallet and I lost all the money. I didn't understand yet how crypto actually works, but things have changed since then. I've studied crypto technology. I'm friends with absolute experts. I've made 500 educational videos on cryptocurrencies, and I have hundreds of thousands of dollars in profits. So let's make this video as easy as possible by discussing the different types of cryptocurrencies, as well as the terms you must know to navigate your way to $10,000 in profit, which wallets and exchanges are the best to use, a step-by-step guide on the easiest and safest way to buy crypto. I'm gonna give you multiple methods, step by step, click by click. This part is so essential if you want to keep your money safe. How to find the very best cryptocurrencies. This way you can be confident in building a bulletproof, rich portfolio. And you know what? I'm gonna give you your next 5 moves so that when this video ends, you don't have to go back to browsing TikTok. You can start your money-making journey today. Bitcoin's been called digital gold, which is insanely important to understand. You see, gold is a special asset. It's useful in art, jewels, medicine, manufacturing, but its price fluctuates all over the place, just like Bitcoin. Bitcoin has a huge impact on our financial system, and its price is crazy as well. But there's one key difference between the two. Gold is old. Bitcoin and other cryptos are young. They're a fresh asset class. They're only going to get bigger. Learning about crypto now is like discovering gold before the gold rush even started. You're still early if you're watching this video right now, if you're just getting into cryptocurrency, if you're just becoming curious in the topic. But to make your first $10,000 with crypto, you need to understand the basics. How does Bitcoin work? What is the blockchain? What are altcoins? And what are the 3 types of crypto investing that can even make you your first $10,000? Before Bitcoin, it was impossible to make electronic payments without a middleman. It was expensive, it was slow. It left our data in the hands of banks. No one wants that. Bitcoin is a cryptocurrency run by the people for the people. This is because Bitcoin is decentralized. There's no middleman when it comes to Bitcoin. Decentralized means no one owns it. Instead of banks being in charge, we are. You and I are literally in charge. And the growth of Bitcoin alone has proven that the world has appetite for this free financial system. Bitcoin is based on a technology called the blockchain. It sounds complex, so let's just make this simple because it's really not that confusing. The simplest way to understand the blockchain is think of it like a Google Doc, one where you can see all the changes everyone else has made. If he edits this thing, you can see that he made that edit. If you add in something, he can see that you made that edit. It's completely transparent. On the blockchain, this works as a chain of transaction entries that can be viewed and verified by anyone. If I send you $5, that's going to be listed on the blockchain forever. It can't be tampered with, and anyone can see that I sent it to you. It's a massive game changer. It's called trustless technology because you don't have to trust anyone for it to work. But hold on, why do they call it blockchain? Where's the block come from? Well, that's pretty simple too. All transaction information is stored in chunks of data called blocks. It's kind of like a single sheet from our Google Doc is a block, and then all of those sheets linked together within a master folder is the blockchain. And you can actually see this in real time. Here are the latest transactions and blocks being created as we speak on the Bitcoin blockchain. Now, you might have heard the term altcoins. What are those? Since the arrival of Bitcoin, countless new coins and tokens have popped up. These are all altcoins. Ethereum, Dogecoin, Solana, Cardano, SNEC, you name it, those are all altcoins. Basically, if you're looking at a crypto and it isn't Bitcoin, it's an altcoin. And while all cryptos use similar technology to Bitcoin, they each have unique differences to solve different problems. The easiest way to think of different cryptos is just different businesses. Every different business solves a slightly different problem. Even sometimes there are two businesses that solve the same problem. It's no different with cryptos. You see two cryptos solving the same problem. They are different, but they are just different businesses. It's the easiest way to think of it. Ethereum, for example, was revolutionary because it was the first time people could build little computer programs on top of the blockchain. Those little programs are called smart contracts. Another example, Render. This is a crypto project that uses the blockchain to allow users to rent out their personal computers to earn money and aid in creating computer graphics and AI projects. So as you can see, this technology has really expanded from the roots of Bitcoin just being trustless transactions. Now there are legitimate businesses being built on this technology, and it's being innovated every day. And eventually we'll see more and more businesses utilizing this tech in a trustless, decentralized way. So while Bitcoin is the gold standard of cryptocurrency, altcoins are where all the new ideas and projects are popping up, and that's where the innovation will be. Now let's talk about the reason why you're here, crypto investing. Here's Bitcoin's price over the last year. Solana's, Ethereum's. Notice anything? Yeah, cryptocurrency prices, they fluctuate like crazy. They're all like this. This is because cryptocurrencies are subject to rampant speculation. This just means investors bet on the price of the crypto. Some people bet it's gonna go up, others bet it's gonna go down. Some really crazy people bet with 100 times leverage, meaning they're putting in $1 and they're getting the bet with $100. It gets insane. We're not gonna advise that. This sends the price of these cryptos and altcoins up and down constantly because of all this betting pressure, the speculation, and these wild price swings would send stocks into a panic. But in crypto, you know, just a normal Tuesday to see a 20% gain or 30% drop. That's crypto for you. So if you're an investor looking to make $10,000 in profit, what do? You got three major options, and all you need to do is decide what your strategy is, because that will massively inform your plan later on. I am big on making an investing plan and sticking to that plan, which we'll discuss later. So here are your major options. Option one, investing long-term, otherwise known as hodling, staying in it for the long run. Invest in cryptocurrencies and projects that you like. Think of them like businesses, analyze them like businesses. Like, does this actually solve a real-world problem that needs to be solved, and is there money behind that problem? If yes, and there's a decent business model, there's a good chance that crypto could do well. Add in a strong community of supporters, and that could be a really good investment. So with this long-term investment strategy, you can just invest upfront, like take your cash, invest into that thing, or you can dollar cost average over time, splitting your buys over time. Either way, you just buy, you don't think about price swings, and you just do it because you believe in crypto for the long term, like 5, 10, 15 years. You don't even really care to check in because you're thinking decades ahead. For example, if you bought $10,000 in Bitcoin on April 1st, 2014, and you held that until now, you'd be over $1.3 million in profit.
You had a balance of 93 cents, and at an average of 2.25% interest over a period of 1,000 years, that comes to $4.3 billion.
This is the easiest strategy. Identify the good cryptos, the good investments, buy it, sit and hold, and wait for that tech to really grow over time. Then you got option two, hunting short-term wins. This is where you look to cash in on those crazy price swings that happen every day, that speculation that's happening every day. All those little up and down price spikes that you see on the price graph, those are opportunities for you to bet against other traders and win little profits. You bet it goes up, and it does, you make your win, and you repeat that process. This is known as scalp trading. If you have the stomach for this, not everyone does, you have to ask yourself, do I have the stomach to make these little bets and to be unemotional about these bets? If you can do that, this can be a very, very viable strategy to make a whole lot of money in crypto. I work with this trader named Kyle. I hired him for FINOVA because of his raw trading talent a few years back. He started trading Bitcoin Just a few years ago with $26, literally his last $26. Over the course of a year or so, he traded that up to $15,000. And that's when he noticed a major trend happening in crypto. And he made a big bet, and that turned his $15,000 into around $300,000. And then a year later, he did it again using all of the exact same rules and parameters, making another massive bet, turning his $300,000 into $2.7 million. It's one of the biggest crypto gains I've ever seen, and the only problem with it is it literally seems too good to be true. But the crazy thing is he posted every single trade he's made in real time on FINOVA. That means our members had access to all of his profits, and his trades created multiple millionaires. If you're interested in checking out FINOVA, I'll have it linked down below. Just make sure you grab your spot quick before they sell out if you are interested. And then option 3 is simply doing both. It is long-term investing plus short-term hunting. It is possible to make short-term profits from price swings while simultaneously growing your money with long-term investing. However, of course, this is going to take much more time in your week to make this happen. So you have to ask yourself, how much time am I willing to allocate into this? This isn't an hour a week kind of strategy. This is going all in to make money off of crypto. So again, you have to know yourself here and know your goal. So ask, what is my goal with crypto? And how much time am I willing to spend? You have to answer those questions before you go too deep into this world. Now, we'll go more into the strategies that you should utilize later, because first, we need to cover a few more terms that you must know. You have to understand this world that you're stepping into. This part is going to be a bit fast, so buckle up. Crypto wallet address, the digital address that your cryptocurrency gets sent to and from. Every wallet has its own unique wallet address. Exchange. This is an online marketplace for crypto. There are ones that are controlled by a single entity called centralized exchanges. That's like your Coinbase, your Binance, things like that. Then you have decentralized exchanges, which are controlled by no one. We'll cover those in more detail later. dApps. You'll hear this a lot. These are applications, but decentralized, hence the D. It's just an application built on the blockchain. Because it's decentralized, they call it a dApp. DeFi. This is finance, but decentralized. Basically, any crypto service that deals in money or directly makes you money, like a decentralized exchange or lending or staking, this is all DeFi. Gas fees. This is a small amount that you pay to send crypto to a wallet address or to perform any action on the blockchain. It's essentially a transaction fee. They're a bit annoying, but they prevent spammers, so they're kind of a necessary evil. Pump. This is when the price of a crypto goes soaring up. And speaking of that, bull market. That means the market is trending upwards. Bear market, market is trending downwards. Mining. The process where computers solve hash problems to verify new transactions on the blockchain. When they do this, they're paid in the network's native currency. So the big example here would be Bitcoin. Bitcoin miners verify transactions, and if they're picked to verify a transaction, they win a reward in the form of more Bitcoin. Staking. This is where you lock up your cryptocurrency to help strengthen the network. In return, you get paid more of that currency as passive income. Not a bad deal. You can make anywhere from 2% interest all the way up to about 15% interest. Examples of cryptos that do this are Cardano and Ethereum. Hard fork. This is when a crypto does a software update, a major software update, and the network actually forks into two, the old one and the new one. Bitcoin and Bitcoin Cash are an example of this. Smart contracts, a self-executing contract or application built on the blockchain. They are completely automated once built, no negotiating, no middleman. A masterpiece. Market cap. This is the total value of all coins within a specific cryptocurrency. This helps show you the value of the total crypto. You can calculate this by taking the total number of coins multiplied by the price per coin. That equals market cap. Whale. This is your mom. Okay. Not really. This is an investor who owns a sizable chunk of any cryptocurrency, a chunk so big that they move the price when they buy or sell. Like Godzilla, their movements get press and Twitter followings. There's whales all over the place. You know what? You've made it this far. We're getting closer to you making your first $10,000 in crypto. But to do that, you need secure tools to use. These start with your wallets and the exchanges that you use. First up is your wallet. We're gonna keep this super simple. There are centralized and decentralized wallets. A decentralized crypto wallet isn't really a wallet like the one in your pocket. The one in your pocket stores cash, cards, your ID, but a crypto wallet doesn't actually store anything. That's because all holdings exist on the blockchain. So what's a crypto wallet for? Your crypto wallet is the home of your private key. When you create a wallet, you're given a 16 to 24 word private key phrase. That is your password to get in. Keep that secure, never share it, Never lose it. The private key is used to access your holdings on the blockchain. Without the private key, you can't access anything. If you lose it, you are screwed. That's what happened to me 10 years ago. I neglected to save my private key and totally lost access to my wallet. That's why this video is so important. Some popular, trusted, decentralized wallets are MetaMask, Trust Wallet, Exodus. There are so many more. Go with a popular one. I'll leave links for everything mentioned in the description. Now, it's not uncommon for anyone new to crypto to be a little bit hesitant when using a decentralized wallet because they're afraid to make a mistake. And let me tell you, that's totally okay. Take your time with these things, start simple. And the simplest way to go in the very beginning is a centralized crypto wallet and exchange like Coinbase. Centralized exchanges act as both a wallet where you can access your crypto as well as a marketplace to trade crypto, to buy and sell crypto. You don't need a decentralized wallet if you're only using a centralized exchange. The upside with a centralized exchange is that you don't need to stress out about making mistakes or losing your private key. You actually don't even have a private key if you use a centralized exchange. The downside is you're trusting a third party with your money. So hardcore crypto enthusiasts, they'll never hold money in a centralized exchange. However, for beginners, it's just the easiest way to go. So that's up to you. Some centralized exchanges like Coinbase are massive publicly listed companies with extremely simple features and high security. If you are an absolute beginner who doesn't need a lot of features, something like Coinbase is the way to go. If you're looking for more options and opportunities to trade and make money, you may want to consider a more advanced exchange. So let's do a step-by-step guide on the easiest and safest way to buy crypto and begin earning money. And then we're gonna slowly up the intensity, up how advanced we're gonna go. So we're gonna go easiest tutorial, medium, advanced, expert level. So buckle in, starting with Coinbase. Here we are on the app, downloaded from the App Store. On the home page, you can see my portfolio balance. I park my Bitcoin and Ethereum here. Now let's click buy and sell. Here we can choose the crypto that we want to buy. I'll leave it on Bitcoin. We type in how much we want to buy. On Coinbase, you can either pay directly with your bank account, which is nice, or you can pay with stablecoins. Stablecoins are essentially crypto $1 bills. They're 1-to-1 for the dollar. They're pegged at the dollar. They might fluctuate a tiny bit, but you can essentially think of them as $1 bills. I'm going to pay with the stablecoin USDC. I hit review order. Now on this page, you can choose if you want this to be a recurring buy. That's a super nice feature. That is dollar cost averaging. You can do however much you feel if you want to use that feature. I'm going to ignore that for now and click buy now. And there you go. You just bought crypto. Now to sell it, it's the same process in reverse. Just type in how much you want to sell, review, click sell. It's that easy. Now there is another feature here on Coinbase that's super nice. We're gonna click the cash tab. Here we can see our stable coins and cash. What's really nice is if you have USDC stable coins on Coinbase, you automatically earn 5% interest annually. So it's a pretty good spot to just park some cash if you want the simple, easy option, but we're gonna have more advanced options that pay more money in a second here. Here I click payouts and you can see all the passive income that I've made with this cash just sitting here. So that's the basics of Coinbase. But what if you want even more advanced features like futures trading or even more cryptos to choose from because you're pretty limited with a site like Coinbase? Well, Blowfin is my new favorite exchange for US users. There's been a lot of things going on with US exchanges. This is the best one currently, if you ask me. Here we are on the homepage of their app. We're gonna click on markets at the bottom. Here you can see all assets that you can trade. You can find them by scrolling. There's tons of them, or you can click search and just start typing in to see if they have that crypto. And here is something important to note. We see futures and we see spot at the top. If you're a beginner, you're gonna wanna stick with spot trading. This is just regular buying and selling. Futures offers things like leverage, which you just totally wanna avoid if you're new. We're actually not even gonna get into that in this video. So let's click spot and we'll click the ETH/USDT pair. This means we'll be trading USDT, the stablecoin, for Ethereum. This also means that we'll have to have USDT in our account in order to make this trade, in order to buy the Ethereum. And not all crypto exchanges allow you to connect to your bank account directly, meaning you may have to send stablecoins from an exchange like Coinbase to your desired exchange if you want access to certain advanced features. So things get a little bit more unuser friendly the more complicated you go within crypto. So again, it's totally up to you. What's your goal here? How advanced are you willing to go? In my case here, I need to transfer from my funding account within Blowfund. This is where I transferred money in to my trading account, and that just takes a couple clicks here. Then on the trading page, we click buy. Now this page looks a whole lot more complicated than it really is. all you really need to pay attention to is the top left rectangle of options. Very top, that's buy or sell. This is self-explanatory. We're gonna leave it on buy. Then we see market. This simply means we're willing to buy at the current rate. It will execute our trade at the prevailing market rate. If we choose limit order, we would be able to choose a specific price, essentially saying, I will only make a purchase if I can buy at this exact price. We're gonna keep it simple here. We're gonna leave it on market. Next, the amount we wanna buy. Right now, it is in ETH, so we're gonna switch that to USDT. Then we'll type in 100, which means we just buy $100 worth. We click buy ETH, and we're good to go. You can see our Ethereum at the bottom of the screen. We now own $100 in Ethereum. Now your third option is KuCoin. KuCoin is my favorite for international users or US users who use a VPN. KuCoin offers every feature you can dream up, from lending to staking to bots, trading, so much more. Real quick, from the homepage, we can check out lending. KuCoin is amazing for passive income. I will click the earn button here. You can see I've already made $1,800 in passive income on this app. I'll click where it says 7% APR. That means you earn 7% annually on a stablecoin. Again, a stablecoin doesn't fluctuate in price. Here we enter in how much we want to lend. It tells us our projected daily profits. That's how much we can expect to earn. Then we can scroll down, check that box, hit participate. It's that easy. This is how you could potentially make 10K in totally passive gains in crypto with the right amount of money invested up front. But of course, trading and investing can get you there much faster in crypto. So how do you do that on KuCoin? From the homepage, we're gonna click spot trading. Then the Bitcoin/USDT trading pair. That means we'll be trading USDT to buy Bitcoin. Here's the trading page. This time, again, it looks a little bit complicated. We're gonna ignore everything except for the top right rectangle. We're gonna leave it on buy. It's defaulted to a limit order, but you can see there are many other options on KuCoin. We're gonna set it to market order. Again, keeping it as simple as possible. Advanced traders are gonna be like, why are you telling them to use market order? It's the simplest way possible. We want this to be as easy and user-friendly as it possibly can. Then we type in how much we wanna buy and click buy. And if we ever wanna sell, we'll simply do the reverse and click sell. That covers centralized exchanges. Again, that will all be linked below. There's no right or wrong way to go. But what about decentralized exchanges? The most popular decentralized exchanges are Uniswap, PancakeSwap, and Curve Finance. But there are literally hundreds more. Now, warning, this is the most advanced way to buy crypto, and it's a bit tricky to give you a specific tutorial here because there are hundreds of options, all with slight variations on how the process works. So I'm gonna try to give you a high-level overview of how to use a decentralized exchange. So let's say you've identified a token that you like. You can then visit coinmarketcap.com, search the token, and click it to view its page. On here, click Markets, then click DEX. This shows every decentralized exchange that offers this token. You can see here it says MinSwap, then ADA/SNEC. That means the SNEC token is available on the MinSwap decentralized exchange, but you need to use the cryptocurrency ADA to trade it. That means we'll need to download a compatible wallet. The easiest way to find a compatible wallet is to visit the decentralized exchange's website, click Connect Wallet, and this should give you options of all the wallets that you can use on that site. Once we have the wallet, we'll then need to send crypto to that wallet from a centralized exchange of your choice, meaning we'll have to buy ADA in this instance and send it to our wallet address. Once we have that, we can visit the decentralized exchange, click the Trade tab, search for the cryptocurrency that we're looking for, and make the swap. You'll need to do a few confirmations after you click trade, and a few minutes later, the crypto will land in your wallet, and there you go, you're using a decentralized wallet. And I know that this can seem like a lot at first, so if that was overwhelming, watch through that a few times. You can always skip the decentralized exchanges and just use simpler centralized ones, or if you really want to try this out, do it with like $5 at first. Keep the bar super low, that way if you make a mistake, no big deal. And now we know how to buy and trade cryptos and ultimately earn money. Now that we know that, we need to understand how to find the very best cryptocurrencies, because we know how to buy them, but we need to find out how to buy the good ones, the profitable ones, to make us that $10,000. So we're going to discover the safe, profitable crypto options, how narratives drive pumps within crypto, and how to build a secure portfolio of mini cryptos. This is where I take you into which coins to pick and how to build a portfolio that can grow from just a little bit of money all the way to your first $10,000 in profits. First up, you got two safe picks, Bitcoin and Ethereum. Both are huge stores of value and they're not going anywhere anytime soon. Ethereum is the chain for countless blockchain projects and Bitcoin is digital gold. They are boom, they're set. There's even ETFs for both of these now. If you want a low risk, secure crypto pick, these are it. They still fluctuate big time compared to regular investments, but as far as crypto goes, they're solid. They're the most guaranteed to increase in price over time as well, the most solid bets. Now for other relatively safe options, hit up CoinMarketCap again and check out the top 20 coins. You got Solana, XRP, Cardano, Avalanche, Tron, Polkadot, Chainlink, Near, Polygon, Uniswap. I suggest that you check these out and understand why they are as big as they are. Understand the business behind those coins. An important thing to understand here is that these coins will give you slower, more reasonable returns. But if you're a degenerate looking for massive returns, you're going to need to look into smaller, riskier coins that are capable of insane pumps. Bitcoin isn't going to 100x in price anytime soon, but a little micro meme coin, it might. However, the micro meme coin is much more likely to go to zero as well. So that's the risk that you take. For absolute beginners, I would avoid any of the super risky stuff for now. It is a get-rich-quick fantasy. You're probably not ready for it. In investing, there are certain stories that develop their own momentum. The gold rush, the dot-com boom, these stories sweep up assets with them into this frenzy of investor greed. Generally, cryptocurrencies break down into specific narratives, memes, gaming, AI, Solana ecosystem. Memes are meme coins. They have little to no inherent value. They're purely speculative and typically driven by the strength of a community, which isn't necessarily a bad thing, but you have to know what you're getting into. Gaming is any cryptocurrency tied to the gaming industry. This could be Web3 gaming, console gaming, anything. AI, pretty self-explanatory. Any AI-related crypto. Naturally, when AI stocks like Nvidia boomed in the stock market, people became interested in AI cryptos, expecting a similar boom. And then there's the Solana ecosystem, which is a catch-all for any cryptos built on Solana, which has been pretty popular recently. And there's many other narratives as well. But when any of these narratives pop off, such as a meme coin frenzy or the AI boom, you can see huge pumps in similar tokens, and that's what we're interested in. A great strategy for making money in crypto is keeping your ear to the ground on sentiment changes to invest in narratives before they become mainstream. Typically, you'll notice an uptick in discussions around a topic like AI cryptos, and then there will be a logic in why people are talking about it, and then slightly more discussion, and you'll start thinking, this really makes sense. That's the time to buy. That's the time to buy because if you catch a coin early in a trending narrative, it's hard not to make money because the rising tide brings up all the ships being cryptocurrencies within that narrative in this case. But while you should explore and familiarize yourself with these narratives, I'd avoid investing too heavily in them just yet. While you're starting out. If you're barely familiar with crypto, you want to stick with the safer picks for now. Remember, the problem we're solving here is making you your first $10,000. All of these coins are just a means to that end. We want to make $10,000. So let's get you there first, then you can think about the advanced strategies. Because to make $10,000, you have to not lose your money in the first place. Rule number one, don't lose money. And to do that, you want to build a solid portfolio. So here's how to build a solid, secure portfolio. I've got 4 options locked and loaded that you can use, ranging from safe to certain death. And for fun, I named them all after superhero teams. First up is the world's finest. The 2 best side by side. This portfolio is a simple 50-50 split between Bitcoin and Ethereum. If you don't want to know much about crypto, you just want to diversify into it, you want some exposure into cryptocurrencies, this is it for you. You can buy it, you don't even have to think about it. Second is the Avengers. A bunch of solid picks. You got heavy hitters like Bitcoin and ETH adding in that stability, but they're supported by proportionally smaller investments, all within the top 10 coins. For those who want to start exploring, but want to still remain safe, this is the one for you. Third, we have the X-Men, a bunch of oddballs bundled together. This time we're sticking to the top 20 cryptos, ignoring stable coins, just the investable cryptos, but with the heavy balance going to the most reliable ones still, like Bitcoin. This way you can benefit from the unstable fluctuations of the smaller altcoins, but still stay secure with the larger, most solid coins. Fourth, we have the Suicide Squad. Unlikely to succeed, but once in a while, they'll pull off a Hail Mary. A bunch of altcoins equally spread out, huge amount of risk, but if you pull it off, you get a massive return. I do not recommend this for beginners. It's too much work, you'll probably lose your money, but I need to give all the options. So let's say you've determined the perfect portfolio for you. How do you allocate money into that portfolio? The simplest and easiest is dollar cost averaging. This means you just pick a set amount and you buy that much every single week, and you do it like clockwork, whether the market is up, down, or sideways. You set your parameters, you have your plan, you stick to that plan until you have a better plan, but you stick to that plan. You don't go emotional, you don't change the plan because of emotions, you only ever change the plans because of logic. Otherwise, you stick to that plan. Again, you're aiming to make your first $10,000 in profit. Picking a safe portfolio and dollar cost averaging your way into it is the safest way to do it, which brings us to your next 5 moves. Move number 1. Figure out your actual budget. Determine how much you can invest. Your crypto budget is not your investing budget. It's not your savings budget. It's not your rent budget. Your crypto budget is what you can afford to lose, nothing more. This is because you're human. You will make mistakes. Crypto is risky. Never risk what you can't afford to lose. Move number 2, get on an exchange. To get started, you need a secure, reliable exchange and a wallet. Start with Coinbase, with Blowfin, with KuCoin, whatever works depending on your individual goals. Move number 3, buy a small amount of Bitcoin and or Ethereum. Don't break the bank, just get a feel for it. Dip your toe in. The goal is to become a crypto investor. And the goal is to understand this world so you can then make money from this world. Move 4, pick a reliable portfolio and start dollar cost averaging into it. This will depend on your budget, but start investing a preset amount every week on repeat. Do it rain or shine. I don't care if it's $1 a week. Do it. Just start. Move 5, be patient. A safe portfolio and dollar cost averaging will take a little while to make your profit, but it's the most likely strategy to get you there as a beginner. So you need to be patient. But while you're waiting, start learning about smaller coins and narratives. Learn how they interact. Learn the projects, learn the tech behind them, dig into the teams, start planning your next move. Earn income outside of crypto, up your income and your skills so you can put more money into crypto. That's how you get really rich. These are the steps that will take you to your first $10,000 in crypto.
Crypto crashes are terrifying, but that doesn't mean you can't profit from them if you know what you're doing.
Tell them to bring me my money.
So here are 5 ways that you can make money while everyone else is losing it. And forewarning, some of these tactics are on the riskier side of the spectrum. I'm just giving out information on how these options work. I'm not a financial advisor. I'm not your spirit guide. I'm not your dad. Always do your own research as well. Number 1, the first way to profit in a crypto crash is definitely a personal favorite of mine. It's a fan favorite and probably the most obvious on this list, buying the dip. This is one of those strategies that's much easier said than done. And you need to be careful. You need to be careful that you're not buying a turd mid-flush only to go down further and further. And as difficult as it may be to buy more of something that you're actively watching decline in price, it's typically the best time to actually buy that thing as long as you've done your due diligence ahead of time. And I'm sure you've heard the saying, be fearful when others are greedy and greedy when others are fearful. I want to update this to have an open mind when others are closed-minded, because sometimes it's good to have a healthy amount of fear, and most of the time it's good to at least have an open mind. So, if China says for the 200th time that they're going to ban crypto again and everyone is fearful and we see a nice little daily correction, that's when it's best to be open-minded and look at the facts and say, hey, China has said this 199 times before, and in the long run, it didn't really matter. And despite the fact that things like this have happened before, we seem to forget how big the dips in crypto are. I mean, a 10% annual return is great in the stock market over the long run. And we're regularly given opportunities to buy dips of 10, 15, 20% in crypto. And a lot of times it recovers within the same day or within a day or two of the correction, and boom, there you go. That's an S&P 500 return in a couple days. Now, a lot of people will say, I bought the dip, but then it kept on dipping, or I hesitated to buy the dip because I thought it would go lower, and now it's back to an all-time high, and I missed out on all this money that I could have made. And here's the thing. If you're trying to decide what to do while a crypto is dipping, you're behind. You're missing opportunities, and you will keep missing opportunities because you need to have a plan ahead of time. Having a plan is absolutely necessary. So let's say Bitcoin is at $50,000 and you have $1,000 on the side that you want to save in case of a crypto dip. What you need to do is make a plan. So here is an example plan. Bitcoin's at $50,000, your plan could say if Bitcoin drops to 45K, I'll buy $100 worth. If it drops to 40K, I'll buy $200 worth. 35K, $400 worth. It doesn't really matter so much what the exact figures are of the plan, it just matters that you have a plan. Now, obviously, it might be a little bit more complicated than this example that I just made because your portfolio probably is more than just Bitcoin, but you get the idea. This will prevent you from getting decision paralysis and never buying at all, or just impulsively buying too early. It just mitigates impulsivity. And maybe you're a person who's like, I can't do this. I'm going to be impulsive every single time. There's something that you can do. You can set a limit order for specific prices on dips. That way, there's literally an order out there. The price dips, it happens automatically. You don't even have to touch it. Now, if you don't feel comfortable leaving orders up and you want to do it yourself, CoinMarketCap, they have an app that actually allows you to set notifications when coins hit certain price points, and then you'll get this little ping that's like, hey, you said if it hit this price, you should buy it. And then if you stick to your plan, you would buy. Now, if you still feel a little bit lost or unsure of yourself, you can always join my Patreon, where we have a private community of people constantly talking about these things and a whole lot more content. So in there, you can find more specifics on what I'm up to each week, both in stocks and crypto. And I even post whenever I buy something, and I'll give my reasoning. That way you can look at the reasoning and see if it aligns with what you think as well. And we're doing pretty well, I gotta admit. Here's a portfolio snapshot. So if you wanna join, now is the time to do it, since the spots are limited. And I feel like a broken record saying this, but it literally sells out every single time. Moving on to the second way that you can make money in a crypto crash. We're gonna move on to a slightly riskier method, and that is shorting crypto. Now, this is going to get a little bit complicated, but no one said it'll be easy. At the very least, it's good to understand how these things work. So shorting crypto is basically betting against the price of a cryptocurrency. Basically, if crypto goes down, you make money. If it goes up, you lose money. It's the opposite of a normal crypto buy. But this is quite risky, especially in today's climate where, one piece of news can come out or one Elon tweet can come out, and this can spike the price of any various cryptocurrency. And this is especially amplified in altcoins, because in those, positive or negative news really amplifies and reverberates through altcoins, where you can see dramatic price swings from positive or negative news. Either way, if you're going to short crypto, just make sure you do a little bit of risk management beforehand to make sure that you're comfortable with it. So you've decided that you want to short Bitcoin. How do you do it? There are many platforms that trade crypto futures, but most of them are fairly limited as to what you can short or the various offerings with futures. So some of the more popular platforms to do this are Binance, Deribit, BitMEX, Kraken, and KuCoin. KuCoin is my favorite. It actually provides some pretty cool tricks that make shorting easier. So they have regular coins that you can buy that do futures trading technically in the background. So here's how it works. Let's say you wanted to short Bitcoin on a temporary dip. You could buy the coin on KuCoin with the ticker symbol BTC3S. This coin shorts Bitcoin futures at a 3 times leverage. So if Bitcoin drops 10% one day, BTC3S reacts and does so 3 times harder. So you would actually gain 30% in that day. Now you might be thinking, well, I want to short a coin, but I don't want 3 times leverage, which is totally understandable if you ask me. So there's a workaround here, because they only offer 3 times leverage. It's kind of crazy. But here's the workaround. So KuCoin offers a non-shorted version of Bitcoin at 3 times leverage. This coin is BTC3L, Bitcoin long. Basically, this means if Bitcoin goes up 10%, you make 30%. It's 3x leverage on the positive side. So here's the trick. You can buy both the 3x leverage long and the 3x leverage short coins in proportion to the leverage that you want. I know this gets a little bit complicated, but just hang in there with me. So if you wanted to short Bitcoin, but you don't want 3x leverage, here's an example. You could buy $300 of BTC3S and $200 of BTC3L. What this does is evens it out a little bit, and you just have 1x leverage instead of 3x, because you're both buying it long and short, but just more short. I hope that makes sense. Now, I know that was a bit much, but honestly, this is still much easier than trading futures yourself. And personally, I am much more of a buy and hold guy myself. I don't really mess with shorting too much, but there are a million ways to make money. So I like to present choices, because I know there's someone who will watch this and be like, oh, that seems pretty cool. And speaking of choices, we still have 3 more ways to make money in a crash. So number 3, this is altcoins with price floors. So this is similar to buying the dip, but I wanted to give some more specific context here. So, Bitcoin is volatile, but what's even more volatile? altcoins. Altcoins being so volatile have potential for deeper dips, but this enables a higher upside as well and slightly less risk in certain situations, and I will explain why. So when Bitcoin drops, altcoins generally drop even harder as people leave projects. You quickly lose people who were day trading that coin or it just wasn't a high conviction pick for them. So like, nah, it's dropping, I'm out of here. And then you're left with the people still holding that altcoin. These are generally big fans of the project, or they're in too deep and they feel that there's no point in selling now. I know everyone's had that feeling at least once. Or they're people who plan on holding for the long term no matter what, and holding through the dips. These are the people that you want because these are the people creating a price floor. And this means you are nearing the price floor once you're left with only these people. And this can actually take away some of the risk on your end if you're hopping into one of those projects on the floor. But now the question is, how do you know what the price floor is? And you can never know exactly, but you can get the sense of a price floor either by following a crypto for a while and just seeing where the price action goes, or taking a look at a chart and looking at support levels for the price. Now, of course, this is far from an exact science, but it does give you at least a starting point to go off of. Now, what this means is if the whole crypto market crashes, you might be able to buy a promising project at a rock bottom price without much downside potential. Now, of course, there's always exceptions to this. My personal rule of thumb here is to do this with projects that are actually solving real world issues that have money behind them, meaning they solve that problem, they're going to make a ton of money. Now, a good example of this is Algorand. If you look back to May 2021, when crypto dumped, Algo dumped as well, and then hung out around like 80 cents. And it hung out right there for about 4 months. It barely moved in price. And that's because there was a price floor there around the high 70-cent range. Now, this isn't to say that every altcoin will work out like this, but it's definitely better than buying at a peak and then losing 20% or 40% the next day. A situation where I personally did this was with Cardano. I knew it was a project with a great team and they were solving big problems, and it was pretty obvious that the price floor was right around $1. So I bought as many red days as I could over the course of a few months. Basically, any terrible, bloody day I was buying. So here are the days that I bought. And doing this enabled me to be up more than 150% on my position now that crypto has picked back up. It was just like a turbo booster was strapped on my back because I had the conviction for the project. I understood the price action. Of course, that's never perfect. And I was willing to buy on the days where I really didn't want to buy, which was those bloody red days. Now let's talk about tip number 4. Lending as liquidity. One big issue with buying the dip is sometimes you don't have extra cash lying around. You've invested all that you want to invest and the rest is just for other expenses. But it's always important, in my opinion, to have money ready to deploy. If I'd gone all in on that first red day on Cardano, I would still be up right now, but I'd be up around 70% instead of 150% plus, which of course is a massive difference. There's actually a sneaky way in order to make money with your cash on the side and still have cash ready to deploy. The way I do that is through USDT lending on KuCoin. So like I said before, with crypto, we tend to get a little bit greedy, wanting 60% annual returns with our money, when in reality, a 10 to 20% return annually is amazing. With USDT lending, you can easily get those kinds of returns, sometimes even more depending on what crypto is doing. If it's pumping, you can see these returns up to like 70% APY. But here's how it works. When you lend out USDT on KuCoin, you can lend it out for as few as 7 days. And it's typically returned back to you even quicker than that, like 1 or 2 or 3 days. So if you kept just 20% of your crypto portfolio as USDT ready to lend on the sidelines and then ready to deploy into a project if there was any big dips, you would likely make more money in the long term picking those great projects. So if Bitcoin dipped and you wanted to buy more, you would just stop your auto lend, let your funds return to you, and then invest them in Bitcoin. And then next time Bitcoin hits an all-time high, you could take a little bit of profits out of your USDT and just rinse and repeat. And like I said, I actually do this myself, even though USDT is far from my favorite. I'm always lending out a little on the side just to have cash earning me money. In fact, I've made more than $15,000 just lending USDT in the last 5 or so months. Now, I don't really sell when things peak because I just like to accumulate and build my stash, but there's an active strategy if you want to take the active version of doing that. I like to just kind of build things up over time. I have an entire tutorial on USDT lending that I will pin above. Now let's do the 5th and final method to earn money during a crash, and this one is the easiest of them all. HODL. hold on for dear life. Now, a wise man once said, you only lose money when you sell. Now, that's not always the best advice, but it has proven to be true many, many times. So if you're confident in your investments, meaning you've actually done the due diligence yourself and your investment plan is long-term, then there really isn't much of a reason to sell on dips. It's been proven, at least with the stock market, that people who buy and hold almost always come out on top of those who are trying to time the market. And the same goes with crypto, at least so far. Holding is by far the easiest and most efficient way to end up with more cash next year than you have today. So I hope that these methods were helpful. Make sure you hit that like button. Join the Patreon if you want even more content. If you want me to do research for you, get buy alerts, have a private community, do all that, make sure you grab one of those before they sell out. And I would just like to thank you so much for watching, and I hope you have a profitable day.
If I wanted to be a crypto millionaire in 2024, I'd start by memorizing these 3 rules. Don't lose money. Only ever risk $1 to make 2, and leave the leverage to the experts. Crypto's a game where there's a million ways to make $1 million, and if you master those 3 rules, you're 70% of the way to winning the game. And if you win the game, you make millions. Take this example. Here's a crypto project called Render. It's got a great idea and a solid team. Render solves real-world problems. They let people earn money off their computer's extra brain power. It's an easy project to be excited about, which is what happened. Render spiked in 2021. Then there was a sell-off, but it wasn't done yet because it climbed back up and down all throughout 2023 and 2024. Look at the chart and it seems like it could keep climbing from here. Time to make money, right? Possibly, but here's the thing. Render increased 1,000% from 2021 to now. Yet there are investors who bought Render here who still hold the token today, yet they somehow went broke instead of making those 1,000% gains. How? It's pretty simple. They broke one of the 3 money rules. If anyone got overexcited, invested more than they could afford, or nuked themselves with leverage, then these countless dips all throughout Render's journey could have just bankrupted them. No more opportunities, no more $1 million. And that's why stage 1 of making millions in crypto is mastering the basics. If you don't master the basics, you can literally take a once-in-a-lifetime opportunity like that and ruin it for yourself. Don't be that guy.
God, please, no!
Now there's even more value I'm gonna give you for free in this video. I'm gonna reveal how you can easily use investor psychology to game the world of crypto to your advantage. How to build the mindset that you need to make $1 million off of crypto. How to pick and screen low risk, high return coins. Plus I'm gonna sneak in 2 secret strategies I'm personally using to make massive profits in 2024. Because the truth is, once you know the fundamentals, your eyes will be open to the limitless ways to make $1 million in crypto. Actually, you know what? I'm gonna give you one of those sneaky strategies right now. This is the only way to $1 million in crypto without actually having a strategy. You just copy and paste someone else's. The trick here is insider trading. Insider trading. It's illegal, you know, unless you're the world's greatest investor, Nancy Pelosi, but it goes down all the time in the crypto world because, well, it's not actually insider trading in crypto because this is all public information. You just have to learn how to find the right information. It's super simple. Here's how it works. Find wallets that bought big into projects early, then rode them during a pump. If those wallets keep doing this over and over again, like suspiciously well, odds are they're either a developer or have some kind of insider information. But how do you find these wallets? You can use a tool like Dex Screener to find top traders on specific tokens. Look for big early buys. This will take a while, like have patience when you do this. But when you found one, copy the wallet address and plug it into a tool like AlphaTrace. This will let you see the profit and loss and their win rate and all kinds of good information. Now, if the wallet has a huge positive P&L, a profit and loss, a huge profit and a solid win rate, copy it. Repeat its trades, profit. Like, it can be that simple. I'd look for wallets with a 70% plus win rate and over $500,000 in profits. This is a brain dead, easy mode way to farm solid trades and climb to $1 million, but it doesn't end here. An even simpler way to do this is to follow trade signals from someone else who has a very high win rate. Look for someone with trades like this: 18% gain, 31% gain, 54% gain. Those are all recent trades from our members and coaches over in my trading group FINOVA, which means if you were a member last week, those gains would have been yours. On FINOVA, we have over 50 hours of crypto training videos, and we show you exactly what myself and other expert traders are buying and selling in real time. You can check out why our members are obsessed with our service, linked in the description. But just a word of warning, we sell out of new member spots every week. So if you want in, join now. Now let's talk about something a bit more traditional. It's been around for at least 2 million years when Australopithecus was walking around. This is mind games. On the surface, all markets, whether crypto or stocks, are measured measures of price, but in reality, they're measures of something much more irrational, emotions. This might sound like a problem, this might sound like an issue, but it's actually how you're going to make money in crypto, because it's possible for you to develop a rock solid mindset while simultaneously making money off the patterns and emotions of the crowd. Let's start with you. There's a key mindset that's needed for any crypto strategy if you're ever gonna make $1 million, and it pairs perfectly with the 3 money rules that we discussed earlier. That's emotional resilience. Not many people have this, but it's totally trainable. If you've ever been sitting there watching a big trade of yours on the line and felt overwhelmed, you don't know for sure if it's going to win or lose, your heart is beating out of your chest, you don't want to lose this money, but it could, the opportunity. This is a bad place to be. You're not making rational decisions in that place, in that mindset. So here's an example. Beam is a gaming crypto that's got a lot of attention recently. It's a blockchain tied to the Avalanche ecosystem. They're doing exciting things. There's a lot to like, but take a look at this. Beam's all-time price has been jagged, consistent up and downs all throughout its lifetime. If you had a bad relationship to failure or you overinvested, any of these losses would have thrown you off of this solid project, one that has shown incredible resilience and earning potential for the people who are able to just invest and chill. Just chill, or not invest too much. So how do you get your emotions in check? How do you stop feeling like a failure? That way you can be on the winning side of the market. If you can do that, you can be on the winning side of the market. I'll tell you what the best traders do. 2 things. First, they train their emotions with smaller losses and smaller wins. They trade with amounts that aren't exciting to them at first to be able to eventually handle larger and larger trades with low emotion. No one's expecting you to be able to trade $10,000 right now and not think about it. Start with a couple bucks if that's what you can trade and not really think too much about. Almost everyone could benefit from trading with less money. And second, they only ever trade if they're confidently risking $1 to make 2. And the key word here is confidently. The only way to be confident that you're risking $1 to make 2 is by having a stack of wins that you can point to that prove to yourself that you know what you're doing and prove that in the long term you'll come out ahead if you just go ahead and continue your strategy. So you're building that confidence over time. You might be thinking, like, that doesn't sound very easy to do. It's not. It's not supposed to be. It's making money. It's supposed to be the hardest game on the planet. You're trying to play the hardest game on the planet. You expect to be a pro day one. It just doesn't work like that. So start small, get your emotions in check, stack up a pile of wins that allows you to prove to you that you know what you're doing. And then once you've mastered yourself, you can take a look at everyone else and notice what the crowd is investing in. Keep tabs on narratives, keep tabs on emotional states that are trending. What you're gonna do is buy into people's fear and sell into people's greed. You've probably heard this before, but it's insanely important that you hear it again because most people, they buy during greed and sell during fear. You're not gonna do that. No. You're gonna spot narratives that are about to begin trending. You're gonna buy into those narratives before they start trending. And when I say narratives, that could even mean things like emotional states, like the market's about to crash. That is a narrative. That can be a narrative. Or a narrative could be categories that are about to get a lot of attention, like gaming, AI, or meme coins. If you keep a non-judgmental ear to the ground, you'll be surprised how possible it is to guess where society's preferences are trending. If you can guess that correctly, you can make a whole lot of money. If you don't believe me, next time you're browsing Twitter, pay attention to new opinions that you see popping up, and then write down your forecast as to how you think that might turn into a bigger trend in the future. Trust your gut and be non-judgmental, and you will be surprised how often you're correct about trends. It's no different for crypto. Keep that ear to the ground and certain things will pop up. They'll stand out and you'll begin to think like, there could be something there. Because typically things that trend, there's some truth in them that you notice, that you pick up on, and you can go, other people would pick up on that too. Now maybe you've identified some narrative that you think is about to start trending. You can then use CoinMarketCap to find tokens within those narratives. For example, the projects I mentioned earlier in this video, Render and Beam, those both fit within trending narratives. SNEC is another token that I love. SNEC is a meme coin with a great team, great community, excellent branding, key assets for any project, also within a trending narrative. They've got resilient price action and plenty of room to grow, especially once we get this thing on a large SEX listing. And of course, for full transparency, I've partnered with SNEC to assist in brand direction, so I'm affiliated with that project. But this brings me to another sneaky way to make $1 million in crypto in 2024. I'll tell you this, then I'll tell you how to pick low market cap, high potential coins. The sneaky strategy is simply joining a crypto project and helping them. Crypto is growing. There are countless projects that need help and are willing to pay you to help them. This could be a few hours a week of work or a full-time job. If you have any skill, pitch that to small startup projects you like and try to be a part of it. This is exactly what I did with SNEC. I was searching for tokens that I thought could potentially do a 100x. Then I realized that I have a lot of value that I could bring to any crypto project. I like working and building things. You can do the same. Pitch yourself. Worst they can do is say no. And on that note, let's talk about how to filter through small projects to find the very best. Let's say you have 10 small crypto projects that have caught your eye. This could be for investing, for trading, or partnering with. I want to make it clear that there are a million ways to make $1 million in crypto. I'm giving you the zoomed out framework to figure out what is the best strategy for you. If you nail all these pieces in the framework, you can make millions. So you have 10 tokens. Next, put them into dropstab.com to get a closer look at the investors, the socials, and see how serious the project looks. If it's looking good, it's time to see if it's safe. Take your token to VestLab and look through the tokenomics. Check out how the tokens are allocated to the community and investors. If it doesn't look fishy, keep on going. Check out platforms like RugCheck and CoinScan to see if it's a dirty contract that could potentially rug pull you. If it is, of course, get out of there. Don't invest in anything that is remotely shady. Also, make sure you check into the developer. Check out their history. Make sure they've never done anything scammy or shady in the past. If he has, get out of there. It's not worth it if there's a red flag. Plenty of other projects to check out. If it's good, move on to the next step. You could add in a phase about making sure it aligns with your personal tax saving strategy. For example, some people bias towards coins that are available on sites like iTrust Capital, because that means they can pay zero tax on their wins because they can trade within a retirement account. If you've never heard about that strategy before, I will link iTrust in the description. I think they're running a $100 sign-up bonus right now. Feel free to check them out. But either way, at this point, you might have found a solid token. It's time to check out where we are in the crypto greed fear cycle. See where market psychology is at. See if the coin is in line with narratives that you think are about to pump, and then start buying or trading or joining the project. Now, what if you're beyond the fundamentals? You've embodied the 3 rules of money. You have your emotions in check. You understand market psychology. You know how to pick coins. You're on your way to $1 million. Well, you better get to work. You got $1 million to make. Now, if you'd like to see these concepts I discussed today in action, check out this video on screen where I interviewed a trader on how he turned his last $26 into $2.7 million.